there were some really interesting initiatives, especially around infrastructure financing and trade and investment on the continent through programs such as Prosper Africa, as well as the creation of the International Development Finance Corporation. So this doesn't have to be a priority for Trump himself, but it's certainly, I think, if this project stays in the background, but can show real benefit for the US, again, in their rivalry with China in particular, then it benefits everybody. It's a win-win-win, but it doesn't necessarily need to be, as I said, top of the agenda for Trump himself.
And yet, Zianda, we're still seeing China outpace the U.S. and others on foreign direct investment to Africa. Do you expect that will continue and Africa then will just be the beneficiary of a lot more investment because this Lobito project seems to be at least an early success?
That's a really good question, and I think only time will tell. The domestic politics across all three of these countries, and we haven't necessarily even mentioned Tanzania, which is a possible expansion point as well. The domestic politics in all of those countries are going to have to be favorable, to again the expansion and the growing of an opportunity like the Lobito corridor. So I think all of the ingredients are there for many of the countries, both in the region, on the continent, to really benefit from what is at this point a really, really interesting geopolitical rivalry, and one that Africa can absolutely capitalize on. But it doesn't matter what the individual governments, involved in a project like Lobito and other future investments, how they're going to be shaped, how they're going to, position themselves to really take advantage.
And Zianda, let's just finish on the G20. South Africa took over the presidency. How do you think potentially they can carry the mantle? We've heard Ramaphosa say this is about Africa and prioritizing Africa for the globe. What's your take?
I think that's very broadly true. That's been a hallmark of Ramaphosa's administration, where foreign policy didn't really quite take shape until I think the second half of his first term in office. But now it is really quite laser focused on common issues, that affect African countries, that really run the gamut from, climate change adaptation and equitable access to global financing, as well as equitable access to pharmaceuticals and life-saving vaccines. I think that'll be very much a focus for South Africa's G20 presidency. And I would expect, in the same way that Ramaphosa and his administration invited many African leaders to the BRICS summit in Johannesburg in August 2023, I would expect the same, going into this year's G20, especially given that the African Union is now also a member of the G20.
Absolutely. And they did say they believe Trump will attend, so time will tell. But great to get you on and get your insights. Zianda Stearman, Senior Analyst for Africa at the Eurasia Group, there with us in Cape Town. Thanks so much. Now, coming up, Ghana heads to the polls to elect a new president. In the backdrop of economic hardship and a debt crisis, we'll explore the challenges facing the country's next leader. Stick with us. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Iliad is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Well, it's been a year of profound political change in Africa and really the globe, with voters punishing ruling parties in South Africa, Botswana, Senegal, and Mauritius. And now Ghanaians are set to follow suit when they go to the polls on Saturday. With the president stepping down, the ruling party is fielding Mahamadou Bawumia as its candidate, but opinion polls suggest a decisive win for ex-president and opposition leader John Mahama. Here's a look at the economic backdrop to the election and the challenges facing the next administration.
Investor confidence in Ghana was high and foreign direct investment was climbing, while multinationals from Microsoft to Unilever to Societe Generale had operations in the country. Things started going wrong, though, as a growing debt burden spurred a surge in inflation to a 21-year high amid a slide in the currency, the cedi. The country defaulted, and after tough negotiations, a restructuring with the IMF followed. Some of these blue chips pulled out, and the crisis spilled onto the streets as the soaring cost of living strangled the economy. But today, there are some positive macro signs to greet the winner of this year's presidential elections. Ghana's economy grew 6.9% in the second quarter, the fastest pace in 5 years. And Moody's raised its credit rating outlook for the nation's debt in October. The country's political leaders, though, will need to build on this momentum as they look to repair investor confidence, with opportunities to revive the petroleum industry and further boost its leading position as Africa's biggest gold miner. All this as Ghana services its newly restructured debt and looks to restore foreign direct investment, returning what was once the continent's rising star to the path of economic stability.
Now, for more on Ghana's elections and the main challenges facing the country, let's bring in Bloomberg's senior reporter, Yinka Ibukan, in Accra, Ghana. Yinka, talk to us about what investors are expecting from this election.
So, first and foremost, Jen, investors are expecting peaceful elections, and Ghana has a good track record in that regard. But then in terms of the foreign direct investors, like the ones that you've mentioned, they'll be looking for an improved business environment and also signs that households' purchasing power is being restored after being battered by inflation. For bond investors, many of them have been affected by this restructuring, through which Ghana restructured most of its $30 billion external debt. And so for them, it will be about Ghana showing that it's ready to be fiscally responsible, spending less and earning more, so that they can get restored confidence in this market.
And Yinka, one of the main challenges that Ghana has is with illegal gold mining. You actually have a story out right now just about that. What are we hearing from the candidates about their solutions to fix that?
So illegal gold mining is a multifaceted issue, and we're in a context where Ghana really can't afford to forego revenue that could help prop up its economy. For that reason alone, it's quite urgent that something is done about it. But it's also a social issue because people are literally risking their lives to go get gold, and also an environmental issue with widespread pollution. What used to be the case is that both parties had done crackdowns to clamp down on illegal miners. But increasingly, their discourse is about formalizing the sector and figuring how to capture the revenue while also promoting responsible mining practices. It remains to be seen if there will be political will to follow through on these pledges.
So, Yinka, do you think something is going to change in regards to this issue anytime soon? Maybe just in 30 seconds or so.
It has to change, Jen. It's been like this for a long time, but it does have to change. I think everyone understands that, but it's quite a complex issue, which is probably why it's lasted this long. And it's really about political will.
All right, we'll leave it there, and everyone should definitely check out Yinka's story that is now available on the Bloomberg Now. Bloomberg's senior reporter, Yinka Ibukun, in Accra, Ghana. Yinka, thanks so much for your reporting and for joining us. And before we go, author and columnist Shiku Kamira joins our podcast Next Africa this week to discuss the continent's ongoing issue of brain drain. It's available now and every Friday on Apple, Spotify, and wherever you usually get your podcasts. Well, that's all we have time for today. Join us again next month and next year. From me, Jennifer Zabasaja, it's goodbye from Johannesburg. Thank you so much for joining us.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Emmanuel Macron vows to serve out his term as French president, promising to choose a new prime minister who will work with everyone. In our exclusive interview, National Rally leader Marine Le Pen tells us a budget will pass if the government narrows the deficit more slowly.
Well, it's a matter of a few weeks. We'll discuss it with the new Prime Minister. We'll work together.
South Korea's ruling party leader now says the president should be suspended, a major shift ahead of an impeachment vote for treason. And Chinese stocks gain on stimulus hopes. European and S&P futures edge lower as investors await US jobs data later today. Happy Friday. European futures pointing lower by 0.3% after 6 straight days of gains, despite the political uncertainty in France. We've seen that story turn around as well in terms of a day when the futures are pointing lower and then you end up in positive territory. We'll see if that plays out again today. You'll see if we get 7 straight days of gains. We've had 6 straight days of gains, and if we get a 7th over in France, that would be the longest winning streak for French equities in 3 years. Pretty remarkable, again, given the standoff we're seeing politically in Paris. FTSE 100 futures pointing lower by 0.2%. S&P futures, after a modest drop of around 0.2% yesterday, pointing lower by about 0.1% so far in the session. We look ahead to non-farm payrolls, of course, with a print expected of above 200,000 for the month of November. Nasdaq 100 futures currently flat after some losses yesterday as well, around 0.3%. The Russell 2000, though, took a bigger hit in terms of the small caps stateside. Let's flip the board and have a look cross asset. Markets expecting still about a 70% chance of a rate cut, another one coming through from the Fed on December the 18th. We'll see if the jobs data adjusts that. The unemployment rate expected to remain at around 4.1%. That is the overall forecast, though Bloomberg Economics thinks it could tick up to 4.2%. Again, the overall number, you're looking at around 200,000 for the month of November, though we know there's some uncertainty around that. The US 10-year currently yielding you 4.17, euro dollar at 105, currently a little softer by 0.1%. Brent at $72 a barrel. We had that decision by OPEC Plus to push out until April, adding any new barrels to that market. Concerns about a surplus. Bitcoin pairing some of those gains, 97,000 right now for the cryptocurrency, down 1%. Let's get to the politics of France now, because French President Emmanuel Macron says he will serve out the remainder of his presidential term as he seeks to put an end to the political turmoil in the country.
C'est pourquoi je nommerai dans les prochains jours un Premier ministre.
This is why I will appoint a new prime minister in the coming days. I will ask them to form a government for the general interest, representing every political force within the spectrum of parties destined to govern, and that they could join or at least agree not to bring it down. The prime minister will consult and form a more effective government at your service. Its priority will be the budget.
Meanwhile, far-right leader Marine Le Pen told Bloomberg in an exclusive interview that she believes the outgoing administration's plan to bring the budget gap to 3% of economic output by 2029 is not feasible.
Getting to 3% in 2029, I don't think it's credible, but I'm not the only one. I don't think it's credible either to the president of the Cour des Comptes. Once again, these are simply promises, and they know very well they can't keep them. Mr. Barnier made this promise, and in reality, his budget worsened the deficit by 12 billion. So if we don't make significant, intelligent structural savings with regard to the state, and if we don't put in place the conditions so that companies can work, invest without being suffocated with extra taxes, we won't get there. But with these two solutions, we can succeed as quickly as possible to get back to a reasonable deficit, even if the 3% was just decided on the back of an envelope.
How fast could that be? C'est l'affaire de quelques semaines.
Well, it's a matter of a few weeks. We'll discuss it with the new Prime Minister. We'll work together. We'll explain what our red lines are. Our red lines are we can't ask the French people to pay the bill for the mistakes of their leaders. That's what Mr. Barnier did. He massively increases taxes. He hits sick people, retired people. He hits everyone. And at the same time, once again, there's zero savings from the state. That's inadmissible.
Okay, the National Rally leader, Marine Le Pen, speaking exclusively to Francine Lacqua, who joins us around the studio right now. Back from Paris then, Fran. What else did she have to say about the budget?
Tom, good morning. We had a great conversation. It was about 18 minutes long. And actually on the budget, she was quite interested in speaking or making a message to the markets. First of all, she looks at the markets. She's, the first thing she said as I walked in was, look at the markets. They're not too worried about what happened, because in France, she's getting a lot of blame for having almost dissolved the government. Now, on the budget, she had a very long-term view, and I was surprised that she said, look, some of the things that they promised, so it's at 6% of GDP this year, it'll get to 5%, 3%. She says, we need to take a good look at that. She says, why 3%? We need to make sure that it's sustainable. But the fact that she's looking at the markets and at least knows that she wants to stay within the EU rules, maybe it's of some comfort to the market. So it's very clear that she thinks the next prime minister will be tasked with making her happy enough to vote him through. So she, struck this message of conciliation, saying, look, I'm ready to work with, no matter who he appoints, it's the policies that I'm interested in. And I think she's hoping that taxes will come down. That felt to me the one thing that she was hoping for.
Yeah, I mean, it's really interesting. Whatever one may think of the brinkmanship, whatever one may think of her politics, she's right when it comes to the markets, isn't she? I mean, French stocks are up for 6 straight days. And on the back of your conversation with her, that spread over the German debt narrowed. So she has a point. Why are the markets? What is your understanding of why the markets are relatively within the context relaxed?
Yeah, so frankly, it's a little bit odd, because if you look at the next 5 to 6 months, it's very difficult to see a way forward. If you look at Parliament, I mean, remember, they have to find a government with the 3 blocks in Parliament. They're extremely difficult. You have right, far, far left, and then you have a center which basically disintegrated. So it will be very hard to find a broader coalition than what Mr. Barnier had. I think the markets are probably looking at the ECB as a backstop, saying, look, no matter what happens, they're there to react. And remember, it was such a shock when Emmanuel Macron dissolved Parliament back in July that kind of hit French assets. So the markets at the moment are in a bit of a wait and see situation, thinking it can't be as bad or as concerning as what happened in July.
Yeah, a lot of it already priced in. The ECB maybe as a backstop. When do we get a new PM then in France?
So when we spoke to Marine Le Pen yesterday, she was pretty sure, and actually she said in the interview that she thought a prime minister would come yesterday, actually, almost the day after the dissolving of the government. We didn't get one. We heard, of course, from Emmanuel Macron that he vows to stay on. There's a lot of pressure, and you can really feel it when you're in France. There's a lot of pressure for him to resign. There's really no reason why he should resign. Marine Le Pen has not called for his resignation, so it looks like the president stays until 2027. But the longer he delays it, probably the longer he gets accused that it's his fault. And then, of course, Donald Trump shows up with with 50 heads of state for the reopening of Notre Dame. So I was expecting something before then, so that it takes the attention away from the nomination of the prime minister. But I guess, Emmanuel Macron doesn't have a good name yet.
Okay, still waiting for that name. Still waiting if he can land on someone that will maybe appease all sides of this political debate, though that seems like a challenge, to say the least. Francine Lacqua, thank you very much indeed with that exclusive conversation with the power broker in Paris right now in France. Marine Le Pen, of course, the head of the National Rally. Some breaking lines right now, and we move from the politics of Europe to the politics of Asia, and the uncertainty there, of course, focused on South Korea. Some lines crossing in terms of what we've been hearing as we look at moves, of course, to impeach the president on the back of that imposition of martial law, even if it was only imposed for 6 hours. Remarkable events, of course, earlier this week. We are seeing some live pictures right now. This is in Seoul, of course, the South Korean capital. South Korea's Yoon is in focus. The National Assembly Speaker will be giving an address at 3:20 p.m. That is according to reports out of South Korea. South Korean opposition lawmakers will be blocking and are blocking, this is apparently the pictures that we're seeing, the president from entering the National Assembly. Appears to be what we are seeing right now. These are live pictures. You can see the confusion there. That appears to be lawmakers blocking the entrance. Again, according to reports, to, of course, the South Korean president. We continue to monitor events there as it seems moves are underway again around that impeachment, given that the leader of the political party in which the president sits has now suggested that he is willing to move ahead with those impeachment proposals. Let's bring in right now Sohee Kim out of Seoul. What is the latest? Explain what we are seeing on the ground. in the capital of South Korea and where we are in terms of moves to impeach the president?
Situations here in South Korea are dramatically shifting every hour and then every minute. So we heard the breaking news now that President could shortly arrive at the National Assembly to meet ruling party leaders. But 5 minutes ago, the presidential office announced he's not going to come to the National Assembly today. So there are a lot of confusions and misleading information. So we are continuing to monitor the development of news unfolding the historic moment at the moment. So this comes after the ruling party leader Han Dong-hoon just finished his meeting with President Yoon after he changed his stance overnight, saying Yoon's duty should be suspended immediately. So the next 24 hours will be so crucial to see the next development as the impeachment vote is scheduled late afternoon tomorrow. For the motion to be successful, the opposition party needs only 8 supporting votes from the ruling party.
Sohee Kim in Seoul, thank you very much indeed, reacting to the breaking news and clearly the situation on the ground in the South Korean capital changing very quickly indeed. The South Korean presidential office saying that the President Yoon will not be visiting Parliament again, according to reports. We keep across this story for you as the developments continue. Let's get the market reaction right now. Bring in April Hong in Singapore. A good day for Chinese assets and Chinese equities. A challenge again when it comes to the equity markets of South Korea.
Yeah, it's interesting to see how South Korea's benchmark is pairing some of the earlier declines, even amid the uncertainty in the country and what you just heard from Sohee. It's on a day where investors overall are really cautious because it's not just the South Korean political turmoil. Investors are also looking ahead to the US jobs data. China, as you say, is an outlier. There is optimism surrounding stimulus ahead of a key economic conference next week. There's also been talk about Trump's pick for ambassador to China. That's somebody that spent a lot of time in the Asia region, highlighting as well what we're seeing in dollar yen, because today we did get some wage numbers which support the case for the BOJ to hike. So dollar yen sitting below the 150 level for the board. And let's recap what we've been seeing on dollar Korea won this week. Just looking at that spike earlier in the week following the late Tuesday shock announcement for martial law. And I wanted to highlight what we're seeing also more recently today, because that news in local media of second martial law, of course, that's something that's just been dismissed by the Special Forces chief. But I wanted to highlight how this spike just shows you how on edge investors are about the political situation in the country. The Korean won today, the decline on a day where most Asia currencies are actually climbing against the greenback. Tom.
Yeah, the market move is interesting, isn't it? Watching the currency and the impacts around those rumours of potentially a second attempt at martial law that, as you say, that has been dismissed by military leaders. April Hong in Singapore, thank you very much indeed. Let's focus in on the jobs data then that April touched on. The key data point of the day, of course, when it comes to these markets, and the Fed's decision as well, how that impacts the Fed's decision. Markets now pricing at about a 70% chance of another cut from the Fed on December the 18th. Bloomberg's NLive's Mark Cranfield with the analysis. Mark, what are you and the team going to be scrutinizing when it comes to the jobs data out of the US later?
Well, traders are really focused on that unemployment rate. There's a lot of moving parts. There's the non-farm payrolls to consider. There's the average earnings. But really, it's all about that 4.1% estimate for the unemployment rate. It was the shock of going up to 4.3 earlier in the year in the July numbers, which was the one that prompted the Fed to do their 50 basis points rate cut. And so people will be looking at that very closely. Anything 4%, 4.1 probably means that the traders will be expecting the Federal Reserve to go ahead with another rate cut in December. If there's a shock and we drop to a 3 handle, if it's say 3.9% on the unemployment rate, that will be the last chance really for the Fed to go on hold. So really it's that unemployment rate that's very, very important. If it's anything in line, people will fully expect a 70% price for a rate cut in December, and they will be expecting the Fed to deliver that. So they'll pretty much look through the non-farm payrolls. There's a lot of distortions to do with the hurricane, but they will be looking for anything that can confirm that they're right on their betting that the Fed is going to go again and then probably start to hold in the first quarter of next year. So watch out for that 4.1% number later in the day.
Okay, that's the number to watch, with Bloomberg Economics suggesting that maybe we get 4.2%. Mark Cranfield, MLive strategist, look through the non-farm payrolls print because of the uncertainty. Focus on the unemployment number. Mark, thank you for the preview for that data point. Coming up, OPEC Plus is accepting that its mission to defend oil prices will drag on much longer than expected. We discuss the oil markets next. We're going to bring you live pictures right now from outside the National Assembly building. Fairly chaotic scenes as lawmakers line up inside and outside that building in, of course, the South Korean capital, Seoul. We are hearing now from reports out of that country that the National Assembly Speaker has cancelled the address. We're also hearing that the president will not be visiting Parliament. You can see attempts there by lawmakers to make their views known after, of course, that shock imposition of martial law. We'll keep, of course, this story for you throughout the programming. Stay with us. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Now, OPEC Plus is coming to terms with signs that its mission to defend crude prices will drag on much longer than expected. At an online gathering, the group agreed for a third time to delay the revival of halted production and to slow it down. Joining me now is Carol Nackley, founder and CEO of Crystal Energy, for the analysis on these oil markets and this decision by OPEC Plus. Not a big surprise, Carol, of course. It is the third time, as we say, that they have delayed this decision. Will it be the last?
Well, if it's the third time, it doesn't have to be the last time, because OPEC is reacting to market conditions. Market fundamentals have not supported the arrival of more barrels to the market unless OPEC is happy to see prices going below $70 a barrel. And also add to that, we had significant geopolitical tensions, and still prices were trading closer to the 70s than they were to the 80s or 90s. So market fundamentals on the one hand, are not supporting additional barrels. But also there is another dimension, that is the geopolitical dimension, not in terms of war in the Middle East, but the arrival of President Trump to the White House. How would his policies look like? Because they would affect oil production and oil trade directly and indirectly. Domestically, is he going to deliver on his promise of achieving record production levels by supporting drill, baby, drill? And what about globally, his relationship with China, the trade tariffs on China, which is the largest oil importer in the world, the relationship with Iran? Is he going to go back to maximum pressure on Iran in an attempt to reduce its exports to zero. That's something he did not succeed in doing, but he managed to reduce them to 500,000 barrels a day, which would mean a withdrawal of around 1 million barrels a day of oil in the market. What about relationship with Russia? So I think it's sensible for OPEC to wait for the first quarter of next year before deciding what to do next. Whether they will postpone again, it all depends on the price signals that they are getting from the market then.
Carol, the IEA, I mean, given all of those uncertainties emanating from the incoming Trump administration, difficult to put a pin in it, as you say. The IEA suggesting that we could be in surplus throughout 2025, even if OPEC Plus doesn't add a single extra barrel of oil to these markets. Does that align with your assessment?
I mean, indeed, the IEA has always been cautious, especially for what we saw for 2024 in terms of oil demand outlook, but also for 2025, whereas OPEC has been the most bullish in terms of oil demand growth, and they have been the most ambitious with at least 1 million barrels a day difference with the IEA forecast. But so far, the IEA seems to have been vindicated. Its numbers are closer to what we are seeing in the market. For 2025, if we put the political uncertainty on the side, if we don't see a significant boost in the Chinese economy in particular, yes, I've subscribed to the camp that oil prices would be under pressure. And we're already seeing some business reports and business surveys. Yesterday, I read about something in the US that people are expecting WTI to trade around $60 a barrel for 2025. So the overview, the general overview for 2025 is that of rather depressed prices.
Yeah, and before we let you go, Carol, to that point, I know you've told me before that it's a fool's errand to kind of try and predict an exact number around pricing. But as you say, we've had the likes of JP Morgan, Citigroup suggesting that the Brent will be in the 60s next year. Just broadly, in terms of that range, does that seem reasonable as an assumption, given what we know now?
Yes, putting aside the political dimension, I think based on market fundamentals and the absence of significant stimulus in China, I think it's not unreasonable to look at prices range between the 60s and the 70s or even a little bit more. But this is a kind of current market sentiment. Mind you, it will change depending on how the situation will unfold in the coming few months.
Carol Nagli, founder and CEO of Crystal Energy, on what we can interpret from this decision from OPEC Plus to delay once again for the third time, putting more barrels on the market, delaying until April, and expectations to that story around a surplus for these oil markets will continue into 2025. Always smart on the oil markets. Carol, thank you very much indeed. We bring you live shots once again from the National Assembly in Seoul, the South Korean capital, of course, where you see lawmakers there standing at this event. The situation is clearly volatile. We're getting reports from local media suggesting that a planned address by the Speaker of the National Assembly has been cancelled. We're also seeing reports that the President Yoon, who of course made that shock announcement around martial law, that the President has cancelled that visit to the National Assembly, to Parliament, again, according to reports. Other lines crossing the last 12 hours or so, suggesting from some officials within South Korea that Yoon, in fact, ordered that lawmakers were arrested when he imposed a martial law. Military leaders, at least some of them in South Korea, now suggesting that they would not enact martial law if the president tried to push it through again. So it's a volatile situation on the ground in South Korea. We keep across that for you, the National Assembly Speaker, asking you to delay that trip to Parliament. There's a lot more coming up. Stay with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Now, the carbon capture industry is facing a reality check with the pipeline of planned projects looking far from certain. Here to unpack what is happening is Anastasia Tomasidou, analyst in Bloomberg NEF's Sustainable Materials team. Anastasia, a really important story. Is the industry in trouble?
That's a great question. It's really been a year of cancellations. And on top of this, we've seen the investment drop to under a third of what we've seen last year. So definitely a reality check. And although there is 400 million tons of capacity in the pipeline for the end of the decade, we only expect about half of that is likely to come online. And this is because of many reasons, like the lack of midstream infrastructure or a lack of viable business case and insufficient project economics, but also pushback from communities where these projects are located. And so the projects we think will actually commission are those that have reached financial close already or made major projects progress towards doing so. For example, awarded major contracts or received transparent storage permits or major government support, but the rest are at high risk of cancellation.
Okay, well, really interesting. And some headwinds. The headwinds are clear then. What is the situation in Europe right now?
The Europe picture is a bit brighter with more, the policy momentum growing and many of the major hubs in the region making progress. In fact, 3 of the major hubs have made significant milestones this year. So the Northern Lights project in Norway is now fully completed and ready to receive and store CO2 from industry. This is a very important project because it's the first globally to demonstrate cross-border transport and storage of CO2. So it can really unlock the value chain, especially in Europe. The Porthos project in the Netherlands started construction, and the Ravenna hub in Italy started injecting CO2 offshore under the seabed. So definitely a lot of good progress happening there.
Anastasia, thank you very much indeed. Some progress in Europe, some challenges overall for carbon capture and the projects that are in the pipeline. Really smart analysis. Anastasia, thanks for coming into the studio. Anastasia Tomasidou, analyst at Bloomberg NEF. Coming up, French bonds gain after Marine Le Pen tells Bloomberg the budget could pass. We'll get the details, the exclusive. This is Bloomberg.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Good morning, happy Friday. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Emmanuel Macron vows to serve out his term as French president, promising to choose a new prime minister who will work with everyone. In our exclusive interview, National Rally leader Marine Le Pen tells us a budget will pass if the government narrows the deficit more slowly.
Well, it's a matter of a few weeks. We'll discuss it with the new prime minister. We'll work together.
South Korea's ruling party now says the president should be suspended. It's a major shift ahead of an impeachment vote for treason. This as opposition lawmakers reportedly block Yoon from entering parliament. And Chinese stocks gain on stimulus hopes. European and S&P futures, though, edge lower as investors await US jobs data later today. Let's check in on the markets then. We've had 6 straight days of gains for European stocks, 6 straight days of gains for French equities, despite the uncertainty politically. We are pointing lower in the session so far. Futures off by 0.3%. If that reverses and you're in positive territory, if you end with 7 straight days of gains over in France, that would be the longest winning streak in 3 years. Counterintuitive on some levels, but maybe it's a reality around how much was priced in since June on political risk in France. FTSE 100 futures currently off by 0.1%. S&P futures flat after dropping just 0.2% yesterday. Nasdaq futures were lower by 0.3, currently pointing to very modest gains. We look ahead to the non-farm payrolls picture, of course. Let's flip the board and have a look at how this is being priced across the Treasury curve. Expectations, of course, that you will get a cut on December the 18th. There's still a little bit of uncertainty, about a 70% chance being priced in by the markets. 4.17 right now on the 10-year. There has been money moving into Treasuries more broadly over the last few weeks with yields down. Currently at 4.17. We'll see how that adjusts on the non-farm payrolls print. Expected to come in the number of around 200,000. Unemployment at 4.1%. It's the unemployment number that you should focus on, according to IM Live Team. Euro dollar at 105, down 0.1%. Brent $72 a barrel, and Bitcoin 98,241, just down 0.8%, but a bit of a drop from that 100,000 level that it crossed earlier this week. Now, a measure of French bond risk fell on hopes that lawmakers will strike a deal on next year's budget sooner rather than later. Far-right leader Marine Le Pen told us in an exclusive interview that a budget can be passed in a matter of weeks, quelques semaines, she said, if the next prime minister is willing to narrow the deficit more slowly.
Getting to 3% in 2029, I don't think it's credible, but I'm not the only one. I don't think it's credible either to the president of the Cour des Comptes state auditor. Once again, these are simply promises, and they know very well that they can't keep to them. Mr. Barnier made that promise, and in reality, his budget worsened the deficit by 12 billion. So if we don't make significant, intelligent, structural savings with regard to the state, and if we don't put in place the conditions so that companies can work, invest without being suffocated with extra taxes, we won't get there. But with those two solutions, we can succeed as quickly as possible to get back to a reasonable deficit, even if the 3% was just decided on the back of an envelope.
How fast could that be?
Well, it's a matter of weeks. We'll discuss it with the new prime minister. We'll work together. We'll explain what our red lines are. Our red lines are we can't ask the French people to pay the bill for the mistakes of their leaders. That's what Mr. Barnier did. He massively increases taxation. He hits sick people, retired people. He hits everyone. And at the same time, once again, there's zero savings from the state. And that's inadmissible. Well, in any case, what I said, that the president's resignation is a personal decision on his behalf and can only take place, in my view, when a political crisis takes place or an institutional crisis can find no other solution than the resignation of the President of the Republic. It is not the case for the moment. What I do wish, on the other hand, because for sure there will be new legislative elections in the next few months, is that we work on a voting system by then that enables us to have a real majority, whatever that majority may be. But the country needs a majority. It can't live for months and years with 3 blocs, which in reality can't implement a policy.
French National Rally leader Marine Le Pen speaking exclusively with Bloomberg's Francine Lacqua in Paris. Let's get more in terms of the market reaction to the political crisis in France. Very pleased to say I'm joined now by Joyce Chang, Global Research Chair at JP Morgan. Joyce, fantastic to have you on the show. Let's start with France then, and we'll move on to the ECB, because of course the two are in some ways linked. What do you make of this call by Marine Le Pen, suggesting that we could get a budget over the line, possibly in the next couple of weeks, but she wants the targets around the deficit to be faded, pushed back? She thinks they're too aggressive right now. Would the markets accept that kind of budget shaped around a slightly easier push around the deficit target?
Yeah, I think she's made her red lines very clear, and we think it adds about maybe 0.4% of GDP to the deficit. So you're getting close to 6% of GDP for the deficit. 5% is just not going to happen. But she's made it very clear that some of the red lines are not increasing the electricity tax, not lowering the reimbursement on drugs. So 0.4% of GDP, I think the market can accept that. I mean, more importantly, they do see this as more idiosyncratic, specific French risk, not something that should necessarily mean contagion or to the rest of the region. So just the willingness to sort of not have an impasse on the budget. But I do think you're looking at 6% of GDP as the footing for this deficit. 5% is just not going to happen here.
Oh, really interesting. You think it's 6%, and the markets can broadly stomach that. Talking the market reaction, just in the short term. Yeah. Joyce, just in terms of the market reaction, we've seen these 6 straight days of gains for equities. You're well below 3%. But there's a lot of hand wringing around the spread versus German bonds, but you're well below 3% on the French 10-year. What do you make of that market reaction? Is that rational?
So I think that what the market is really looking at, were you going to have something that was really prolonged and uncertain? And it looks from what Le Pen is saying that you could have sort of a quicker resolution at a somewhat higher number, but not an astronomical number. So I think the market had already priced in that 5% was not going to happen. What the balance of those risks has, and this has been something the market's been watching since June. So it really hasn't impacted the rest of the region that much, just because of where expectations are right now. We do think also, the market is expecting, we are expecting that the ECB will ease, 50 basis points. When we look at just where the data is coming forth right now, we've pulled forward our forecast from January to December. And that's partly some of the disappointment with the consumer as well. So I think there's focus not just on what's happening in France, but what will the ECB be doing later.
Yeah, well, let's put a pin in that, because it's a big call. You're not alone, of course, but it's an important call. 50 basis points, a jumbo cut expected from the ECB in December. Joyce, what does that look like in terms of synchronization of cuts then into 2025 if you get that jumbo cut as you expect later this month?
Well, we think that the ECB will come down to 1.75% at the end, but there's more risk right now. Some of that's around the U.S. election risk, slowdown in growth, some disappointment on the consumer as well. So we did pull forward the call, and we think that you're going to continue to see the ECB having to move lower, and that's sort of the structure of risk, or more structural in nature for the ECB if you compare it to the Fed, for example. When you just look at some of the forces they're contending with, the dependency on trade with China, the slowdown, some of the disappointments on the growth numbers, as well. And I think inflation is coming back to target, so that they feel like they have the scope to move.
You've got a call on the S&P 500, 6,500, Joyce. What is the time frame for that target, and what gets us there?
So, that is our target for the end of the year next year. And I think that much of that is driven by where we are in the business cycle right now. I mean, the business cycle is performing pretty well. And when we look at the Magnificent Seven, we still see very sizable CapEx and R&D into the sector, 500 billion, in the order of $500 billion. I think there's an opportunity for small cap to play more of a catch up, more of a broadening of the rally that's in place. But the market is focused right now on deregulation, lower taxes, and trying to weigh that with the risk of tariffs and some of the policy uncertainty that could play out. But I think right now the focus is on the business cycle, deregulation, lower taxes, and continued CapEx and R&D investment that's going into the Mag 7 as well.
Joyce Chang, Global Research Chair at JP Morgan, thank you very much indeed. The deficit of France more likely to be 6% than 5% that Barnier had been pushing for next year. A 50 basis point cut expected from the ECB later this month. And the target on the S&P 500 of 6,500. A lot of that down to the CapEx spend expected from big tech. Always smart analysis across these markets globally. Joyce Chang of JP Morgan, thank you. Right, let's get you up to speed on what's happening in South Korea, because it's a volatile situation, of course, and lines continue to cross. Outside the National Assembly and inside the National Assembly, you're seeing lawmakers there and a gathering. We had expected the president to attend, but that appears to be not happening right now. The Korean National Assembly Speaker has asked the President Yoon to delay that trip to Parliament. The key events that have unfolded in the last 12 hours or so is that one of the key members, the leader of the president's own party, has suggested that he would back impeachment of the South Korean president, and the leader of that party, the People Power Party, the president's own party, Han Dong-hoon, saying that the president should be suspended from office quickly. And so if you get a lineup of that person's allies, Han Dong-hoon's allies within the leading power party, the People Power Party, which is the party that currently leads, along with the opposition party, then that does look like an impeachment is more likely for the president. So we keep across this story for you. Live pictures of the National Assembly in the South Korean capital there. Now, some other stories making news this Friday. Donald Trump says he's chosen venture capitalist David Sachs of Craft Ventures to serve as his AI and crypto czar. The newly created position underscores the US president-elect's intent to boost two rapidly developing industries. Trump also nominated former senator and businessman David Perdue as US ambassador to China. Perdue has lived in Hong Kong and Singapore, says he's looking forward to implementing Trump's strategy. New York police have released new photos showing the face of the alleged suspect in the fatal shooting of United Healthcare CEO Brian Thompson. Officers have offered $10,000 for tips to help identify and find the man. They also searched a youth hostel in Manhattan where the suspect allegedly checked in using a fake ID. People familiar with the investigation said the words delay and depose were written on a shell casing, and a live round recovered from the scene of the shooting. Antitrust regulators have approved Vodafone's £15 billion merger with Free to create Britain's largest telecoms operator by revenue. Both companies have committed to invest £11 billion in the UK's digital infrastructure. Vodafone Chief Executive Margherita Della Valle spoke to me after the deal's approval.
This is not about revenues. The rationale of the merger is to unlock investment, infrastructure investment. With the combination between Vodafone and Three, we unlock scale in our networks, which is what will allow us to build the biggest, the best network in the UK, reaching 99% of the UK population. That's what we do for a living. We want to invest. We want to invest to give a better service to our customers, and we want to invest to drive growth in our markets, which is where revenues come from. But the most important point for the financial setup of Vodafone is that all the markets in which Vodafone will operate next year, including the UK, will be growth markets where our own scale will allow us to drive growth with good returns.
Yeah, and you focused on that investment piece, £11 billion of investment. When does that investment start, Margherita, and how will you be financing it?
It starts as soon as we complete. We still have a few weeks to go as we go apply the final legal touches with the CMA and our partners. We will complete in H1 2025. And as soon as we complete, we will start investing, which is why, although typically big infrastructure projects take time, our customers will already see the benefit into next year of a bigger, better, broader network. In terms of funding, you know that the other activity we have done this year as part of the reshaping of Vodafone in Europe is to reshape our balance sheet. So we have all the funding we need to execute on our plan.
Specifically for Vodafone, as you look for those synergies, but also that investment, what does that do for headcount in the years ahead?
This is something we will be working on with our partners as soon as we are allowed to complete. In the grand scheme of things, think about it as small, as the impact of the merger. Of course, to give you an example, there will be duplication in the heads offices, but they have nothing in comparison to the investment plan that we have in mind.
Okay, Vodafone's CEO, Margherita Della Valle, speaking to me yesterday on the back of the announcement that that merger will be going ahead. It's been given the green light by regulators. Now, coming up, UK digital bank Zopa raises £68 million in funding as it prepares to launch a flagship current account next year and a Gen AI product. When we speak with the company's CEO next, this is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back. Now, as technology continues to advance, of course, and convenience drives customer preferences, digital banking has been on the rise. Zopa, a UK digital bank, has raised £68 million in fundraising from Maersk owner AP Moller Holding. Interestingly, this as Zopa looks to fuel its growth and ahead of its current account launch. Jaidev Janardana, CEO of Zopa Bank, joins me in the studio right now. Jaidev, thanks so much for coming. So you've raised this additional capital. You had a lot of investors seemingly knocking at the door, wanting to invest. How do you deploy this capital?
Well, we are a profitable bank that is growing and serving people in the UK. So for us, the capital is really about creating the regulatory capital required for growing the balance sheet of the bank. We, of course, are also, having started our journey from focusing on borrowings and savings, moving into everyday banking, launching current accounts, as well as investing further into Gen AI, particularly to simplify customers' financial interactions.
What does that Gen AI story look for you, specifically as a customer?
I mean, I think if you look at it, today we all interact with our banks on a little small digital rectangle with our fingers. That's not how it was supposed to be, right? We would like to talk to people. We would like to talk to banks. And I think our hypothesis is that Gen AI leads us beyond mobile banking back into voice banking. And we think, ironically, using AI, we can bring back some more warmth, some more humanity into banking and really simplify the banking interactions and the financial interactions that customers have and use it to help them make better choices.
What are your priorities then for expansion in the years ahead for Zopa? What does the bank look like in 2-3 years' time?
So we started focusing on borrowings and savings. I think there's a huge amount of growth there. We expect to grow those products by 30% plus over the next few years. On top of that, as you said, we are stepping into everyday banking. We believe current accounts in the UK, while customers have a lot of choice, there is very few places where they can get both the ease of a neobank and value. And particularly in today's interest rate environment, we do believe that customers deserve more value than they get from current accounts in the UK, and that's our focus going to be there.
You've got 1.3 million customers right now. What's the target by the end of 2025?
I think we'd like to be 1.8, hopefully cross 2, about that.
And revenue and profit targets for next year?
From a revenue standpoint, we should be crossing 300 million this year. Next year, to cross 400 million will be the target. We again, few days to go for the year, but we are expecting double profits from last year and again double again next year.
Okay, interesting. You talk about interest rates. The Bank of England is a little bit more reluctant to cut rates as quickly as maybe the ECB, certainly the Fed will see.
Yeah.
Is that good news or bad news for your business line?
I think we are reasonably well hedged from an interest rate standpoint, unlike many other banks, particularly because we have got a big lending book. That said, from a UK consumer standpoint, we definitely prefer that interest rates are cut sooner because we can see that particularly the resetting mortgages are putting pressure on consumers as they have to pay higher bills. Thus, a lower interest rate environment, I think, will be better for our customers, and what is better for our customers is better for us.
Do you see consolidation in the neobank space in the UK?
I do believe that there is some room for consolidation. A lot of us have built slightly complementary product sets, not just neobanks, but also fintechs. And if we really have to take on the incumbents and really make banking better and make the banking sector more efficient, then I think some of us joining forces can be for the better.
The choice sometimes is overwhelming. Monzo, Starling, you've got Zopa, of course.
Yes.
You've got Revolut.
Yeah.
There's a lot to choose from.
Yeah, it's great to have that competition.
Yeah.
But even today, that said, if I look at the markets we are playing in, lending and kind of savings, we're still competing with the big banks. They hold more than 85-90% share. So there's still more work to be done. And I think having the competition is helpful. And I think we just need to remain focused on the customer so that we can make a bigger change.
You are very much a UK-focused business, at least for now.
Yeah.
Does that mean when an IPO comes, when that timing comes, and I know it's difficult to put a pin in the date, but you would list in the UK, or is the UK not attractive yet?
I think the UK would be the natural place, given we are a UK business focused on UK customers, for us to list. We do not think, though, that the public markets are quite there yet, and definitely really not the IPO markets. So as and when that changes, we'll be ready.
Okay, thank you very much indeed. Appreciate you coming in on the back of that capital raise, £68 million for Zopa. Jaidev Janardana, the CEO of Zopa, on the back of that news. There's plenty more coming up. Stay with us. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
We seem to be edging closer to a place where the president of South Korea could be impeached, given that some lawmakers, key lawmakers within his own party, seem to be aligning to that view. What's volatility then around the Korean currency, the won? You can see that spike up there, and that volatility continues. Let's flip the board and have a look at what's happening in France, because arguably there's less volatility than you might have expected across French debt and French equities. But of course, Marine Le Pen, speaking exclusively to Bloomberg's Francine Lecoir, saying that a budget could be passed with the caveat that those deficit targets are moderated. Here's the picture when it comes to the deficit outlook for France and the overspend at the government level of France versus Germany. And these are the projections. 124% debt to GDP is the projection out to 2029, hence the need to get this under control, versus Germany's expected to drop just 58%. So that divergence is pronounced. And that is the problem at the heart of French politics right now. Let's flip the board and have a look at the key data point of the day, with expectations non-farm payrolls are going to come in possibly around the 200,000 level, 220,000. This is the number to watch, though, according to Mark Cranfield of MLive, 4.1% in terms of the unemployment rate. Does it come in higher than that forecast? That could adjust views around the Fed. 70% expectations around another cut from the Federal Reserve. This data point, though, of course, could change that. Later today, 10 a.m. UK time, we're going to speak with the German Finance Minister, Jörg Kukies. Listening to that, 10:40 a.m. UK time, we're going to speak exclusively with the Bank of England external member, Swati Dhingra. A crucial conversation if you want to get a clearer steer on where the BOE goes, above, of course, the NBC. A programme you note as well on Tuesday, Bloomberg Television will have live coverage of the inaugural Women, Money and Power event, convening the most influential female voices in finance from around the world to discuss consequential themes facing the future of business. The opening trade, though, is up next. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Emmanuel Macron vows to serve out his term as French president, promising to choose a new prime minister within days. Meanwhile, National Rally leader Marine Le Pen tells Bloomberg a budget will pass if the government narrows the deficit more slowly. More turmoil in South Korea. President Yoon's planned trip to the National Assembly is delayed as he loses a key ally ahead of an impeachment vote for treason. Meanwhile, Chinese stocks rise on stimulus bets, while US and European futures are mixed as investors globally wait for the US jobs data.
In the meantime, a quick check on these markets. You can see some of the futures positioning there a little bit lower, down about 0.4% in the Eurostoxx 500 futures. It is a big day in the U.S. data. You do have payrolls today, so we do have one eye on that 10-year yield, 4.17, unchanged at the moment, 4.16 we'll call it. But it feels like before we even get there, we have to talk about what's happening in both China and Korea. Of course, the stimulus story, not to mention the new ambassador pick out of the United States, 726 on that currency pair. And then, of course, the Korean won. Weaker today, elevated volatility. We're going to dive to the details in just a moment. The countdown to the opening trade starts right now.
En tout cas, ce que j'ai dit, c'est que la démission du président de la République.
What I said was that the president's resignation is a personal decision for him and can only take place, in my view, when a political crisis happens.
Le mandat que vous m'avez démocratiquement confié.
The term you democratically entrusted me with is for 5 years, and I will serve my duty until the end.
Good morning, Friday morning. Your day looks a little bit like this. Politics, then payrolls. Let's start with the politics and figure out what is happening with France. Marine Le Pen speaking exclusively to Bloomberg. That's interesting, in as much as what she said was basically, I can wait for Emmanuel Macron to not be president. And it's fascinating, Chrissy. I'm just sitting here wondering, what did Le Pen achieve, therefore?
I don't really know. Because it all depends on not just the 2027 elections and then, of course, the potential snap parliamentary elections in July of 2025. But it's the trial date that for her that really matters, March 31st. And if she's able, if that's a positive outcome, Anna, in terms of the kind of positive trial date, then she actually could be in the running for the presidential election. I just came back from Paris. The support she has on the ground is wild.
Yeah, the legal story is a real complexity, isn't it? And is it influencing how the key players are behaving right now ahead of all of that the legal decisions that we're not expected to get until the spring. Really fascinating to me the way the bond markets have responded to all of this. The calmness in the spread has been quite incredible, really. Is it because Macron says he's staying? Is it because Le Pen says she will pass a budget, just not Barnier's budget? I mean, we just have to, we'll see whether any budget is possible of passing. Or is it because actually the market's not quite so fixated on fiscal discipline as maybe we thought they were? Reading John Authors this morning got me wondering about the Stability and Growth Pact and the demands it puts on European nations at a time when we know that they need to spend more on defence, for example.
Or is it just a pause as we await the next acts in this story? It's from Le Pen's point of view, I think the legal story is really interesting.
Yeah.
If you thought that she could be president before that ban kicked in, then this would make sense, right? Yeah. I can become president. We're going to topple Macron. I'm going to become president, and therefore the legal case goes away. So she's kind of parked that by saying that she didn't want to do that. She doesn't necessarily want the withdrawal of Macron quickly. The budget story is interesting as well. She can't have the chaos go on for too long.
Yeah.
Because if she has the chaos going on for too long, it looks like she's caused it and she could potentially be blamed for it. So she needs the budget to be happening fairly quickly a budget to be passed fairly quickly on the back of this.
Yeah. The other piece of maybe analysis I'll add is that maybe spreads are closing because with this political chaos that we're going to get for 2 years and counting, as expected, is that if deficits is what created the spread widening, a austerity measure, a technocratic government basically, would close that deficit even more severely than Barnier expected. 4.8% is what Bloomberg Economics is expecting. That could just reverse some of the concerns.
Whereas a budget that Le Pen would agree to would not do that. So
Exactly.
we'll see. Yeah, we'll see whether we get that,
Yeah.
and whether that in fact ends up blowing out spreads a little more. But you've got some.
I
some
do. I
resources.
wanted to show everybody that basically the front headline of yesterday's newspaper. We had the story basically of Macron, of Barnier, Marine Le Pen is what made the headlines. But the second story there is South Korea, and I think that's where we go next because that story also continues into today. We're of course going to go live on location. We're getting headlines, of course, this morning. Some really interesting live pictures that we're going to show you in just a moment. Bloomberg's Sherry Ahn joins us from South Korea. Sherry, walk us through kind of what you're seeing, what's going on the ground.
Pretty, the political chaos continues here in Seoul. So this is the state of play right now. Opposition lawmakers blocking the entrance to the national parliament. There was speculation today that the president was heading to the National Assembly. We just heard from the South Korean presidential office saying that Yoon will not be visiting parliament. Lawmakers are still lining up with placards calling to impeach Yoon Suk-yeol. Now, what's happening right now is that there will be this impeachment vote. The opposition leaders calling for this to happen Saturday. They made the vote come quicker than what was expected at around 5 p.m. tomorrow. Will the ruling party head impeach the president? We started the morning thinking that he was going to oppose the impeachment. Then things changed when he released a statement saying that he was calling for Yoon Suk-yeol's power to be suspended, citing credible evidence that Yoon ordered the arrest of key politicians. This, of course, all related to that failed martial law decree. At this moment, the ruling party head, Han Dong-un, is giving a press conference, and he's explaining that he met with the president for less than an hour, but that there wasn't necessarily anything that could change the party line. And the party line being that they're going to oppose the impeachment of Yoon Suk-yeol. We're still up in the air about what will happen in the vote tomorrow. The fact remains that the opposition party needs 8 ruling lawmakers to vote in favor of this impeachment for the president to be removed. And then there's another long process that goes to the Constitutional Court. And then you need elections within 60 days.
All right, Sherry Ahn, of course, joining us on the ground right outside where I believe is the National Parliament in South Korea. And just to describe what you're actually seeing there, this is the outside of the parliamentary building. When we looked at the shot earlier, you actually tried to see basically blocked lawmakers holding signs, showing some of this. We'll see if some of that chaos at the moment, or just that shot looks like it's calmed down a little bit, but the chaos was certainly there just 30 short minutes ago.
So this is the atrium within the building. Previously, what you had was basically those two doors that you can see in the center of the shop being blocked by lawmakers. And they've now departed. They were originally standing up. There was a lot of chaos and tussling. They then sat down. So we're in a position now where it looks like the president is not going to be going to the National Assembly, and we'll watch how things progress throughout the morning. But it does seem to be calming down a little bit.
Absolutely. And really symbolic, isn't it? Because if your view of this situation, these are the pictures from earlier, if your view of this situation is that what this story tells us is that democracy is strong in Korea, and there was an attempt at martial law and a coup, and it's failed because these people stood up to it. And so that's why all of this imagery of what's happening on the ground and what the opposition party is doing and what some of the ruling party are doing in standing up to these rules, these calls for martial law, that's why it matters so much. There we go. There's the images from a little while earlier of those lawmakers standing in the way of President Yoon.
There was also, I did read also some speculation on the way in this morning that there may be a second attempt at martial law. That seems to have faded a little bit, but that was certainly one of the headlines that was floating around overnight, that this was a possibility. Let's turn attention to what is happening in China. Chinese equities have rallied a little bit today. We've now got to close on that, and we are watching very carefully what is going to be happening, because next week we've got the Central Economic Working Conference taking place, which is a grand title. Markets are hoping that we are going to see some sort of stimulus coming out of this. I went back July, September, and November. December, we had big events, set-piece events from China, all of which the market speculated would deliver significant stimulus, all of which didn't.
Right, indeed. I mean, yeah, that's the thing. We talked about this at the beginning of the week. When you're disappointed by one set-piece event in China, it's okay because there's another one you can pin your expectations and your hopes to. Will they deliver this time around? I mean, on the one hand, we heard from one guest yesterday, Stephen Orth, I think it was, yesterday, telling us they need to stimulate demand from the Chinese consumer, because if you've got all these cars / other consumer goods that you were planning to export around the world, and now it's going to be harder for you to do that, you're going to need to sell them to the Chinese consumer. That also helps your relationship with the United States. So that's the argument to do it. But on the other hand, if you're waiting for President Trump to come in and you're waiting to see which cards he plays, why would you play your cards first is another argument I could see being played.
Maybe we got an early indication of that in the last 24 hours. He's nominating David Perdue to be the U.S. ambassador to China amid a sea of hawks. David Perdue, perhaps not one. I kind of dig a little bit into his resume, his CV, if you will. He used to be at Sara Lee Corporation, which is a major bakery breads company, basically, over in the United States. He did the supply chain for that, out of Hong Kong and Shanghai. So basically anything that has to do with, say, the farm food deals, agricultural buying, this is something where he can add value. He was the CEO of Reebok, for example. This is something where he can add value. He was the CEO of Reebok, for example, consumer goods, and that exposure to China there as well. And then he was the head of the Georgia Ports Authority. Savannah is a major spot for kind of incoming
So he's
shipping.
steeped in trade. He's steeped in global trade, and he's somebody who has actually cautioned against moving into a period of distrust. I feel like maybe we're in a period of distrust already, but that's interesting language to come from the future ambassador.
Feels like the takeaway is not a hawk.
Yeah.
Because there seems to be lots of other hawks within the administration when it comes to China. What have we got coming up on the show? Let's walk you through the action. Vivek Paul, BlackRock Investment Institute Global Head of Portfolio Research, is going to be joining us. Kristen Sinding, the EQT CEO, joining us out of Zurich. Really interesting conversation there as well. Alec Rufiek, Rebecca, multi-asset portfolio manager, and Anne Applebaum, author, historian. How do you connect some of the dots, particularly in Europe at the moment? Globally, maybe you can fold Korea into this narrative as well. We're going to be talking about what is happening with the dictatorship story around the world and how maybe it is progressing or not progressing, and maybe there's some threads to pull there. What else are we watching? Jobs.
Yeah, it's payrolls day. It's payrolls Friday. And I feel like this morning there's just been so much news flow that it kind of got a little bit lost in the current there. The survey number about 220,000, the whisper number just shy of that 212. Remember last month we got only a 12,000 job increase. So that's one piece. We've got UMich sentiment and of course Fed speakers, but let's be real, jobs are going to take the cake today.
They are. I mean, yes, so last month was all about the hurricanes, took a digit off those numbers, didn't it? I mean, it certainly didn't give us a clean picture of what's going on. Bloomberg Economics, though, saying that even beneath that, there was weakness in last month's report, and they expect some of that to come through this time around. But they also cautioned that actually the CPI print next week, we get that in the middle of next week.
Piece of data.
There's always another piece of data about the same time as that Chinese conference. That's going to be key. How elevated that November CPI print is will dictate, in their view, just how aggressively the Fed moves in December, if it moves.
Do you ignore the last month? Do you ignore November? Do you basically ignore last month's prints and use October as the benchmark? And does that disappointing print condition traders to be more attuned to the downside, i.e., if you get an upside surprise, even a small one, the symmetry of the risk is that basically, therefore, you get a bigger reaction for a small upside surprise.
I was reading, I don't know if you were reading this as well. BMO does a survey of clients ahead of these payroll reports, and they were talking about different scenarios, the way bond markets might respond. Would you buy? Would you sell? And it was a very high percentage said that they would do nothing. And they put this down to the fact that it is, surprise, surprise, December, and there's not quite so many people paying attention. That seems to be what's going on right now.
I will say I did kind of admit the news flow to kind of slow down into the holidays. I feel like it's almost ramping up. I don't know. Maybe it'll be an exciting holiday season.
Usually is. All the times you think you're going to be nice and relaxing these days prove to be exactly the opposite. Maybe because there is light liquidity. What else you need to know this Friday morning? New York police have released new photos showing the face of the alleged suspect in the fatal shooting of the United Healthcare CEO, Brian Thompson. Officers have offered $10,000 for tips to help identify and find the man. They've also searched a youth hostel where the suspect allegedly checked in using a fake ID. People familiar with the investigation said the words delay and depose were written on the shell casings and live rounds recovered from the scene of the shooting. In corporate news, Aviva has reached a preliminary agreement to acquire Direct Line as the UK motor insurer finally succumbs to a suitor after fending off takeover interest since early this year. Aviva's offer represents a total consideration valued at 275 pence per Direct Line share. And back to the politics, Donald Trump says he has chosen venture capitalist David Sachs of Kraft Ventures to serve as his AI and crypto czar. The newly created position underscores the US president-elect's intent to boost two rapidly developing industries. How much more good news does the crypto market need right now? It keeps coming, but you did see quite a significant dip yesterday in Bitcoin. It's come back up again, but nevertheless, it does feel, the market feels a little bit jittery.
Does he have to keep appointing crypto-friendly people
How much more
to keep
good
it
news?
above 100,000?
Precisely.
How
Yeah.
many more of them are there, Chrissy? I don't know. AI and crypto, they're not the same thing, though, are they?
They're not the same
baffled me
thing,
slightly.
but I think you can look to Elon Musk to kind of create it under the Musk umbrella, if you will. But it does bring a key point of not just the appointees, but are things like a crypto reserve, for example, the idea that's been floated, even a realistic prospect?
We certainly heard Larry Summers suggesting that it's not necessary and would only benefit special interest groups. Let us tell you what is coming up on the programme. Then we are going to be talking about oil, of course, coming up. OPEC kicks the can down the road once again. We'll break down the latest decision from the Producers Alliance. Plus, we'll have more from our exclusive interview with the National Rally's Marine Le Pen. Up next, it's Jobs Day, but markets are digesting so much more. We'll dig deep into the details. We'll talk about France with our guests as well, of course. IB plus BBTV Go. That is the function on the Bloomberg terminal. If you want to get in touch with this team, a beautiful sunrise over London, preparing for bad weather this weekend ahead, though, I fear. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Who do you think holds the leverage right now? Employers or employees? It's more balanced than we've ever seen.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market weakness we saw in the summer was a head fake.
What raises this question, basically, has the narrative been set?
We are still in the throes of a strong labor market.
The November jobs report, today on Bloomberg.
There are probably respects in which crypto has been over-regulated by overzealous regulators. But some of what is being said, this idea that we should have some kind of national Bitcoin reserve, is crazy.
That's crazy. Is the price crazy? 97,918 right now. That's the price of Bitcoin. It has rallied very strongly since, obviously, we saw the election result coming through. That, of course, was former US Treasury Secretary Larry Summers speaking to Bloomberg about the Bitcoin story. Bitcoin's been on a tear. US stock markets have been on a tear. Outside of the United States, you've got all kinds of political problems. You look at what's happening in Korea, South Korea. You look at what's happening in France. You look at what's happening in China right now. Do you just keep investing in the United States? Vivek Paul, Global Head of Portfolio Research at BlackRock, joining us around the table this morning. Nice to see you.
Thanks.
Is that the narrative? Keep going, keep going, keep going. For how long?
So we are overweight in the US, and we've doubled down on that in our 2025 outlook. If you kind of look at the dynamics facing the US markets, where the US is placed with regards to some of these structural mega forces that are shaping the economy now, it is in a better position to handle those in the near run. Right? The idea of this AI transformation that is changing the way in which markets operate. You have some of the most important companies in the world with regards to that space in the US. We expect this to broaden out. That's why we continue to
Isn't that in the price already, though? I know all that.
Yeah. Well, so I think you're right that the prices have clearly kind of ramped up a long way, but I think using historical valuation measures and relying upon them alone, I think misses some of the bigger picture, right? We're in an environment where the nature of the US stock market itself has materially shifted over recent decades. Just take the Mag 7, for instance, where the idea that these companies were a small share of that broad stock market before, now they're a massive share of that stock market. You can't kind of compare apples to oranges. This is a different market now. It's more growthy. The valuation dynamic we should expect should be different on a go-forward basis. So I'm not saying that there's nothing to be taken from the valuation signals, but we need to also allow for the fact that the market itself is structurally transforming right now.
Okay, so it's more growthy. I like that. That's a new one on me. And you say in your notes that this is not a business cycle.
Yeah.
Such are the structural forces at work here and the geopolitical forces that is not a business cycle. So sort of the structural outweighs all the cyclical right now?
So it's not to say that the cyclical doesn't matter at all, but there's a real risk of applying a purely cyclical lens to what's going on right now. And I think we can miss big opportunities and big drivers, right? 2024 shows us that. You go back to 2024, the idea of an inverted yield curve inevitably sort of foreshadowing a recession, the idea of the SARM rule, the unemployment data inevitably foreshadowing a recession. That didn't occur because structural forces were dominating. And I think what we need to be aware of here is that if we put purely a cyclical playbook, we might actually take the wrong investment decisions right now.
Okay, and we're somewhere where we are seeing certainly not a cycle, but all kinds of structural forces at work is France. I got a note this morning from Barclays talking about the price action in France, suggesting a lot of bad news is already priced in. I mean, how do you respond to the sort of very calm nature of the market's response to really dramatic developments in Paris?
Yeah, I think if you think about the events of the last sort of 24 hours or so, in some ways there is no sort of new news there, right? I guess once we knew that there was likely to be this instability from earlier in the week, we've seen what was likely to occur. The bigger move in French spreads really happened towards the summer, and you sort of seen that. Obviously, they've continued to wide, but actually, if you look at the equity markets, this is kind of this idea of being in the price from the earlier question. It's been there for a while. We're seeing a valuation shortfall in Europe relative to the US, which is historically wide. But this goes to that point about sort of the structural dominating the cyclical. A cyclical interpretation could be that valuation gap is really wide, therefore it will inevitably kind of tighten, and therefore there's an opportunity there. That's not the story that we'd be telling right now. The structural dynamic is one that maybe the mean that we're reverting to is different from the one of the past. So there are opportunities in Europe, but I think they're much more selective than a broad story would suggest.
Do you need to factor in the China story more in Europe or more in the United States? Where does that show up?
Well, there are different dynamics here, right? So I guess, the direct sort of structural linkages between the economies, clearly that's been talked about between China and Europe for a while. The idea of, the sort of consumer dynamic, that is prevalent. But the China story with regards to the US is a broader one. It's one of tariffs. It's one of localized tariffs relative to global tariffs. And I think that, in the grand scheme of things, could arguably end up becoming an even bigger story for global markets. That's something that's very uncertain right now, and I think there's no obvious and immediate answer to that question. We'll learn as time goes on.
But by that logic, you are kind of using the Trump 1.0 roadmap, right? That Trump tweets, there's a tariff story, there's a ripple effect in the markets. But every time he's made a comment on China, on Mexico, for example, as an early start of what these next 4 years might bring, the market has been relatively complacent versus the reaction you saw 4 years ago.
Yeah.
Is that the norm?
I think it's because I think we have a better understanding of what the Trump policies might look like. We've had the experience of Donald Trump being president before. And I think this idea of inflationary pressures being a little bit more elevated, the idea of maybe the rates path coming down but staying at slightly higher levels than was anticipated in the past, markets have adjusted to that story. I don't know if they've adjusted all the way. I think there could be more developments yet to come. We do see long-dated US yields still have room to go up from the levels that they are at today. So I don't think everything is in the price, but I think to the point you made earlier, there's a playbook to some degree that we have experienced in the past, which is why some of that is in the price now.
Is AI a disruptive technology?
AI, absolutely. So
Okay, so absolutely. Why, therefore, should we assume that the current incumbents, the Mag 7, the companies that are doing well right now, will not be disrupted themselves? Because they look like the most obvious targets for the disruption in so many ways. Why should we assume that these epic valuations, high multiples that we're watching at the moment, can be maintained if disruption is coming?
So I think there's, in the AI story, I think it's important to think about the different phases of the build out, right? There's a phase 1 build out, there's a phase 2 build out, et cetera. And what I mean by that is, I think on that phase 1 story where there's a lot to do with hardware, there's an idea of incumbents having a sort of a power that is hard for others to replicate in the short run, right? So there is a reason why some of those companies which have already built up a really big presence could continue to outperform from here. But importantly to your point, as we get into phase 2, as it becomes about
when
adoption,
does phase 2 start?
Well, this is the big question. And I think this is part of the reason why, for us, we do see a broadening out in 2025 that is related to this story. I don't think that means that phase 1 finishes in 2025. Right. But I think this is a period where we can see overlapping phases occur.
All right, Vivek Paul joining us around the table this morning, Global Head of Portfolio Research over at the BlackRock Investment Institute. He's talking about the Trump story. We are, of course, seeing a little bit of movement here in these markets. You're looking at a 10-year yield that's flat right now, but a little bit of a bump on the front end of the curve when it comes to yield. 4.16 over in the States. Here in Europe, 105.73 on euro dollar. It feels like a lot of perhaps momentum is going to be coming out of headlines around the payroll story later today. Perhaps a little bit of a softer approach this morning, Guy, when it comes to the markets.
Absolutely, we're going to watch. Today is politics, then payrolls. Yeah. That seems to be basically what we're watching out for. We're going to try and factor all of this into our next conversation. What's the outlook for private equity, and does the political instability that we're seeing undermine it? Kristen Sindick, CEO of EQT. Next, this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to the program. It's Friday, 30 minutes to go until the start of the opening trade. This is the opening trade. Let's have a look at what the futures have in store for us. And not a great deal of movement expected this morning. Euro Stoxx 50 futures down 0.3%. US futures look decidedly undisturbed, unperturbed by any geopolitical news lines or otherwise this morning. We had some support for Chinese stocks through the Asia session, but that not filtering through particularly into expectations for Europe or indeed into the US. We have jobs data later on today, and that's going to be a key feature. Let's have a quick look at the bond markets. We've been watching the spread. We've been watching the yields in France actually ticking down a little bit and the spread coming down a little bit over the past week or so, which seems almost incongruous given the news flow, but maybe the markets have priced it all in. Seems to be a lot of what we were hearing from guests, but that's what we have on the markets right now here in Europe. So a little bit of buying just at the margins on European debt this morning. Now, in an exclusive interview, far-right leader Marine Le Pen told Bloomberg a budget can be passed in a matter of weeks if the next Prime Minister is willing to narrow the deficit more slowly.
Getting to 3% in 2029, I don't think is credible, but I'm not the only one. I don't think it's credible either to the president of the Cour des Comptes state auditor. Once again, these are simply promises, and they know very well that they can't keep to them. Mr. Barnier made that promise, and in reality, his budget worsened the deficit by 12 billion. So if we don't make significant, intelligent, structural savings with regard to the state, and if we don't put in place the conditions so that companies can work, invest without being suffocated with extra taxes, we won't get there. But with those two solutions, we can succeed as quickly as possible to get back to a reasonable deficit, even if the 3% was just decided on the back of an envelope.
How fast could that be?
Well, it's a matter of weeks. We'll discuss it with the new Prime Minister. We'll work together. We'll explain what our red lines are. Our red lines are we can't ask the French people to pay the bill for the mistakes of their leaders. That's what Mr. Barnier did. He massively increases taxation. He hits sick people, retired people. He hits everyone. And at the same time, once again, there's zero savings from the state, and that's inadmissible. Well, in any case, what I said, that the president's resignation is a personal decision on his behalf and can only take place, in my view, when a political crisis takes place or an institutional crisis can find no other solution than the resignation of the President of the Republic. It is not the case for the moment. What I do wish, on the other hand, because for sure there will be new legislative elections in the next few months, is that we work on a voting system by then that enables us to have a real majority, whatever that majority may be. But the country needs a majority. It can't live for months and years with three blocs, which in reality can't implement a policy.
The French National Rally leader, Marine Le Pen, speaking exclusively there to Francine Lacroix in Paris. So not pushing for Macron to resign, clearly looking ahead, though, to new legislative elections, new parliamentary elections. They can't come yet. They can't come until the summer, but that seems to be on her radar.
It does. And on the Macron side of this, I think it's interesting because he, with his whoever he chooses next, is going to be trying to create what's been called a pact of non-aggression, basically, and saying we need to peel off factions of the leftist coalition so that whenever we do put a caretaker government in, you have a better shot of it against Marine Le Pen. And that key piece is a socialist faction, but they're kind of hitching their wagon, for lack of a better term, to the far left. And that's the piece that he talked about in Parliament, that Gabrielle Attal is pushing for. We'll see how successful that is, though.
Still don't understand exactly what she achieved with this.
Yeah.
And that's what I'm trying to work through in my mind. Her voters clearly wanted her to do this. There was clear support that she should bring down the government. She's done that. But now what? And what was the objective ultimately, other than appeasing those voters? Don't know. If the period of chaos lasts a long time, there's huge risks for her in this, because she will be seen as being, rather than the socialists, potentially responsible for it. And ultimately, how does that play out in the elections, which are now likely to take place at some point next year? You've got to assume July.
Yeah, to what extent do the public attach blame for these developments to her, to Barnier, to Macron, to others? All of that very much still a live conversation. We'll continue to monitor all these developments in France, the political turmoil, of course. And it is with that political turmoil in France in mind that we go to our next conversation. This instability being added in Europe, businesses are having to make decisions about how to deploy their capital. A really interesting example of this, we're joined now by Christian Sinding, CEO of private equity firm EQT, making a big investment right now, not connected to France, but we put it in this political context because it's interesting to see business as usual being done. Christian, very good to see you. Thank you very much for coming to speak to us. So you've made this decision, this investment, Unis, an energy business, a battery energy storage system developer in Germany. I wonder how much political headlines distract you from the business of going about investing in Europe or not?
It's a great question, and it's obviously a very interesting time in the world right now, and particularly in Europe. Now, when we look at investing, we're a global firm. We invest in Europe, we invest in Asia, we invest in the United States. We try to find long-term secular themes in society. Behind those themes, we find investable sectors, and then within those, companies. So if you break it down from some of the macro challenges, political challenges, geopolitical challenges that we're seeing right now, we're still some really interesting opportunities, and those, which is an energy battery storage business in Germany that is not dependent on, it's not dependent on subsidies. It's not politically sensitive. It's just a trend in society that needs to be supported with capital and competence.
Okay, yes, you say it's not politically sensitive, but you do watch this politics and wonder where it goes next and how it plays out, Christian. I mean, clearly Europe is taking measures to tackle climate change. We do see some areas of rising nationalism, and that gets tied up with some pushback against that. And clearly in the United States, the tone being set by the US from January onwards could look very different in terms of transition. Does that not impact your enthusiasm, the timing of you setting up this transition infrastructure strategy?
Well, again, this is not a political type of decision that we do. We invest in the long-term trends, and at some point in time, fossil fuels will disappear in the world. That means that the world needs to decarbonize. The energy system is decarbonizing. The transportation system is decarbonizing. Look at Tesla, for example. The manufacturing system has to decarbonize. And as part of that decarbonization trend, which is going to take 20, 30, 40, 50 years, we probably need $200-300 trillion to drive that change. We want investing in that long-term trend. And the nice thing about private equity is that we can be long-term. We own companies for 5 to 10 years. And during that time, we try to accelerate and drive their change and transformation. So another way to say it is that we're not investing in kind of Europe's macro or the United States macro or the Asia's macro. We break it down and try to find companies where we can make an impact and drive transformation, and then ultimately deliver great returns to our investors.
Well, Christian, it's Creedy in London. Let's take a little bit of a step back here on this infrastructure theme, because it's not just an energy story. Some of the juiciest deals in private markets at the moment are in European infrastructure. You're seeing that with some of your peers as well. But how much of that extends to investment around things like data centers, things like electricity grids, as Europe, driven by the Draghi report, driven by these fiscal governments you're talking about, is trying to ramp up. Does that create a valuation glut or a valuation premium? How are you thinking about that?
Well, that's a great question, actually. I think that the valuation situation right now is complicated, and that gives us an opportunity to find companies that we can develop faster or better and provide capital to. So I'm not sure you could say that anything is undervalued or overvalued. It's very difficult to know at a single point in time. But if you look at the data center space, for example, that's the other mega trend in the world, of course, you know, the digitalization of the world. We own a very large data center company called it's growing in all the regions in the world. It needs billions of dollars every year to continue to expand. And to find those platforms and accelerate them is really the opportunity. And when there's, you know, political turmoil or capital markets turmoil, sellers of those assets are a little bit more keen to sell. So it gives us more opportunities to invest, actually. So we, in a strange way, we kind of like it when the markets are a little bit complicated, because that gives us an opportunity to think long term and find those assets that we can build.
Spoken like a true market maker. You made a key point, which is that ultimately you're positioning for the long term, 5 to 10 years down the road. But Christian, some of the sellers of those assets you just outlined are European governments. I'm looking at Maloney's government, for example, looking to offload some of their international stakes. You're seeing it in Germany. I'm sure you'll see it in France shortly, certainly in Spain. How are you thinking about kind of approaching some of those governments at a time when they're making big promises on infrastructure investment, but if you look at their budgets, they don't really have the money to deliver on it? Is that where private markets can step in, and with what speed?
This connects actually to the Draghi report, where Europe needs to improve our competitiveness at multiple levels, from capital markets to deregulation, to the digitalization of our societies, et cetera. What we'd like to do now is to engage more with governments, actually, both at the EU level, at the country level, and of course also in the US and Asia, to help drive capital, private capital, into this transition of society, whether it's on the energy transition side or on the digitalization side or wherever it may be. And I think we need to get better cooperation between the private markets or the business world and the political world. And I think that cooperation hasn't been that good for the last 5 or 10 years. So hopefully there's an opportunity also, with that Draghi report in mind and what's happening in the US in mind, to drive capital, to drive change. It's really needed for society. And that's what's interesting about infrastructure, is we're investing in companies and assets that are providing essential services to society. So that does have a real public service element to it as well, while at the same time, it's a quite interesting place to invest and drive returns. So we should be able to make that cooperation better. That's at least our hope.
Christian, good morning. Is it easier to buy assets than sell assets at the moment?
Yeah, excellent thought. It is easier to buy, I would say, because we still have a little bit of the cycle left where there were huge investments made in private markets as interest rates were very, very low, during and after the pandemic, almost a bubble happening, across the world in the financial markets. And some of those investments take time to get to their required returns in the private markets. And when there's political uncertainty and geopolitical uncertainty as well, families, corporates, et cetera, are maybe a little bit more careful. But we're seeing a shift. We're seeing a lot of activity this year. EQT's invested over 24 billion euros in equity in deals all across the world. That's a record. Our previous record was 21 billion. We've done more than 10 billion of exits. So the cycle is turning, and we're starting to look into 2025 to a more balanced market between buyers and sellers, and hopefully a very active time.
Okay, so at that point you start to see maybe the velocity within the space starting to pick up. Is that what we should be anticipating? And do the deals that get done now, how different are they to the deals that got done previously, just in terms of the spaces that you're looking at? If you look at the past vintages versus the current vintages, are you looking in different places in terms of where you're looking to deploy money where you were looking to deploy money previously. How big a shift, which sectors should we be looking at to kind of be left behind, and which ones are we going to see the greatest focus on going forward?
Yeah, I think the private markets have learned again that investing in cyclical assets or very, trend exposed or commodity exposed assets is very complicated. We don't do that. We're investing in these themes which are longer term. So we're a big investor in healthcare, one of the biggest investors in healthcare in the world, actually, in private markets. Big investor in technology, software, digitalization of the world, the energy transition, etc. And I think the markets are moving in that direction, the private markets are. And you can kind of see it in the deal flow. If you look at the deal flow this year, a lot of the transactions that happened in super high quality tech companies, super high quality infrastructure companies, excellent healthcare companies. We took Galderma public this year on the Zurich Stock Exchange, for example. So it's those sectors that are robust and that are not so politically exposed and not so cyclical that are there. And I think that's where we play the biggest role. At least that's what EQT does. We, of course, as an industry, invest in many different types of companies, but the hot ones now are those that I mentioned, and I think that's going to continue into next year, but then it'll open up into other sectors.
Christian, it's Kriti again. You mentioned key to two kind of hot button issues, which is high tech and high infrastructure, right? Those both kind of found a marriage in the likes of Northvolt, which has, of course, filed for bankruptcy in the United States. It feels like a little bit of a scare factor for a lot of your private equity peers. What are you and some of the folks you're talking to learning from the Northvolt story, given it had so much momentum to begin with as basically investing in the future? What did you learn?
Well, this is one of those industries that's super exposed globally, right? And we're not investing we never invested in Northvolt for many of our funds, even if we're based in Sweden. The reason for that is that there's so much global competition in the battery space. If you look at Korea, you look at China, and the volume and the competence that they have to compete in this industry, and this is really a CapEx competition. And I don't think it's going to be that easy for European companies to compete against the Asian companies in this space. So, you have to kind of bring it back and try to find out wherever our companies are based, whether they're based in Asia, Europe, or the US, where are they competing? Are you competing locally in infrastructure? Are you competing globally? If you're competing globally, do you have all the skills and all the competitive advantages that you need to win? And I think this has proven now, unfortunately, that Northvolt did not have that.
All right, Christian Sinding, the CEO of EQT, joining us this morning. We thank you so much for your time out of Zurich. Coming up on the program, UK insurer Aviva reaches a preliminary deal to buy Direct Line. We're going to get that in your stocks to watch next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve, chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deep into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's payroll day in America. Should we care? Joining us now, Markets Live Executive Editor Mark Cudmore. Mark, do you care?
Day traders should definitely care. From a macro point of view, no, I'm not really paying too much attention. This is not going to change the views for where the Fed is pricing into next year. I think we have too much policy uncertainty, and next year could still be a very binary situation. We've just got such a massive scope of outcomes. There are potentially a lot of inflation boosting policies coming through, but we have to see whether they actually get delivered, and we have to see what the full spectrum of policies that come through from the Trump administration. However, for short-term traders over the next couple of weeks, we've got a rate cut from the Fed that's about 70% priced in for less than 2 weeks away. And today's decision will either confirm that is happening or put more doubt around it. So therefore, it will affect rates at the front end. That means it'll affect the dollar. That means it'll affect stocks for a short term. So we'll kind of trade it today, this afternoon. We'll trade it into Monday. It's the kind of short-term trading that I always used to lose money on. So these are the kind of days that at 1:30 p.m. when it comes out in London, I'd go to the pub at 1 p.m. so I wouldn't lose more money and then assess it over the weekend instead. A much better situation.
Well, Mark, that actually might be valuable to our audience. With that context in mind, tell us what you would do.
Well, as I said, if I was able to, I would go to the pub. Fortunately, because I know that non-farm payrolls Friday like this, where it's about the short term rather than the macro, it's some of the most dangerous trading because you might have the short term conclusion. For example, we get a strong print and everyone goes, oh my God, there's going to be doubt in the Fed cut. They won't cut in December. Maybe we get high wage inflation. And so everyone goes, no, they're going to ease off. And you get that initial reaction, but then because of pricing, it can reverse very quickly. That's why I find these short-term Friday reactions are a different type of trading to the macro trading environment. So yes, today, to Guy's initial question, today really matters for some sector of the market, but for the macro audience, no, not really. They're still kind of processing France, which was kind of seen a pivot point this week. They're wondering what the next developments are in Korea. They're wondering whether Bitcoin has another leg. But I think many people are managing books into this stage.
Yes, really interesting. So thinking we are close to the year end then, really interesting the way that the politics has, and to a large extent, not moved risk appetite over the past week, Mark. Whether you look at Korea, you look at France, I'm looking at the MSCI Global Index, and we're much higher than we were at the start of the month, which given all of the political headlines, you might have thought might not be the case, but we seem to be able to put this aside.
Well, Korean stocks are even cheaper. They have had a long discount for they had a discount for a long while, but they're even cheaper. So Korean assets have an extra premium. I think it's going to stay for a while. I think French assets have underperformed all year. We know that actually the CAC 40 has done very well recently, but that's because it had massively underperformed. I think it's going to do okay in the short term. As we were saying in yesterday's show, I think that the outlook for France is not very positive, but this is not the time to pay the bearish scenario. I think next year there'll be a chance to refocus on French stress again.
Okay, thanks very much, Mark. Bloomberg Markets Live Executive Editor Mark Cudmore, of course. MLIV Go is the function to use on the terminal to get the team's analysis. Let's get the stocks that could be on the move. Joe Easton's here. Joe.
Morning, Anna. So Aviva has agreed to take over Direct Line, the insurance rival, for 275 pence a share. Now, the original bid was down at 250. We saw the stock rally on that news last week. And then yesterday, there were reports that it would come back up. And we've got that approved in terms of an agreement today. In terms of Aviva shares, could potentially be a little bit weaker given the concerns around the capital implications for that company. Then in terms of Holden Builders, a couple of pieces of news there. Firstly, we've got Barclay Group reporting pretty strong sales in the latest period, saying they've seen an uptick in some of their recent orders in the sector. Now, these shares slammed recently as UK rates rose following the budget here in the UK. Barclay nursing a loss of around 20%, as is the rest of the sector, and a lot of those stocks trading below book value at the moment. Then in terms of Puig over in the cosmetic space, the company has recalled one of its makeup sprays made by the Charlotte Tilbury brand, and analysts over at Citi saying that this will reduce the company's earnings for the year ahead, and they expect the stock to fall today on worries about this. Now, this was one of the biggest IPOs that we've had in Europe this year, and it's down around 20% since that Madrid listing. Keep an eye on that one today. Then finally, in ratings, we've got an upgrade from Moncler at Goldman in luxury. BMW is upgraded at Jefferies today, and Ørsted downgraded in utilities at Morgan Stanley. One to watch in Copenhagen later.
Joe, thank you for that. Our equities reporter, Joe Easton. Some individual stock names to watch. We are expecting a little bit of weakness at the start of trade today. US futures look flat to negative. Of course, we've got the jobs report. Will that set expectations for December? Will we find ourselves waiting for the inflation print next week? All of that still to come later in the trading day. The market open is next. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Friday morning, good morning. Yes, it's Friday. Let's talk about the Thursday session, though. To start with, yesterday we saw European equities rallying into the close. We then get a fade in the US session. Maybe that's why futures are ticking a little bit lower this morning here in Europe. We're only down by a little bit. We're watching, of course, what is happening with the politics. The politics is going to maybe be the story this morning, but of course, payrolls will be the story this afternoon. Critty, what are you seeing? A little bit of red, maybe.
A little bit of red. If you're looking for that Friday feeling, look elsewhere. You're not seeing it in the futures picture. Your Stocks 50 futures are down about 0.2%. The FTSE 100 on its heels. CAC 50 futures, 40, they are unchanged at the moment. They were marginally positive just a moment ago, Anna. If it does indeed somehow turn into the green and end close in positive territory, I'm told it will be the longest winning streak in 3 years for the CAC 40. We'll see if we get there, Anna.
Yeah, absolutely. That will be incredible, juxtaposed against the politics. Let's have a look at some of the individual stocks we're focused on. Direct Line could be will be in focus, as Aviva has reached a preliminary agreement to acquire this business. 275 pence a share is the price on the table right now, values the company at £3.6 billion, and the stock closed at 236, so we should expect to see a bit of a pop higher there. Citi says that Puig shares are likely to fall today after the company said it's voluntarily withdrawing selective batches of its Charlotte Tilbury airbrush flawless setting spray due to quality issues. So we'll certainly keep an eye on that one. Is that something that would be big enough to move the stock? We will see. Let us focus in on the housing sector in the UK as well, because Berkeley's saying that there is traction in the UK planning system amid reforms. That links to the politics of yesterday, of course, and they say they're on track to deliver their profit guidance for 25 and 26, Guy.
Halifax house data this morning a little higher. Skincare matters. Two things you need to know. Let's talk about this market open. Let's figure out what is happening here. Let's watch the numbers and come through and see what we're getting. FTSE 100 really struggling to gain a little bit of traction this morning. I think we've got a bit to wait for as we work our way through the day. We've got to watch what happens with that payroll number. IBEX is down a little bit. So again, not a great deal of movement up front for the European session. The 600 is up by less than 1/10 of 1%. To Critty's point, we'll see what happens with the CAC Caron today. Does the relief kind of story that maybe we're seeing in markets in France continue today? We'll watch that one very carefully. You've seen disappointing German data as well. Keep an eye on the industrial story. What is happening there may signal a recession potentially for Germany. The CAC is open. It's up a little bit. We wait for the DAX. We wait for the SMI. What's going on below the surface? Let's find out what that story looks like, Critty.
Well, Guy, you are seeing green on the screen when it comes to the French story, at least in terms of index contributors. Your biggest index contributor to the upside this morning is actually Airbus, followed by several other French stocks. I'm looking at L'Oreal, I'm looking at LVMH, among several others. They're your top 3 index contributors, Anna, this morning. The rest of the market broadly lower.
Yes, and I'm intrigued by this Puig story. I was just looking at this, and consumer products and services broadly is going higher. But Puig brand's actually an area of weakness, down by 3.9%. This on the back of, and Citi calling this right, that this would weigh on the stock today after they voluntarily withdrew these selected batches of this setting spray. I didn't realize setting spray is such a big deal, but clearly the Citi analysts know more than I do about face products.
Your hair's clearly not as frizzy as mine and Guy's, obviously. I think Guy's the prime audience for this, right, Guy?
Skincare matters. Alex Steele always told me that. You got to take this stuff seriously.
Can I start with just saying hairspray and skincare are 2 different things?
Yeah, but this is an airbrush flawless setting spray, so I'm assuming this goes on your face.
Oh, fair enough.
There you go. We're learning new things here this morning. Back to the markets. I think it's fascinating that we are seeing French. So the more international businesses, think about Airbus. So Airbus is a company that manufactures largely in euros and sells in dollars. Aeroplanes are priced in dollars. This is a global business. Are we starting to see maybe the market looking at what the French situation tells us about the long-term trajectory of some of these businesses, and maybe it doesn't? And I think that's the narrative. We spoke earlier this week about babies and bathwater. Are we seeing maybe some of the babies being put back in the bathwater, and some of the winners globally? Airbus, I look at what it's doing at the moment, huge order backlog, Boeing in trouble. Maybe that's a business that actually has a non-French related narrative to it. And maybe that's why you're seeing maybe some of the interest coming back into those kinds of stocks. I can only speculate on that, but it feels logical.
It does feel logical. I will say, though, if we're looking for signs of stress, and this is a conversation we've had all week as we continue to look at the French stock market with the political overhang, as Anna had mentioned, continue to rally. There are signs of stress. You have to just look under the surface. So, for example, in today's trade, you are still looking at the banks, the French banks, becoming the underperformers. So perhaps that's the sector story that matters from here on out, to your point. Let's get another perspective here. Aliki Rufiak, multi-asset portfolio manager over at Rebecca, joins us around the table. Aliki, pleasure to have you on the program. Good morning. Walk us through perhaps your thoughts on the French story. We've seen so much underperformance in the CAC 40, and we've seen so much underperformance when it comes to that bond market. Is this the moment to kind of bottom feed or pick your winners, as Guy kind of mentioned? How do you think about it?
So to a certain extent, what we've already seen in the French market has been already priced in. The French stock market is trading at a discount relative to the European market. But also, if we take a little bit of a more long-term perspective, because at the moment, there is a lot of political uncertainty in Europe, not only in France, but the situation in Germany as well, with the strikes and elections coming up next year, is a cause for concern. So for now, I think a more cautious approach is warranted. However, looking a little bit further in 2025, there is significant upside potential for this market, and the reason being valuation. Valuation is pretty attractive, especially relative to the US. At the moment, Europe is trading at a significant discount of more than 40% relative to US equities, but we really need to see some catalysts playing out over the next year for this value to be unlocked.
Well, I think this is kind of a journalist's dream to say, and I think I'm going to jinx it as I say it, but I think the first 60 days of 2025, we're going to kind of know the two big headlines in this part of the world. It'll be, of course, the German federal election. I'll throw France in there in terms of European kind of political chaos. And then it's going to be what happens in Donald Trump's first days in office. I'm curious which of those things matters more for the European market in terms of trading, maybe first quarter 2025.
I think we're going to see a lot of volatility, which could potentially create buying opportunities during the first quarter. On the one front, what's are going to be the announcements in terms of the US, particularly on the tariffs front. This, to a certain extent, has been already priced in. So politically, if we see a result that would lead to stabilization in terms of the landscape in Germany, that would be a very strong catalyst for European assets to perform.
That's interesting. So maybe our focus should be maybe on Germany rather than all on France right now. Let me ask you about the dollar, though, because you talked about the Trump trades and what they mean. I know that you or the team that you work with has been talking about how the dollar does look overvalued and at risk. Do you see a catalyst for changing that, though?
The catalyst would be when asset markets are going to price in the relevant factors that are going to affect the global geopolitical landscape over the first quarter of the year. And what I mean by that is we're already expecting tax cuts in the US, but also tariffs. Deregulation is a big factor that is going to play out, and also immigration curbs. So once all these factors are priced in, and also once we have visibility in terms of the degree and timing of implementation, I think then we would see some moves on the dollar, particularly if it's more positive for other asset markets. We expect the dollar to weaken.
And is there anything then that picks the euro up? I mean, is that a catalyst for the euro as well?
That's quite an interesting question, because at the moment, the only conviction that we have within our tactical asset allocation outlook is getting exposure to the yen. That is a little bit a kind of outsider in terms of how the currency is reacting. We've seen recently, yesterday, it strengthened at the back of announcement of a rise in Japan wages. And there we also see in Japan a policy that is more towards hiking rates, and this would support potentially a stronger yen. However, having said that, we do look at the yen relative more to euro and the Swiss franc, where we find that there the funding costs are better at this point in time to capitalize on this opportunity.
What's going to outperform the S&P next year?
That's, I think, from a 1-year perspective, and as we've already written on our 1-year Robeco outlook, there are two areas where there is a lot of potential to unlock value. One is Europe, and the other one is emerging markets. And if I look at emerging markets as it stands now.
Yep. Do you think Europe's going to outperform the S&P next year? Is that possible? I can look at the numbers this year. The DAX has done relatively well, up 21%, and this is currency adjusted. This is not currency adjusted. The S&P is up 27%. If I currency adjust that, that's 32 and 21. Does that do I get a mean reversion in any of these stories? US outperformance this year, underperformance elsewhere. Do we see that gap closing?
I think, as I said previously, we need to see some catalysts for this value to be unlocked. And Europe, for example, if we see a reversal in terms of underspending trend that has been going on in Europe, and this is going to be a very significant catalyst. So what we're looking there is improvement in consumer sentiment, but also improvement in consumer spending, which is currently lagging the real wage growth. So the picture there is more constructive, but we need to see the catalyst happening. The other point to mention in Europe is currently the saving rates is at post-COVID high. So we have 20% saving ratio. So if we start to see saving rates going down, this would also be a beneficiary to consumer spending. And I think what the market doesn't expect, events like, for example, a truce between Ukraine and Russia could be another catalyst that would lead to Europe outperformance.
So, Aliki, to Guy's point, Europe has outperformed the United States in very small, short periods of cyclicality, right? When you start to see the cyclical part of the expansionary cycle, that's when Europe outperforms. So I'm curious what you need to get there. What signs do you need from Europe to get there? You mentioned the consumer savings rate. Is it something that could show up in the data? Do you need hiring? What to you signals the start of a expansionary cycle in Europe?
I think what would make consumers spend more is a more stable environment. So we talked about politics. Politics at the moment induce a lot of uncertainty. And on the other side, we are seeing a lot of weakness on the manufacturing sector. So if those two themes, we see improvement going into 2025, I think then sentiment is likely to improve and would support consumer spending.
Aliki, great to see you. Thank you very much indeed for joining us this Friday morning. Very nice. Aliki Rufiak, Robeco, multi-asset portfolio manager. Let's take a look at what the core six looks like this morning. This is the picture we find ourselves with in Europe. Lots of red to the right of the screen. Ferrari, ASML, Schneider, Nestle, all seeing losses. But it was interesting, as Critty was pointing out, you are seeing some of the big French names this morning, maybe outperforming a little bit. Schneider's an exception, but LVMH is up. Airbus is having a really solid session. Are we starting to maybe become a little bit more selective in the stocks that we're watching in France? Let's check some of the other individual names, figure out what is happening there. Joe, over to you.
So we are seeing a big drop in Puig, the owner of Charlotte Tilbury, over in Madrid. Now, remember, the company has said that they are withdrawing one of their makeup sprays due to a quality issue. They say there is no health concern, but that is the biggest decliner on the entire stocks Europe 600 today, and also the biggest drop for the shares in 3 months. Now, this stock IPO'd at 24.50 back in May. We're down to 18.35. It's already down about 25% since that IPO. One of the biggest IPOs in Europe this year, and really hit hard by that Charlotte Tilbury withdrawal for Puig over in Madrid today. Then in terms of the insurers, we've got some upside as expected in Direct Line. Now the latest bid at 275, so we're still around 20 pence or so below where it is priced in terms of that agreed deal. Potentially a bit of execution risk on that one, but the stock coming up almost 8%. Aviva holding pretty steady in terms of the acquiring company holding firm at the moment. Then in terms of Barclay Group, now the sales looked okay, but we're still coming back down. We also had the Halifax data that Guy mentioned as well. That looked pretty solid, around a 1% gain in the latest month, but still not seeing too much of a boost on that. Potentially more to read into that statement on there. Then in terms of the athletic leisure stocks, Lululemon was up 9% in the US yesterday, citing strength in mostly its international business. The US looked a little bit weak in terms of some of their sales. We're seeing a little bit of a gain in Puma today, up almost 1%, but the rest of them pretty steady at the moment. Then in terms of rating changes, the big one in luxury was Goldman saying they like Moncler. This has actually been one of the better performers in the sector, and Goldman thinks there's still value in this stock. There was a speculation around Burberry. That kind of seems to have faded away in terms of reports on a potential deal there. And finally, BMW, a second buy this week after UBS upgraded it. Now Jefferies switches preference. They go from BMW to BMW from Mercedes, preferring BMW due to its cash flow outlook. And that one is up 0.9% in Germany this morning.
Okay, Joe, thank you. Joe Easton with the movers. And the CAC 40 is outperforming a little bit, but nothing's moving all that much this morning, is it? I mean, we've got the CAC up 0.2%, the FTSE 100 entirely flat, US futures, you really can't see much movement there. We do see, whether it proves to be a big event or not, payrolls is on the horizon, and that could matter for December, as Mark was telling us earlier.
Can you tell it's Friday?
Yeah, so what I guess the question you have to ask then if you are looking at this short-term story, what gets squeezed around this? I guess is the question that we should probably ask ourselves.
Around payrolls.
Yeah, what are we out of position on in terms of a strong number? What pushes us higher? You look at the whisper number, you're potentially going higher.
And it doesn't seem as if the market is betting on loads and loads of rate cuts, and that's really underpinning the market narrative at the moment. So even if we got a terrible number and it changed expectations, or even, if we got a really good one and it changed expectations about the number of cuts we get, it doesn't feel like that is top of mind for investors as we go into 2025. Yes, it's there in the backstory, but what President-elect Trump does next seems to be a bigger question.
Yeah, and I think your point about the numbers is crucial here in that if you look at the months prior to the 12,000, it's like 135, 156. 220, does the math work here that 220 is the estimate? Do you just divide that in two to account for both months? Like, is that how you think about it? I don't know.
Going back to Mark's point, you whatever you want, you will generally see. So what does the market want from this number? Because that will be the narrative that ultimately comes out of it. Is the initial narrative the right one? Normally not. So you've got to figure that one out as well.
That's why you go to the pub, you said.
That's why you go to the pub.
To consider
which is generally a good piece of advice anyway. And then you think about what the positioning setup is. The dollar's quite strong right now. Is that where you therefore potentially get the euro moving around quite a lot on the back of this number?
He is geographically well positioned for this strategy, isn't he, being in Singapore? Coming up on the programme, we'll get back to some of the global politics. South Korea's president cancels a visit to Parliament after opposition lawmakers, they planned to block him from the building. We saw them lining up to do that a little bit earlier on. We'll be live in Seoul with the latest. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power and 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back. Watching the opening trade. We are 18 minutes into the European equity market session. Generally, most markets this morning are going nowhere in a hurry. The exception appears to be actually the CAC 40, where we're actually seeing some action this morning. You've got that market up by 0.3%. What is also interesting is that volume is significantly higher in the CAC 40 than it is in most other markets, which are actually a little soft today as we await the payroll number coming a little bit later on. So a little bit of activity this Friday as maybe the situation begins to stabilize in France. Political instability is certainly a theme in France at the moment. It's also a theme in South Korea, where the country's president, Yoon Suk-yeol, has cancelled a visit to parliament, where he faces impeachment proceedings for a failed attempt to impose martial law. There are reports that opposition lawmakers are planning to block Yoon from entering the building. We saw evidence of that a little bit earlier on. Bloomberg Sherry Ann joins us now from the National Assembly. Sherry, walk us through the latest. What does it look like now?
Perhaps a good idea not to come to the National Assembly, given what you can see happening behind me. Safety concerns are rampant right now. We have dozens of protesters out in force. You have crowds just extending behind me, demanding the resignation of President Yoon Suk-yeol. I have a demonstrator right now with me, who's in fact a part of a small opposition party. Let me ask her why she's out today. 오늘 어떤 목표로 나오셨어요?
국민에게 총을 들이댄 윤석열이 체포하기 위해서 나왔습니다.
We want to arrest President Yoon Suk-yeol, who's actually put a gun to the citizens' heads here in South Korea. 언제까지 계실 거예요? Until when will you be here?
윤석열 탄핵될 때까지 멈추지 않고 여기 있을 겁니다.
She will not stop. She will continue to come here every day until he is impeached. 탄핵이 안 된다면, if he's not impeached?
그럴 일은 없습니다. 반드시 탄핵될 거고 윤석열 체포될 때까지 우리 국민들은 싸울 겁니다. 국민이 반드시 이깁니다.
That will not happen. He will be impeached and the citizens will win this battle, especially when it comes to arresting him as well. Thank you so much for being with us. These demonstrations can grow really fast, you guys, because remember the last president that was impeached was back in 2016, facing a crowd of thousands that grew into more than 2 million in just a matter of months. We do have that impeachment vote slated for tomorrow. Whether the ruling party will oppose that impeachment bill is a big question. The ruling party leader has already said that he wants the president to be suspended.
Sherry, a fascinating conversation there. Walk us through the ripple effects here. We know that Yoon's government, Yoon's administration has been one that's been crucial to the defense story in Southeast Asia. Walk us through the ripple effects of this potentially new administration that may come in and what that means for South Korea's relationship with the rest of the world.
the ripple effect will be huge, because right now we have a conservative Yoon Suk-yeol administration who's had a friendlier relationship with Japan and really worked through that trilateral cooperation with the Biden administration in order to push back against not only the likes of China, but also North Korea. If we do get a new administration, especially coming from the opposition leader, Lee Jae-myung, who I spoke to yesterday, he was saying that he was going to do everything that he could. It was just a matter of time that President Yoon Suk-yeol gets impeached. He sounded more dovish when it comes to relations with North Korea, that if not provoked, that things would remain the same. When it comes to Japan, he talked about how meetings just for the sake of meetings are not good. So we will have to wait and see what happens. But right now, the crucial test is what happens on Saturday on that impeachment vote. The opposition parties only need 8 ruling lawmakers to change their vote and actually pass the impeachment bill. If the impeachment bill is passed, it goes to the Constitutional Court. And then if the Constitutional Court upheld that impeachment motion, then an election needs to be triggered within 60 days.
And Sherry, what is the role of the defense ministry, the military at this point? We saw headlines earlier saying that the defense ministry has suspended duties of some officials, and there seem to be questions now about whether some military officials are able to leave the country.
Yes, we have heard reports of the defense ministry now suspending duties of some commanders involved in the operations after the martial law was declared. We have seen a new defense minister being appointed by President Yoon Suk-yeol already. That would be South Korea's ambassador to Saudi Arabia. This, of course, as there are allegations now of treason against the defense minister, safety minister, and President Yoon Suk-yeol now facing these allegations that will be investigated thoroughly. Right now, authorities are trying to move. We are still trying to figure out what the next steps will be in terms of who runs the country. But what remains clear is that if President Yoon Suk-yeol's duties are suspended, or if he gets impeached, then a caretaker administration would take over, and that would be led by Prime Minister Han Duck-soo. He is a veteran. He has served in that role of Prime Minister before under a president that was also impeached. President Yoon Suk-yeol is the 3rd South Korean president to be impeached.
Sherry, thank you very much for joining us. Bloomberg's Sherry Ann in Seoul with the latest there. From Seoul, let's go to the Middle East. The oil beat needs our attention as well. Oil has steadied after OPEC Plus decided to push back the revival of shutter production by another 3 months. The decision failed to lift sentiment in a market that's expected to suffer from a glut next year. Let's bring in Bloomberg's Jumana Basecha in Dubai. This was widely anticipated. OPEC Plus was expected to make this decision then, Jumana. What takeaways from it?
Yeah, well, as you say, there wasn't that much of an impact on the market because there was an expectation in the market that OPEC Plus would once again delay the decision to start putting back oil barrels to the market, which doesn't seem ready to digest extra barrels. So the impression from the market here is that they have just decided once again to kick the can down the road. And what we found out yesterday is instead of actually bringing back that 2.2 million barrels per day to the market over 12 months from April of next year, they're going to do it over 18 months as well. So a lot more gradual putback. And really, this is a reflection of very weak market fundamentals here coming from some of the downside to demand that exists. Several think tanks, including the IA and even the OPEC group themselves, have downgraded their estimates for demand growth over 2025 several times this year. And what that means is there still is a supply imbalance. According to our own numbers, Bloomberg Economics estimate that that supply glut amounts to about 1 million barrels per day. So if you take into consideration some of the weakness of demand that's coming through from China, plus the potential for further non-OPEC supply to hit the market, what you are seeing here is very clearly OPEC's hands are tied. And many people are saying that even once we get to the closer to the next decision, which is again in Q1 of next year, they may once again decide to delay given some of the headwinds that the oil market is facing here.
Jumana, thank you very much indeed. Bloomberg Horizons anchor Jumana Basecha updating us on what is happening with the oil market, which is interesting considering what we're about to get from the Trump administration as well, and America, potentially even more oil coming onto the market at a time when the market really doesn't need it. OPEC between a rock and a hard place.
Yeah, absolutely. So, well, you know that Trump is a big fan of the oil industry, and drill, baby, drill has been that mantra, hasn't it? And so the extent to which that adds to the glut concerns next year is something we watch closely.
At the same time that the economic sentiment may be slowing as well. We're talking about the U.S. consumer resilience. What happens if we start to see evidence of that fade?
We're going to pull some of the politics threads in just a moment and figure out what is happening. Tests on democracy certainly seems to be a narrative at the moment. Pulitzer Prize winning historian Anne Applebaum joining the dots for us next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young Black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. We're about 30 minutes into today's session, seeing some very marginal moves everywhere except for the French markets. That's where you're seeing some notable outperformance. The CAC 40 higher by 0.4%, even in the face of some of the political tensions we've seen, of course, across the week. It seems like France going into potentially a technocratic government. The market's not really batting an eye. CAC 40 higher by 0.4%, again, in the face of that political overhang.
Yeah, we saw a lot of stocks getting thrown out, babies being thrown out with bathwater earlier on this week. And maybe we're trying to kind of figure out what we do next. Names like Airbus, L'Oreal doing better as maybe the market reassesses some of the risks around some of those names. It has, though, been, to Crudy's point, a week of geopolitical shocks. We've been watching what's been happening in France, but you've seen this lightning advance by Syrian opposition fighters. You've got martial law potentially being declared or not declared in South Korea. You've got anti-government protests in Georgia. This coming Sunday, you've got elections in Romania. Keep an eye on that story. You definitely want to keep an eye on that story because potentially this threatens another country pivoting towards Russia. is there a link? Can I make a connection? Is this a pre-Trump era in which this chaos is beginning to manifest itself? Or are these just unrelated events? I think a lot of people are trying to figure that question out as we go into this weekend. Let's try and get some answers for you. Anne Applebaum, author of Autocracy Inc., The Dictators That Want to Run the World, joins us now from Poland. Anne, good morning. There's a lot going on.
Good morning.
Are these unrelated events? Are these related events? Is there a theme that I can draw between the geopolitical tensions that I'm seeing in so many parts of the world right now?
I think there's some of them are related, and there are themes that you can see. One of them is the theme of Russian influence and Russian attempt to persuade parts of the former Soviet Empire, parts of the Soviet bloc, to realign with them against the United States, against Europe, against the democratic world. And so their efforts in Georgia, the Georgian ruling party is closely aligned with Russia, has just declared that it will end Georgia's plan to join the European Union. The massive protests you've seen on the street are disappointed Georgians who wanted their country to go in a different direction. You see something similar happening in Romania, where a candidate whose popularity surged after enormous amounts of money were secretly invested on his behalf on TikTok, which is, of course, a Chinese-owned app. The money is thought to come from Russia, helped to boost his campaign. He's also somebody who would take Romania in a different direction, maybe away from NATO, maybe away from supporting the Ukrainian effort to repel Russian invasion. So you can see in quite a lot of countries the Russian attempt to package its influence and to spread its influence continues. I mean, in Syria, of course, you have something the opposite. You see an armed group with backing from outsiders also pushing back against the Russian-Iranian-backed regime there. So, in a way, that's the forces of what I've called in my book Autocracy Inc., the countries who are seeking to help one another maintain dictatorships. You see them, under attack.
History sometimes provides a useful template to understand current situations, and I'm wondering if there's a period in history that stands out as maybe an indication of kind of what we're going through and therefore what we may go through in the future. A lot of people I'm talking to at the moment are drawing parallels with the 1930s or with the 1970s. And the question that maybe comes out of that is, are we going to end up seeing a sort of Neville Chamberlain situation where we end up appeasing a dictator, or are we going to end up seeing a kind of Ronald Reagan where we end up pushing back a dictator? What do you think happens next?
So first of all, I mean, be careful with historical analogies. Nothing is precise. But it is true that we see a group of countries with very different ideologies actually beginning to work together in the way that perhaps the Axis worked together in the 1930s. It's a little bit different from the 1970s. But yes, the challenges facing the democratic world are the same. I think we've heard pretty clearly from Donald Trump that he doesn't see himself as a leader of the democratic world. He's not going to pull the democracies together in order to fight back against kleptocracy or to push back against, Russian disinformation on the internet. I mean, those are tasks that will have to be taken over by Europeans or by the Asian democracies or others who want to protect their integrity and protect their sovereignty. Trump is also at this stage still a kind of, there's a question mark about what he'll do. He hasn't given us yet a plan what he'll do about Ukraine. We don't really know what his attitude towards China will be. So I think there are a lot of, there's a lot of open questions. But the main point being that he doesn't see himself as somebody who's the leader of a large group of allies. And I think other countries would do well to listen to that. He's been saying it throughout the campaign. He said it during his previous presidency. It's important that people listen to that and take on board the lessons from that.
And it's Creedy in London. Let's talk about one of those allies in particular that's dealing with a bit of political chaos. And that, of course, is South Korea. We know that South Korea and the United States had a little bit of a tenuous relationship in Trump 1.0. now with this new chaos and the concerns around the defense associated with that part of the world, specifically against North Korea, and of course what that means for the war in Ukraine, how are you thinking about it? What does the ripple effect of the Yoon administration in South Korea mean for a Trump 2.0?
Actually, what was really impressive about South Korea, and what has been noticed in a lot of countries, including this one, I'm in Poland today, is the speed with which the South Korean political system reacted to the declaration of martial law, the way in which the opposition parties, but also the public, consolidated to push back against it because they cared about democracy and wanted to save it. And that has, that will have an effect on others. I mean, people have noticed that, there remains a country that cares enough to keep Democrats in power. I mean, how it will affect, Trump's attitude to South Korea, which he's been in the past skeptical of the U.S.'s role as South Korea's protector. He's talked about the high cost of U.S. troops there. Is hard for me to say. Probably it won't. Again, I would repeat what I said a few seconds ago. I mean, he doesn't see himself as the leader of a big international democratic alliance. He thinks allies are burdens. And so whatever kind of government South Korea has, I think understanding that, not being misled, not living in some kind of fantasy. It's important to listen to what Trump is saying and be prepared for perhaps a different kind of different kind of relationship with America. That's more important than the question of who is the president right now.
In terms of South Korea's role, that trilateral cooperation in the South China Sea, does this have a ripple effect there in terms of kind of that growth story or that kind of fighting Chinese aggression in the sea? What does that look like?
I mean, actually, the South Korean stand in favor of democracy, I think, is a great example for that part of the world and for the broader ideological argument against China, if that's the right way to put it. I hope the Japanese were watching. I hope that others in the region, the Philippines and so on, were watching as the South Koreans defended their system, because there is going to be a lot of pressure on democracies. I mean, there is already. The degree to which they can pull together and stick together based on shared values will help them a lot. I mean, of course, there are strategic reasons why Japan and South Korea and others should be allied, but having something shared as well, having a sense of values, a sense of the importance of liberal democracy to share, I think is potentially could strengthen that alliance.
And take us to Romania, if you could. And we're looking at the prospect of a NATO skeptic, somebody who's spoken very favorably of President Putin, potentially becoming the president of that country. We'll wait for the final round of the elections. And you've been through some of the allegations about how he was supported in the first round by Russia via TikTok. What does that mean for Europe? What does that mean for NATO if this member of both is run by somebody of that ilk, given what we've already seen in Hungary?
So first of all, let's give the Romanian people a chance to vote in their election and not, jump ahead and assume that we know who the winner will be. Yes, obviously, it's of huge concern if Romania were to drop out of the alliance to help Ukraine. Romania's just geographically, it has a border with Ukraine. It's very important for Ukraine's defense of itself in the Black Sea. Romania has been one of the routes that the Ukrainians have used to ship grain and other goods, outside of the country during the war. And maintaining Romania as a solid part of the alliance is very important. Remember also that Romania is a country that has a president and separately a prime minister. It looks like right now the prime minister will remain somebody who is in favor of Romania's role in the European Union and in NATO. So it might be a little bit more complicated than just Romania disappearing from the club or becoming Hungary. I mean, the president will not have full control over the country or over its politics. Clearly the amount of interest and money and attention that Russia has paid to this campaign, the investment in this candidate shows how much Russia cares about the unity of Europe and the unity of NATO, and how much Obviously it's easier for Russia to win this war by picking off political allies of Ukraine rather than winning on the battlefield. So,
right. And thinking about Ukraine, and I wanted to go there next. I mean, you talked earlier on about how under a Trump presidency, it would be up to Europe to push back against Putin if that's what Europe wants to do. Are you anticipating that Europe will have an independent foreign policy stance when it comes to Russia, separate from what we hear from the White House?
I mean, I don't think anybody wants it to be separate. And as I said, we just don't know yet what Trump's policy is. And I wouldn't, again, prejudge that either. It's pretty clear that inside Europe, there is now there's almost a NATO within NATO, the Scandinavian countries, the Baltic states, Poland, maybe the UK. There's a group of countries who do understand both the security risks and the internal risks Putin victory would pose to their countries and to the stability of their countries, remembering that Russia has been, involved in sabotage all across Europe in recent days. There have been underwater cables that have been cut. There have been buildings that have exploded. There have been assassinations all over Europe in recent days and weeks and months. And there is now a group of countries who understand why that's important and willing to work together. And I think you'll hear more from them, and you'll see pretty clear efforts from that kind of inner NATO, which may eventually include Germany after its election, might eventually include France and others as well. But you'll certainly see them pulling together to make sure that there isn't a collapse or a catastrophe in Ukraine, which, by the way, I should say, it seems as if Trump doesn't want either. The one thing we know about him that he's been saying in phone calls with foreign leaders is that he doesn't want there to be a collapse. What that means in terms of what a negotiating strategy would look like, of course, we don't really know.
Anne, thank you very much. Thanks for joining us. Anne Applebaum, author of Autocracy, Inc., The Dictators Who Want to Run the World. Thank you very much for joining us to discuss, many geographies and where we're seeing those tensions. I should tell you on a programming note, at 10 a.m. UK time, we'll have a conversation with the German Finance Minister, Jörg Cookies. And later, 10:40 a.m. UK time, we will speak exclusively with the Bank of England MPC member, Swati Dhingra. So a host of different topics under the microscope, from German politics, German economics, to what happens at the Bank of England.
And then I believe next we go to France as well. Still ahead on this program, more from Bloomberg's exclusive interview with Marine Le Pen, including if she has any plans to meet with U.S. President-elect Donald Trump on his visit to Paris. We're going to get to that next. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big. 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Welcome back. You're watching the opening trade, 47 minutes into the equity market session. This is what the narrative looks like. Generally, nothing happening except in France, where actually you're seeing some outperformance this morning as maybe some of the names that got thrown out earlier on this week on the political tensions start to recover a little bit. Maybe names like L'Oreal and Airbus tracking a little bit higher. In terms of what comes up throughout the rest of the day, there is but one event. We're moving from the politics of the payrolls. Yes, we've got University of Michigan data, which I think is quite interesting. And it'll be fascinating to see what happens there. You've got a few Fed speakers, but it is payrolls day today. And I've got the charts up in front of me of the Whisper number, which has been creeping higher over the last few days. So the survey number is 220. The Whisper number is now up to 217. Is the market set up for an upside outperformance or a downside outperformance? And just in terms of the way that we're going to manage that, if you do see an upside number, does the market kind of react more than a downside number? And I suspect it may be a little bit of the latter. I wonder whether you get a euro squeeze with the downside print today.
Well, I think the point that's been made on this program time and time again is that it comes down to Fed expectations, right? But it's the
for December.
For December, sure, but it's the in terms of like the 10-year yield, for example, and the 2-year, which you're already, by the way, seeing bumps early or ahead of in the session, 416 on that 2-year. But then I think it also comes down to the margin of the beat, right? Because if it's 220,000 is the survey number, that's a massive number. So if you were to get something substantially bigger than that, or even meet expectations, that is still significantly higher.
Do I just instantly discount it then go, yeah, we're just recovering from last month? Is this a real number?
Well, yeah, well, I wonder how much people really are fixated on the estimate this time around, given that last month was such a different story. It was all hurricane related. I mean, what was it, 12,000, Critty? It was something, it wasn't normal in any sense. And so will there be just no noise in this number? I find it hard to believe that you kind of turn your back so quickly. And the US labor market moves fast, but does it turn its back so quickly in all that chaos of the last month?
We've also had the conversation that maybe it's not the payrolls number that matters anymore.
Yeah,
maybe it is still the inflation numbers that matter more, which is a real turnaround from what we've seen in the last couple of months. Right.
Yeah, Bloomberg Economics saying that'll be the number to watch. That's next week, middle of next week.
Always feels like next week, doesn't it?
Just when you're watching that Chinese briefing about growth, you'll also have to focus on the inflation number out of the United States.
Can I not just get ready for Christmas? Shouldn't that be maybe
yes, is your tree up?
Doing?
And that's what traders are doing, according to BMO survey of clients. Everyone's just getting ready for the festivities. 65% said they're going to do nothing, no matter what happens with the payrolls.
I am putting the tree up this weekend. Rest assured,
You are literally 6 days late.
We have gone prematurely to our plans for the weekend. Let us focus in on the hard news agenda, though, of this week, and there's been plenty of it coming through to us, much of it across the channel. Far-right leader Marine Le Pen has told Bloomberg in an exclusive interview that France can overcome government collapse and deliver a budget in a matter of weeks. But that's if the next prime minister is prepared to narrow the deficit more slowly.
Getting to 3% in 2029, I don't think it's credible, but I'm not the only one. I don't think it's credible either to the president of the Cour des Comptes. Once again, these are simply promises, and they know very well they can't keep to them. Mr. Barnier made this promise, and in reality, his budget worsened the deficit by 12 billion. So if we don't make significant, intelligent structural savings with regard to the state, and if we don't put in place the conditions so that companies can work, invest without being suffocated with extra taxes, we won't get there. But with these two solutions, we can succeed as quickly as possible to get back to a reasonable deficit, even if the 3% was just decided on the back of an envelope.
How fast could that be?
Well, it's a matter of a few weeks. We'll discuss it with the new Prime Minister. We'll work together. We'll explain what our red lines are. Our red lines are we can't ask the French people to pay the bill for the mistakes of their leaders. That's what Mr. Barnier did. He massively increases taxes, he hits sick people, retired people, he hits everyone. And at the same time, once again, there's zero savings from the state. That's inadmissible.
Meanwhile, French President Emmanuel Macron says he will serve out the remainder of his presidential term as he seeks to put an end to the political turmoil in the country.
C'est pourquoi je nommerai dans les prochains jours un Premier ministre.
This is why I will appoint a new prime minister in the coming days. I will ask them to form a government for the general interest, representing every political force within the spectrum of parties destined to govern, and that they could join or at least agree not to bring it down. The Prime Minister will consult and form a more effective government at your service. Its priority will be the budget.
Let's bring in Bloomberg's anchor of the Pulse, Francine Lacroix. And Francine, good morning. You've been in Paris recently. You conducted that interview with Marine Le Pen. You have to wonder, she's giving very calming messages to markets, isn't she? She's saying, yeah, there is a budget I could approve. It just wasn't that one. It wasn't the one Michel Barnier had. It'll be one that doesn't do the fiscal hard work as quickly as he'd planned. Now I guess we just wait and see. Is there really a budget that they can coalesce around?
Yeah, so this is the million-dollar question. So I came back actually on the same Eurostar with Kriti yesterday, and we, breaking news, the Eurostar was not late. So that's one thing that we can put on the positive side. I mean, the negative side is that there's going to be a lot of volatility over the next couple of months. And you're right, Anna. Look, Marine Le Pen has been at pains over the last 4, 5, 6 years after a pretty disastrous debate 6 years ago, where she was seen as, pushing out some crazy ideas on Europe, some crazy ideas on the markets, as much more mainstream. So she wants to say, she'll fight with you if you say she's far right. She says, no, I'm center right. I am, someone who's reliable, which is also why she's not asked Emmanuel Macron to resign. So all of her conversation when it comes to budget and deficit was trying to reassure the markets, whilst at the same time saying, look, we don't want tax hikes, especially not for companies, because that's her base. She wants the companies to be on her side. Let's see who's a prime minister and actually what that prime minister comes with in terms of budget. It's unclear to me whether there will be a lot of chaos in the next couple of months or whether she can keep it calm.
Yeah. Well, Fran, as we were taking the Eurostar together, you saw me kind of cram all the newspapers from yesterday, and I was shocked that on all the front pages, it wasn't Macron, it wasn't Barnier, it was Le Pen. And I think it builds on Anna's question, what is she actually saying is the solution? I haven't heard any policy ideas from her that could be kind of the antidote to some of the things that she's kind of shutting down.
Yes, again, I mean, Marine Le Pen in France really represents something. Her father was seen as one of probably the most racist right-wing politicians. And she, throughout the last 15 to 20 years, has tried to change that image, again, to be more calming or a more calming source. So the fact that she now holds the cards, not only to, help with the next prime minister, but that she has 11 million people, let's remember, that voted for her party back in July, means that she's front page news because she could possibly be closer to the presidency. Now, two caveats for that is that Emmanuel Macron stays in power until 2027, unless he resigns, and he made it very clear yesterday that he would not resign. And then she has a bit of judicial trouble, and so we'll know around the 31st of March whether she can actually run for president next time or not.
Why does she not want to bring Macron down? That's the bit I don't understand.
Because she wants to be seen actually as respecting the institutions. And I think that goes back to like her family. She brought the government because she says it wasn't a good budget. But the institutions, so she has to, I think, tread a very careful line in not being blamed for chaos. Now, we're not seeing chaos in the markets. And because of her past and because of her father's past, she wants to say, well, the Constitution doesn't say the president should resign, so I'm not asking him to resign.
So she needs a budget quickly, because if there's no budget for a long time, then chaos may ensue and she may end up taking the blame.
Again, so I think that's a good question. It was unclear what her intentions were. I think she says she doesn't want chaos, and she certainly doesn't want chaos that she will be blamed for.
Yes.
Whether she wants, Emmanuel Macron to stay on, no. Whether, chaos would help her, it probably would, as long as she's not blamed for it. So it's kind of like a treading line. This is like politics at its finest.
Sticking with Paris, Guy.
Notre Dame this weekend.
On to the weekend, yes. It is reopening.
Yeah. And guess who shows up?
Yes.
The main show, as always.
You would have thought the reopening would be the main show, but it's going to be Donald Trump, isn't it?
Yeah, so first of all, we have had a look inside. It's beautiful. And this was going to be the big centerpiece for Emmanuel Macron. Like, look at, what we've done 5 years after that fire that really shocked France. Donald Trump is showing up for his first overseas travel since he became president.
And Marine Le Pen might bump into him.
Yeah, so I was surprised. We tried to, we thought she had better ties with him or stronger ties, but it kind of reminded me, Macron did something quite special with Trump last time around.
Yes.
He wowed him.
It was very showy, wasn't it?
I think there was a romantic dinner with Melania Trump at the bottom of the Eiffel Tower that Trump and family liked.
Donald Trump quite like the military processions around the Arc de Triomphe as well. I'm putting the Christmas tree up this weekend. You've also got the final Eras Tour concert.
What is the global economy going to do next? Is my question around the Eras Tour.
Without Swifties.
That is definitely crucial.
Yeah, crucial. We should get a programming note on Tuesday. The opening trade will be live for Bloomberg's inaugural Woman, Money, and Power event. We're convening the most influential female voices in finance. Discuss the biggest themes facing the future of business. Do not miss that. We'll, of course, be on location. This is Bloomberg.
Everything you need to get the edge at the end of the market day. Big Tech. The countdown is on. Everything you need to get the edge at the end of the market day.
Big Tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
More turmoil in South Korea. President Yoon's planned trip to the National Assembly is delayed as he loses a key ally ahead of an impeachment vote for treason. Emmanuel Macron vows to serve out his term as French president, promising a new prime minister within days. Meanwhile, National Rally leader Marine Le Pen tells us a budget will pass if the government narrows the deficit more slowly.
Well, it's a matter of a few weeks. We'll discuss it with the new prime minister. We'll work together.
Plus, after a bullish day for Chinese shares, investors await U.S. jobs data due out later today. So let's take a quick look
at the European markets map, but I'm not going to lie. All of the action will probably be in the U.S. after that jobs data. We also have a couple of stories saying that everything is winding down. I don't see any winding down, but maybe traders are taking a bit more time off as they get ready for the holiday season. The FTSE you see down 0.2%. The CAC 40 and the FTSE MIB again in between 0.5 and 1%. The DAX 2% higher. And then we'll bring you the very latest on what's happening, of course, with S&P futures, but also the U.S. 10-year yield 4.1818. Let's see whether U.S. jobs data actually feeds into Fed expectations for the month of December. Euro dollar 105.82. We've seen a pretty stable euro dollar in the last couple of weeks, despite all of the political turmoil in France, and then Brent crude 71.74. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, South Korea's president, Yoon Suk-yeol, has cancelled a visit to parliament where he faces impeachment proceedings for a failed attempt to impose martial law. Now, there were reports that opposition lawmakers were planning to block Yoon from entering the building. All of this, of course, comes ahead of a parliamentary vote on an impeachment motion against Yoon expected to take place by Saturday. Well, Bloomberg's Sherry Ann reports.
South Koreans are out in force, demanding President Yoon Suk-yeol's resignation. A former star prosecutor that played a key role in convicting former presidents of abuse of power, his government now is on the verge of collapse. South Korea has had a painful and bloody path to democracy, something that these people are trying to remind the public. Now, these crowds can grow really fast. The last president to be impeached, Park Geun-hye, faced demonstrations of a few thousand people in 2016 to crowds of more than 2 million in just a matter of months. That hit consumer confidence, which sank consumer spending. The economy is now much weaker. So authorities right now are trying to calm markets, convince investors that democracy remains healthy and that they remain committed to support the economy. Sherry Ann, Bloomberg, Seoul.
And we'll have more on the political turmoil in South Korea a little later. Now, the French President Emmanuel Macron says he will serve out the remainder of his presidential term as he seeks to put an end to the political turmoil in the country.
C'est pourquoi je nommerai dans les prochains jours un Premier ministre.
This is why I will appoint a new prime minister in the coming days. I will ask them to form a government for the general interest, representing every political force within the spectrum of parties destined to govern, and that they could join or at least agree not to bring it down. The prime minister will consult and form a more effective government at your service. Its priority will be the budget.
Meanwhile, far-right leader Marine Le Pen told Bloomberg in an exclusive interview that she believes the outgoing administration's plan to bring the budget gap to 3% of economic output by 2029 is not feasible.
Getting to 3% in 2029, I don't think it's credible, but I'm not the only one. I don't think it's credible either to the president of the Cour des Comptes state auditor. Once again, these are simply promises, and they know very well that they can't keep to them.
Now, for more, let's bring in Bloomberg's Paris bureau chief, Alan Katz. Alan, it's so good to see you. I mean, yesterday we were at the Marine Le Pen interview together. She said that, she would be expecting actually a new prime minister by end of year yesterday. Why is Emmanuel Macron taking longer than expected?
Hi, Francine. So, one, he normally takes longer than expected. It frequently happens in France to say, oh, something's coming today, in hours, or tonight, and it ends up taking quite a bit longer than that. So that's really par for the course for Macron. But I suppose the real reason is that he's meeting today with a variety of political leaders in trying to find this group of parties and politicians who can come together to form a stable government, at least for a short period of time. As you discussed with Marine Le Pen yesterday, there can't be elections in the near term in France, parliamentary elections. They have to wait at least until July of next year. So something has to happen because there is a 7-month period at least when you're stuck in France with the current situation. And so this morning, actually, Olivier Faure, who heads the Socialist Party, said on France Info Radio that he is open to compromises as long as they are mutual compromises. So there is a bit of movement at least. Now, that said, Macron and his party have in the past said that they wanted to reach out to the Socialist Party, and things have never worked out in terms of bringing them into some sort of grand centrist coalition to help govern France. And so I would be quite skeptical about whether or not this would actually achieve anything. But there at least there are discussions going on, if nothing else, and those discussions take time. So that's why it's taking longer. And I wouldn't expect there to be an announcement today.
So, Alan, I mean, it's going to be a big weekend, of course, for Emmanuel Macron, because he has to try and find a new government, a new prime minister. But he's also hosting 50 heads of state, Donald Trump, tomorrow at, of course, the reopening of Notre Dame. I mean, is that going to be awkward, or are we expecting news out of that?
So with Donald Trump, you never know. There's no sort of news expected from it. It's the point is supposed to be the grand opening of this great cathedral that's one of the best known churches in the world. And it was, as everyone knows, it was ravaged by a fire 5 years ago. There was a really compressed rebuilding time. And this is supposed to be the sort of the big party for its coming back, for its reopening. And that's really all it's supposed to be about. That said, with Donald Trump, really, you never know. He's coming, I would imagine, in part to sort of show his. He was actually, in all fairness, he was very quick back in 2019 to say what a disaster it was for this fire to have happened. He wants to show his sort of solidarity with Notre Dame. He was early on in his first term relatively friendly with Emmanuel Macron. Things just sort of disintegrated a bit later on in their term. But we will see if there is a real meeting between the two of them, and if there is something to come out between them in terms of sort of Franco-American relations and how Macron might work with Trump when Trump comes into office in January.
Alan, thanks so much, as always. It was really good actually doing that interview together. Paris Bureau Chief there, Alan Katz. Now we'll have more of our exclusive interview with Marine Le Pen, the leader of the national rally, a little bit later on in the show. Now let's dive into market reaction from the political crisis in France. We're now joined by Justina Lee from Bloomberg and Hannah Gooch-Peters, global equity investment analyst at Sanlam Investments. So thank you both for joining us. Hannah, I mean, it's kind of, when you look at bond yields, or actually when you look at the market reaction, they had a brief panic, but actually they're fine with France not having a prime minister right now.
Yeah, so the briefness of the reaction actually really surprised me. But then if you think about the weakness overall in both the French equity market and the European equity market this year, I think a lot of bad news has already been discounted in. I think that the European market and the French market, it's got those large constituents, and this year has really showed dangers of buying into expensive constituents like L'Oreal or LVMH, for example, when you've got a weakening fundamental backdrop. They've been very, very weak stocks this year.
Justina, I mean, do they also, is there, I guess what's priced in is possible ECB intervention were something to go wrong, or does that come later?
Right. I think what's kind of interesting is sort of for investors, they might even welcome a bit of, fiscal expansion. And I think that's kind of been a big theme for the area. They're also wondering if Germany is going to do a little bit more to support the economy. But kind of more broadly speaking, I mean, I think what a lot of investors are wondering going into next year is we've had another year of incredible U.S. exceptionalism. I think this is set to be the best kind of year relatively for U.S. stocks since 1997. And so at this point, the U.S. really is not the value play. But do you really see catalysts kind of in Europe to rotate out of that? And it's interesting that most strategists thinking about next year say not yet.
Yeah, Hannah, I mean, I guess the million-dollar question is what's an entry point? I mean, in France, but also Germany, we don't know what happens with the elections in February.
Yeah, of course. And I think what's really important is those fundamentals of the underlying businesses. And I think you have to go for companies that have both a valuation discount, but also a dependable earnings stream. And I think that just if you have a look at Europe versus the US, you touched on the US consumer, for example, strength. I just think that you've got more opportunity in the US. Yes, overall, the stock market is more expensive on a headline level, but I think that the US consumer is just in a much better place than Europe. And, not on a fundamental basis. I just think that's a much better place to go.
We're also, I mean, there's political turmoil in South Korea with many questions. I mean, we didn't really know what happened, even if there was martial law for the first couple of hours that we saw big market swings. Does that play out in the longer term in terms of investor perception on South Korea?
Yeah, I think that's the big question here. And I mean, we're already seeing some more of that volatility coming back with markets kind of speculating that maybe there'll be another martial law earlier today. And then we kind of saw the military deny that, and then markets kind of pair those losses. And I think, it's not just about the political instability. I think at the same time, South Korea is also facing the economic threat from, another Donald Trump term, given their heavy reliance on exports in the economy. And we're already seeing a lot of economies worried about a recession there. So I think it's both that and also kind of the political element. And I think it's going to be very difficult to kind of convince foreign investors that this is the market to get into.
Hannah, is there a read across, for what's happening in South Korea, or is it just, I don't know how invested, your clients want to be in South Korea right now?
Well, I think there could actually be a substantial opportunity in a company like Samsung, for example. It's been very, very weak this year, but I think there could be, more than 50% upside potentially in the name. It's trading on exceptionally cheap valuation. It's got a huge cash balance. Of course, it is the leader in memory market. So, if they can bring their products to market and they can, the sort of overhang, if you like, from all this turbulence and everything goes away, then there could be, real value in a company like that, especially versus what's a more expensive developed market on a headline level. This could actually really be an opportunity for investors while the news flow is bad.
Okay, thank you both. Bloomberg's Justina Lee and Hannah Gooch-Peters from Sanlam Investments both stay with us. Now, Lululemon has lifted its full-year outlook on strong sales overseas. The company now sees between $10.45 billion and $10.49 billion. It's pretty close in revenue for the current fiscal year. You can see pre-market getting some 9.5%. Maybe it's because I started doing yoga. I'm just kidding. But it is, as people are getting fitter across the world, I guess that helps with sales of Lululemon. Much more to come, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Still with us, Bloomberg's Justina Lee and Hannah Gooch-Peters from Sanlam Investments. What a week. So we've survived and we're Friday. But then actually there's a lot of U.S., the U.S. jobs report today is very interesting. It could probably change the dynamics of what the Fed does, Justina.
Yeah, I mean, economists are currently expecting 220,000 new jobs, which would be quite a big rebound from last month. But what's interesting is, last month, there were the hurricanes and there were the strikes. And so we got an unusually low number. And so it was kind of hard to read whether that was just a reflection of those idiosyncratic events, or it actually was already showing some underlying slowing in the job market. And so today we're going to get kind of, last month's numbers, but also revisions from the month before. And hopefully we'll see kind of that trend a bit more clearly and, weeks ahead of the Fed decision.
Yeah, Hannah, I mean, not my concern, but actually my question is that once Trump comes into power and there are tariffs and there could be immigrant deportations, it changes the dynamic of the U.S. economy. So how difficult is it for Jay Powell now to set policy in December?
I think that, so obviously he's looking to keep inflation steady, and they'll be looking very keenly at the jobs numbers. But I think just from an investment perspective, the news about Trump, we've seen anything geared towards small businesses, pro-business, is moved substantially. Companies like Intuit, say, for example, small business accounting software, Paychecks, payroll software for small businesses, all reflected a lot of optimism already.
Yeah.
I think that what we've got to do is focus on the strength in the U.S. consumer. So U.S. consumer stocks, again, performing very, very well. And I think that trend is set to continue regardless of actually what the Fed decision is in December.
So focus on a lot of the retailers. I mean, big tech, we're quite unclear about how they'll handle that.
So I think big tech is almost a law unto its own at the minute. These companies have exceptional balance sheets. A company like Nvidia, for example, doesn't care whether or not we've got a higher risk-free rate. It doesn't care whether the cost of debt goes up. So, I think there's almost like a flight to safety into those names. Of course, momentum trade is really, really gathering momentum, let's just say. I think there are actually a lot of opportunities outside of those big tech names. If we continue to look at names like not so much retailers, but more like, say, for example, Hilton, consumer stocks, even if we look at automatic data processing, of course, with the payroll numbers, but these are all companies that really do, they look at enrollment numbers, they look at the numbers of new employees that are coming in, and they, of course, get paid on that because they're offering that payroll accounting software for those businesses. So I think that if we look at companies with dependable earning streams, I think that that's a better place to be than, for example, just trying to guess which way this sort of decision is going to go and potentially going to areas of overvaluation.
I mean, and crypto was at 100,000, but again, it's quite unclear actually what kind of policy we'll get apart from, gold up, crypto up, and for the moment, stocks are holding high.
Yeah, I think, crypto partly reflects just the return of animal spirits all across markets. But also, I think it's probably safe to bet that, the new administration will be kind of a lot more supportive of the industry, especially if you contrast it with the hostility from Gary Gensler. I mean, overnight we got the news that, Trump has appointed David Sachs, the podcaster and venture capitalist, as the czar of AI and crypto. And I think, it's probably pretty safe to bet that he will be more supportive of crypto. But at the end of the day, it's all about speculative sentiment and whether the Trump administration is going to keep that up.
Hannah, what are you watching for in the next couple of weeks? I mean, animal spirits in the U.S. Is there anything else that could change your view on certain stocks that you're looking at?
I think, Francine, I'm welcoming any sort of volatility in the market. I think the important thing right now is to try and use opportunities. So far this year, when you have that narrowness in the market, there are opportunities to buy into companies at more reasonable value. China, I think, is really interesting. Of course, we've seen news on about stimulus in China again today. I think there's still very good upside in names that are very high quality that are focused on sort of China, like Yum China, for example, like Tencent, perhaps. So I think that one just has to be nimble. If you've got the ability to buy into quality names with durable, predictable earning streams at a reasonable valuation, I think that's where you have to put your focus. But these opportunities coming and going very quickly this year.
Hannah and Justina, thanks so much. Bloomberg's Justina Lee and Hannah Gooch-Peters, Sanlam Investment Global Equity Investment Analyst. Now, coming up, oil studies after OPEC Plus delays the revival of shuttered production. We take a look at market sentiment next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, oil steadied after OPEC Plus decided to push back the revival of shuttered production by another 3 months. Now, the decision actually failed to lift sentiment in the markets that expected to suffer from a glut next year. Let's bring in Bloomberg's Jumana Braseche in Dubai. Hi, Jumana. So what were the key takeaways from the OPEC meeting?
Yeah, well, Francine, this is the third time OPEC Plus have decided to delay their decision to start putting back those extra barrels to the market. And look, I mean, this is a reflection of market dynamics here and how much the price of oil has moved just since they came out with that initial announcement back in June that they were going to start gradually returning 2.2 million barrels per day over the course of 12 months. Since then, the oil price has dropped 18%. So a lot of headwinds facing the energy industry here, which prompted their latest decision to actually postpone it once again towards April of next year, and then gradually start putting back those oil barrels, not over the course of 12 months, but actually over the course of 18 months, so even more gradual. But I would say, Francine, the lack of reaction today in the oil market is pretty telling itself, because this market is still reflective of the fact that looking ahead into next year, you are looking at a supply glut, and that there's a mismatch between the amount of barrels that are anticipated to hit in terms of supply growth versus the forecast for demand growth. And herein lies the issue, which means invariably what OPEC are doing is they're just kicking the can down the road. But at some point, they will have to make difficult decisions in terms of how much market share do they want to lose versus maintaining price stability.
So what is, Jumana, the outlook for oil prices next year?
Well, it's interesting that you say that, Francine, because actually several analysts out there, including the likes of Morgan Stanley, have marginally put up their revisions, put up their forecasts for oil prices going into next year. They see prices averaging around $70 because of these adjustments that OPEC Plus have come to. They now see a mismatch or a supply glut of around 500,000 barrels per day. Before that, it was 800,000 barrels per day. So yes, there's small technical adjustments being made, but the big swing factor going into next year is going to be what happens to China demand. The demand signals coming from China have been weak. That has been the reason why OPEC and IEA, both of these groups, have revised down their outlook for demand growth going into next year. Add to that, you've got the possible return of the Trump administration. We know that he's very much focused on energy dominance. So all of those are factors contributing.
Jumana, thanks so much. Jumana Braseche there with the very latest on oil. Coming up, more from our exclusive interview with Marine Le Pen, the leader of the National Rally, on why she believes France could pass a budget within weeks after the government's collapse. This is Bloomberg.
In case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
From the beating heart, global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. These are your top stories. More turmoil in South Korea. President Yoon's planned trip to the National Assembly is cancelled as he loses a key ally ahead of an impeachment vote for treason. Emmanuel Macron vows to serve out his term as French president, promising a new prime minister within days. Meanwhile, National Rally leader Marine Le Pen tells us a budget will pass if the government narrows the deficit more slowly. Plus, a bullish day for Chinese shares. Investors await U.S. jobs data due out later today. So back to our top stories, and South Korea's president, Yoon Suk-yeol, has canceled a visit to parliament where he faces impeachment proceedings for a failed attempt to impose martial law. Now, there were reports that opposition lawmakers were planning to block Yoon from entering the building. For more on the story, let's bring in Bloomberg's Katya Dmitrieva. Katya, the scenes seem to be pretty chaotic right now. What do we know?
Yeah, the past few hours, really the past 48 hours have been incredibly chaotic in South Korea. And we know that things have changed even just today. You know, we had originally thought that impeaching the president would be done by Saturday evening. That was sort of the latest by law that they can have this vote. Unfortunately for the main opposition, the Democratic Party, what's happened instead is that the leader of Yoon's party said actually they'd be voting against any kind of motion. And then, of course, this morning, the latest is that the leader of Yoon's party said, in fact, new information had come to light and they would be looking to relieve Yoon of his duty. They didn't use the word impeach, but he did say that Yoon should be relieved of his duties. And that's because there was evidence, allegedly, that Yoon had called for the arrest of several members of government, which is against the law. And so that's sort of where we stand at the moment as we're seeing these scenes unfold.
I mean, Katya, to ask very bluntly, is this a president gone rogue, or are there competing forces politically?
That is such a good question. And I think a lot of people are trying to answer this exact question right now. And depending on the answer, if you're a policymaker in South Korea, depending on the answer, it will decide the fate of President Yoon and who might be president of the country. We know that by Saturday, there might be this vote to impeach the president. After that point, we'll see if they can get 8 members of his party to join that vote, because there is criticism of President Yoon, of course, not just from the public, from all these protests you're seeing, but also from analysts and from the opposition and members of his own party saying this was very clearly an attempt of the president to maintain power when his favorability ratings are now at a record low, and when he's being called on to be investigated by a number of people in the opposition. So that's definitely one side. Yoon's side, of course, is that he was trying to quash anti-South Korean or pro-North Korea elements in the government. So depending on where you sit on that debate will really decide how you vote, how policymakers vote as soon as Saturday.
It certainly will, Katya. Thank you so much for all of the great reporting there on the ground, Katya Dmitrieva. Now, that lawmakers will strike a deal on next year's budget sooner than expected. Far-right leader Marine Le Pen told us in an exclusive interview that a budget can be passed in a matter of weeks if the next prime minister is willing to narrow the deficit more slowly.
Getting to 3% in 2029, I don't think it's credible, but I'm not the only one. I don't think it's credible either to the president of the Cour des Comptes state auditor. Once again, these are simply promises, and they know very well that they can't keep to them. Mr. Barnier made that promise, and in reality, his budget worsened the deficit by 12 billion. So if we don't make significant, intelligent, structural savings with regard to the state, and if we don't put in place the conditions so that companies can work, invest without being suffocated with extra taxes, we won't get there. But with those two solutions, we can succeed as quickly as possible to get back to a reasonable deficit, even if the 3% was just decided on the back of an envelope.
How fast could that be?
Well, it's a matter of weeks. We'll discuss it with the new Prime Minister. We'll work together. We'll explain what our red lines are. Our red lines are we can't ask the French people to pay the bill for the mistakes of their leaders. That's what Mr. Barnier did. He massively increases taxation, he hits sick people, retired people, he hits everyone. And at the same time, once again, there's zero savings from the state, and that's inadmissible. Well, in any case, what I said, that the president's resignation is a personal decision on his behalf and can only take place, in my view, when a political crisis takes place or an institutional crisis can find no other solution than the resignation of the President of the Republic. It is not the case for the moment. What I do wish, on the other hand, because for sure there will be new legislative elections in the next few months, is that we work on a voting system by then that enables us to have a real majority, whatever that majority may be. But the country needs a majority. It can't live for months and years with three blocs, which in reality can't implement a policy.
Well, I also asked Marine Le Pen again why she will not ask President Macron to leave before his term ends in 2027 if she worries about severe market reactions in the short and medium term.
To ask him to resign would mean to disturb our institutions. Once again, it's his decision. Now, if there is a political crisis, an institutional crisis, and if he can no longer dissolve the assembly, if reshuffle serves no purpose, then the French constitution only leaves one other option, which is his resignation. But that wouldn't be a drama either. There would be new presidential elections. General de Gaulle, designed our institutions, and they are very solid. They are extremely solid. Everything's done to make sure that the life of the nation can carry on and not create disturbances that can't be dealt with. If he were to resign now, there would be new presidential elections and new legislative elections.
But are you worried about these crises then leading to severe market reactions?
No, because the reality is that what worries the markets is the economic situation in France. What worries the markets is the lack of perspective concerning reducing deficits. It's the absence of savings at the state level, the increase of taxation on companies that worries the markets. And in fact, you've seen the markets have remained extremely stable over the past few days since the announcement of the no confidence vote, and even after the no confidence vote. In reality, they had concerns at the moment of the dissolution in June. But for the moment, whether it's the spread between France and Germany, the rates, or the markets, but for the moment, whether it's the spread between France and Germany, the rates, or the markets, for the moment, everything is relatively calm. Because once again, they realize that anyway, there has to be at all cost another policy other than that envisaged by Mr. Barnier.
But the market is probably looking at the fact that the ECB is standing close and that there's a want from France of getting the deficit down pretty quickly.
Well, yes, but once again, there's a long way to go between wishes and reality. Mr. Barnier wanted to reduce the deficits. He's increased them by 12 billion. You see what I mean? So, once again, using a hammer to bash French people over the heads with taxes, when we're the country with the highest rate of taxation in Europe, is not the solution. But it's the only solution that French leaders have implemented for years. It doesn't work. Look at the situation we find ourselves in. So help companies, enable them to do business, reduce production tax, reduce the cost of energy, or at least reduce it to the same level as the cost of production in France. Those are things that will allow companies to develop and thus create employment.
Voilà, ça, ce sont des lignes qui vont permettre aux entreprises de se développer et donc de créer de l'emploi.
But Madame Le Pen, I mean, first of all, the Barnier actually proposal means that GDP would be the deficit of GDP would be 5% in 2025 compared to 6% this year. So it's going down.
Non, il augmentait de 12 milliards.
No, the deficit rose by 12 billion. The deficit rose by 12 billion. But you know, the head of Safran, which is a major company, has just given an interview. And what did the head of Safran say? He said Barnier's budget is a bad budget. So, in reality, the fact that it's last year's budget that's applied, however unfair it was socially, is actually rather good news for companies. There are a certain number of entrepreneurs in economic circles who are in fact pleased about the no-confidence motion because they consider Mr. Barnier's budget was worse than last year's budget, and that's saying something.
Well, I also spoke with Marine Le Pen about the reopening of Notre Dame Cathedral and Donald Trump's visit to Paris on Saturday.
Well, I won't meet with him, but maybe we'll bump into each other because I will indeed be there too, at the reopening of Notre Dame, which is a major event for us in France. I don't have any relationship with Donald Trump. I will have one, I hope, the day I become president of the Republic.
Well, Trump's visit to Paris marks his first trip overseas since the November election win and makes Macron the third foreign leader to meet with him since his victory. For more, Bloomberg's Kevin Whitelaw joins us from Brussels. Kevin, I mean, there's a lot going on. And then, of course, Donald Trump shows up in Paris tomorrow. How will Europe approach his visit?
Well, I mean, obviously, Europe is going to be looking for any clues they can find on what he's going to do on two big issues in his first couple days and weeks in office. And those are the U.S. support for Ukraine and then, what his plans are with regards to tariffs that he's threatened to impose on Europe. So, if you're Macron or if you're a number of other European leaders, you're looking to find ways to reach out to him, to try to show him that Europe's engaged and ready to listen and work with him and try to avoid some of the things they fear most. If you're, whether it's a few other leaders who are maybe more Trump allies, depending on who shows up, they may be trying to get his ear on a different set of things. So a lot at stake as they try to set the tone for what will be the first days of his administration next year.
So, Kevin, how is Emmanuel Macron going to deal with these two competing forces? So he needs to form a government, find a prime minister. He's under increasing pressure from voters in France, but he also had a special relationship with Donald Trump the first time around, so he still wants to wow and impress him.
Yes, and I do think he's got, at least with this moment in Notre Dame, it is a moment to, on some level, show him some pomp and ceremony of the kind of thing that Trump does enjoy. He's previously enjoyed some of the French pomp and circumstance with military parades and other things. But Donald Trump is a guy who responds to strength. This is probably the weakest Macron has ever been, with the collapse of his government and also about to have the EU clinch a trade deal with the Mercosur group in South America over his vehement objections. So on one level, he's got the trappings of all of the elegance and the grandeur of Notre Dame at a time where he just couldn't be more vulnerable. So it's going to be interesting to see whether Trump responds to the pump or sees through some and focuses on the weakness.
Kevin, Trump's picks David Sachs as White House AI and crypto czar, David Perdue as ambassador to China. What's your take?
Yeah, these are both interesting picks because after picking a number of harder line, people to fill key foreign policy and security positions, harder line on China. Picking David Perdue is a little bit of a middle ground pick, a businessman who's worked in Asia and has talked about the various reasons to want to continue to trade there. So I think on some level, I think China can look at that as maybe picking more of a businessman, the kind of person that can be talked to and that there's room to make deals with. On AI and crypto, David Sachs is a guy who is not a hardcore crypto guy. Trump has come in as a very strong booster of crypto, but I think what you're actually looking at in this situation is someone who may help lead a bit of a charge to put a legal framework around crypto, maybe a pro-crypto framework, but a legal framework, a regulatory one nonetheless. So that would likely be his job. At the same time, it's an advisory role. It's not sort of a full-time member of the administration. So we'll have to see exactly what that means about his influence in the White House down the line.
And thank you so much, Kevin Whitelaw there in Brussels. Now, coming up, two of Britain's largest insurers are set to merge as Direct Line has accepted a £3.6 billion takeover from Aviva. More on that next. And this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All they're looking for are clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Welcome back, everyone. Aviva has reached a preliminary agreement to acquire Direct Line as a UK motor insurer finally succumbs after fending off takeover interest since early this year. Now, the London-listed Aviva sweetened its bid to 275 pence per share. The cash and stock proposal valued Direct Line at £3.6 billion. Let's speak with Bloomberg's Aaron Kirchfeld, who, of course, runs the M&A team for us here. So you're always busy. You're always chasing deals, Aaron. I mean, why did they say yes finally?
Well, finally, after a lot of back and forth in terms of price, I think they got to the magic number, which was kind of 270 plus. They'd gone in initially at 250, then they bumped a couple days later to 261. And I think they were closing the bid-ask gap over time. And I think at the end of the day, Amanda Blank, the CEO of Aviva, really wanted this deal. She's gotten some credibility from her investors after reshaping the company. So I think she knew she could get the backing, even if she stretched the price to win over Direct Line and their board.
So what does this give her? I guess it's more online, kind of consumer-friendly?
Yes, more consumer. I think in particular, it gives her motor insurance. So this makes them, according to our analysis, the biggest motor insurer in the UK. Aviva is very life dependent, so this diversifies their revenue stream. And it also gets them a company that's been struggling a bit. Direct Line has been working on a turnaround, cutting some jobs. They missed the boat on comparison websites, et cetera. So I think she sees this as an opportunity to take a company that has a lot of potential, get it while it's turning around, and then get synergies, get growth, and diversify her portfolio.
I mean, Direct Line, I always think of the ads. I don't know whether that's a good or bad thing.
Yes, the ads and the jingle that you can never get out of your head. Absolutely right.
Thanks for that, Aaron. In terms of M&A, so we're 6 months into a Labour government. We haven't had a Labour government for the last 13 years in the country. Has it made difference to the animal spirits and whether companies want or need to buy each other?
Yeah, so I think there was some nervousness about when Labour was taking over, especially with the budget. Would that crimp M&A appetite in the UK? What we've seen so far is actually quite the different version. We've seen a lot of activity. The UK is way up, 80% plus year to date in terms of M&A, double the next European country in Germany. And with deals like this, like Direct Line, it's just more evidence that there is still appetite to do deals. And let's not forget, UK companies remain relatively cheap compared to their global peers. And what's an interesting trend on the flip side, as my colleague Ben Sent reported, is that we're seeing the most delistings of UK PLCs due to M&A in over a decade, which, on the one hand, you want to see M&A activity. On the other hand, you ask yourself, how much longer will there be enough UK companies, for equity investors, et cetera, in the country?
So interesting. Aaron, thank you so much. Aaron Kirchfeld there, who, of course, leads our deals team. If you have a tip, you can email directly Aaron and his team. Coming up, our interview with the Queen Maxima of the Netherlands on her role as UN ambassador for financial health. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Now, in her role as the UN Secretary General Special Advocate for Financial Health, Queen Maxima of the Netherlands has championed the development of financial services and policies to support ordinary people around the world. Well, she spoke to us about the importance of financial literacy and inclusion.
What we've actually realized is having access to financial service doesn't mean in and by itself that you become better at it. In the Netherlands, we have 99.7% of financial inclusion, and we do have 23% of the population that are struggling to making ends meet, struggling to save, struggling to manage their finances. In Kenya, for example, we've seen a very big jump of financial inclusion, but we also saw a lot of consumption credit by which a lot of households end up being over-indebted. So this issue of looking at the financial health, at the outcome, so it's financial inclusion for what, is extremely important. And yes, I think it's important to define financial health. What is financial health? It's not about how much income a person gets, but it's actually how do we help clients and citizens in managing four things. First of all, how do we help them manage the day-to-day finances? Make it to the end of the month, you get a lot of money 1 week, and then you don't get anything for some time, and they get a lot of bills. How do we help them bridge and budget, their monthly or the weekly, or even sometimes in India, daily? Number two, how do we help them to go for those long-term, goals they actually have? Buy a house, a mortgage, pension, being able to invest in your children's education, these long-term goals that, you can actually identify yourself with. The third one is the resilience part. How do we help people go into these, help themselves out of these shocks, health shock, job loss, climate change shocks, even small shocks, your car breaks down and this is the one that you actually use to go to your job. Do you have that money to actually go to the garage and pay? And the fourth one is the confidence you actually have to be able to manage that.
I mean, this partly is financial literacy. This is, of course, managing money. Are women disproportionately affected, or does it affect all places in society, depending on what country you're in?
Well, I think it affects in different places because the contexts are different. For example, in a country like Kenya, school fees are a big worry for families. So that would be the reason why people get indebted, or they try to get a credit. Whilst in Tanzania, it would actually be a health shock because the health system is not that well organized. So per country would be different. For example, here in the UK, 1 in 4 people in the UK cannot come up with £300 in case of an emergency. So this issue of actually having some emergency buffer, it's a very, very important issue.
Well, that was Queen Maxima of the Netherlands on the importance of financial health and inclusion. Now, in a few minutes, we'll be speaking with the German finance minister, Jörg Kukies. Don't miss, of course, that conversation that has to do with trade ahead of the election in Germany. It'll be extremely interesting to see how he sees the political development going, and actually maybe some of the solutions that he sees for Germany needing. At 10:40 a.m. then UK time, we'll speak exclusively with the Bank of England external member, Swati Dhingra. Lizzie Burden will be doing that interview. A programming note also on Tuesday. From Tuesday, Bloomberg TV will have live coverage of Woman Power and Money event, convening the most influential female voices in finance from around the world to discuss consequential themes facing the futures of business. I'll be speaking to Jenny Johnson of Frankel Templeton. I'll also be speaking to Laila Ibrahim of DeepMind and Anna Butin of Santander. Coming up, all focus on U.S. job. You can see S&P futures practically unchanged. Up next, a Bloomberg Brief. This is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics. Makes you wonder how politics might play out.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Good morning from our global headquarters in New York. I'm Menace Kenny. Welcome to Bloomberg Brief. Let's set that agenda. Caution ahead of the last piece of the jobs jigsaw for 2024, guiding the Fed's rate cut options. President-elect Trump picks David Sachs as his AI and crypto czar, and former Senator David Perdue as ambassador to China. And don't miss our conversation with the new German finance minister, Jörg Kukies. That's later this hour. Good morning. An abundance of caution ahead of the jobs report. The whisper number on the Bloomberg terminal this morning, 220,000, bang in line with the estimate of 220. What would be a blowout number is the question you need to ask yourself after all of the revisions. Bank of America warned there is froth building in these markets. There's a risk of an overshoot in early 2025, but you still could get to 6,666, which is 10% above here, before you probably need to worry. The bond market is ground zero for the jobs report. In actual fact, all these risk markets will be focused on the jobs report, but we are focused on the average hourly earnings, 3.9%. The rates market right now sees a 65% probability of a further rate cut in December, and just 80 basis points for 2025. Veronica Clark will join us a little bit later on from Citi on her outlook for the rates market. We're also keeping an eye on HP Enterprise this morning. They reported better than expected revenue, all as a result, you got it, of their AI servers. Another earnings story, Lululemon raises its full-year outlook due to strong sales overseas, despite slower growth in consumer spending. And Boeing, falling after the federal judge rejected its plea, the plea deal that would have allowed the company to avoid criminal prosecution over two fatal 737 MAX crashes. Those are just three stocks that are on the block this morning. In just a few moments, we'll be speaking to Henry Allen of Deutsche Bank. A little bit later this hour, we've got Citi's Veronica Clark. Of course, the strategists there have a very different view to the economists. We'll ask Veronica why she's hunkering down again on a slowdown in this U.S. economy. The team at Deutsche Bank today are pushing ahead with a payrolls report saying this. Following the weather and strike-related disruptions from the previous month, the underlying trend in the U.S. remains very positive, and we think that momentum will continue into 2025. Henry Allen is the macro strategist over at Deutsche Bank. And this is a paraphrase, really, of what Powell said. This economy in the United States, it is the envy of the world. For you this morning, what would be a solid bounce back, reaffirming that envy of the world position for the USA?
Well, I think if you've got a solid number, say non-farm payrolls came in above 200,000, then that would affirm that the number that last month, only 12,000, the lowest since December 2020, was likely just a blip. And there are reasons that we can explain that. So obviously we had the strike-related disruption, particularly from Boeing. We also had Hurricane Milton barrel into Florida during the week of the survey. So there are rational reasons why that report would have been lower and didn't speak to underlying weakness in the economy. So as long as we get a jobs report above 200K, we're saying 215 is our baseline, then we're pretty positive what that means going forward.
So that's a nice bullish sort of consensus number in there. I mean, the estimate on the Bloomberg is 220, the whisper is 220. These asset markets are on fire. There's an exuberance in equities, in crypto, and there's a stoicism to the bond market. But does that reflect in the economy? This economy is strong. How strong do you think it can persist into 2025? And how dependent is that on, let's say, on an aggressive tax cutting policy from the president-elect?
I don't think it is dependent on that, because actually there are a lot of positive tailwinds as we look forward into 2025. In particular, the Fed, of course, are now easing policy rather than hiking rates. And we know that monetary policy operates with a lag. So we should get the tailwinds from that into 2025. And to some extent, the tax cuts are already priced in, because at the end of the day, it was widely expected that both sides, Republicans and Democrats, said they wanted to extend the bulk of the Trump tax cuts beyond 2025. So I don't think that's going to be a significant macro factor. Clearly, there's then a risk from any tariff policy, but we'll have to wait and see where that lands out. But fundamentally, I think the trends are pretty positive into next year.
Look, one of the tails, and it's getting fatter because we'll know a little bit more about it, is the possibility of tariffs, Henry, and whether President-elect comes out on day one and goes hard and heavy on China. He's already indicated 25% for Mexico and Canada, whether we reach that or not. But the risk is this, the tail risk is this. And I want to know the differentiation between a reinflation spike on a policy narrative from the next Trump administration, or the risk of stagflation.
I think the risk is that you get what we've dubbed actually growthflation. So you get, rather than stagflation, where you have low growth and high inflation, actually that growth is strong and inflation kind of persists. You get that kind of no landing scenario we were talking about earlier in the year, because growth is still running very, very positively. Indeed, the Atlanta Fed's GDP tracker for Q4 still pointing to an annualized rate of 3.2%. But then actually you've got lots of inflationary force at the same time. You've got tariffs, you've got fiscal stimulus from the Trump tax cuts, and then of course central banks are cutting rates, and we know that the money supply growth is already picking up. So I think actually what we've dubbed growthflation is the bigger risk heading into 2025 rather than stagflation. I think to get back to a stagflation type scenario, you'd need to see some sort of negative shock, perhaps geopolitical of some kind, a bit like we saw in 2022. I'd be surprised at this point, given just how strong growth is running, if you did end up in a stagflation type scenario.
So with growthflation, what does that do to the bond market? Is that what takes you to 475?
Absolutely. I mean, we think that the bond market is being too aggressive in pricing rate cuts from the Fed, because they're underestimating how strong the economy could prove into next year. I mean, one thing I've been saying is for the last 3 years in a row, 2022, 23, 24, bond markets and investors have persistently underestimated how hawkish the Fed are going to be. I think they're too anchored by the low rates world of the 2010s. And actually, we're in a bit of a new normal now. So I think, as you've seen this year, as growth holds up, if inflation lingers above target in particular, core PCE came in at a 7-month high last month, and I think you could see yields rise further, particularly as the market realizes you're not going to get those aggressive rate cuts that are priced in.
What does that do to risk? I mean, we've weathered the fastest hiking cycle since the 1980s from the Federal Reserve, really quite stoically as far as assets are concerned. At 475, it's not that much of a dislocation, is it?
I don't think it is. I guess the question is, how does that balance against all the other factors? I mean, we're quite bullish in the sense that, we can still see a run-up in equities alongside yields moving higher. particularly if growth surprises on the upside, which we think it will. We're a bit more bullish than consensus on growth. So I don't think there's a big dislocation. I just think there's something that needs to be worked out in terms of markets perhaps underestimating the underlying strength in the economy. I think some of that hard landing narrative from last year is still persisting a bit. I think there's still questions as to whether those lags from tighter policy, QT still going, might impact into next year. But I think fundamentally the narrative remains a pretty bullish one. And although valuations are stretched, certainly things are expensive in the US. We've seen this carry on, for instance, in the dot-com bubble. When valuations got to this level, it still went on for a couple more years. There's nothing inevitable about kind of some sort of big correction on the horizon.
No, in actual fact, that might be a bit cathartic. And that's the point that Bank of America made this morning. They looked at the price to book value in 2000 on the S&P 500, which is a 5.5. We're at 5.3 at the moment, so there's still a little bit of fuel left in the risk tank. Henry, thank you so much. Henry Allen there of Deutsche Bank on this jobs day. Other stories trending on your Bloomberg terminal. This is what we got for you. China has set out to extend its domestic laws across international borders with a ban on selling some goods to the US. The rules apply to companies and to individuals both inside and outside China, and is seen as an escalation with the US just weeks before President-elect Trump takes to office. President-elect Trump says he is selecting venture capitalist David Sachs to serve as his AI and crypto czar. A newly created position, he is expected to help spearhead the crypto industry deregulation and provide cryptocurrency advocates a direct line to the White House. South Korean President Yoon has lost the support of a key ally. It increases the chances he'll be impeached in a vote set to take place in the next few days. It's an abrupt U-turn. The head of Yoon's ruling People Power Party called for the president to be suspended from office quickly. If the impeachment motion passes, Yoon could be suspended from duty immediately. Coming up in the show, we'll shift our focus to Europe. Political turmoil keeps the markets on edge. We'll bring you Germany's new finance minister live from Berlin right here on Bloomberg Brief. Context matters.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Ways on the heartbeat of the tech
sector across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations to offer deep discussions and important insights. What do you think the future is for inflation? Is this the new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
In Europe, France isn't alone in facing political turmoil. Germany is staring down an early election after its coalition collapsed. Let's cross to Berlin. Bloomberg's Oliver Krug is standing by with a special guest. Ollie, good morning.
Yeah, that's right, man. It's because just a few hours actually after Donald Trump was elected president of the United States, the German government sort of collapsed under the great weight of its budget debate. And now, 6 weeks later, one finance minister later, we are facing the German election, facing recession, tens of thousands of job cuts, but also negotiating this new relationship with the new U.S. president in the United States. And I'm very pleased to say we're probably speaking to the best person positioned to talk about all these things, Jörg Kukis, who is the finance minister of Germany and a close Schultz advisor for a very long time. Thank you so much for joining us.
Hi, thank you for inviting me.
Yeah, so I'd like to begin with that relationship with Trump and Donald Trump. How are you imagining that relationship playing out? How are you going to approach that relationship, both as sort of finance minister, but also as the SPD sort of approaching an election?
Well, in the last Trump administration, we always had very constructive relationships with U.S. Treasury. I was the state secretary in that time when the relationship between then Finance Minister Olaf Scholz and Treasury Secretary Mnuchin worked out well, and they launched quite a lot of joint initiatives and had a very constructive relationship. So I'm looking forward to repeating that.
Yeah, there's been no secret, though, to the fact that his aim has been to rebalance the trading relationship in terms of flows between Germany, between Europe more broadly. Are you prepared for that? Are you prepared for tough negotiations there? Do you have a list in your drawer of potential retaliation? How do you intend to approach that?
Well, I don't think it would be appropriate to speculate. The administration isn't even in office yet, so
but it's
it would be inappropriate to speculate about the specifics about what may or may not happen. As I said, we're very keen to engage. We're very keen to have a strong dialogue, and we are in a very, very strong trade relationship with the United States. So it's obviously a very important topic for us.
And I spoke a little earlier to one of your colleagues, Jens Spahn, and the CDU, and they were talking about their approach to both Trump and China. They were suggesting that maybe there would be an opportunity to reposition a little bit away from China in a sort of striking a deal with the U.S. in order to strengthen those ties and to boost those trade flows between the U.S. and Europe. Is that an approach that you would advocate?
Well, the reality is our trade ties with the United States have grown very strongly, and we are, according to our China strategy, setting a lot of incentives to de-risk from China. We are now exporting more goods and services to France than to China. We are exporting as many goods and services to Poland as to China. So we're already seeing that this diversification, the de-risking, is already taking place.
And you mentioned France. Obviously, what is going on there will not have escaped your attention. There's been some concern, obviously, with yields at one point rising above sort of Greek, which is sort of seen as a very sort of strong indicator. A lot of concern around the economy. When you see that, where do you see the sort of risk of spillover? Is it concerning you at all here in Germany?
Well, I mean, I'm obviously in very regular dialogue and contact with my French colleague, and the response of markets to the vote in the French Parliament was very constructive. There's very orderly markets, and the auction of the French OATs went very well. So in that sense, the market seems to be taking this in stride and constructively.
And another question also, we heard from Christine Lagarde also a little bit earlier this week in Brussels, and from Brussels we've been hearing more and more calls for joint debt, specifically on the issue of defense spending, collective defense spending in Europe, and really sort of trying to build up these militaries. Is that something that you can imagine yourself and the SPD getting behind, joint debt in Europe, in order to finance these sort of great defense needs of Europe?
Well, I think there's, first of all, the question of what role will European military play in the context of our primary defense coalition, namely NATO. I mean, for us, NATO is really the big transatlantic pillar of cooperation and joint defense. And of course, strengthening Europe within NATO is a positive. But of course, before speaking about the financing, we have to talk about what does the substance of defense cooperation, industry cooperation look like. Then we can talk about the financing, but we already have quite a few projects of common European financing of defense activities, the European Defense Fund, the European Peace Facility, the European Defense Industry Program. We've encouraged the European Investment Bank to become more active in defense industry financing. So there is already a lot of work being done on common European cooperation and collaboration on defense and defense spending.
A lot of the defense executives that I speak to, though, say they don't necessarily have the sort of visibility looking forward to sort of build up the capacity to build within Europe, and that maybe front-loading some of this would be an option. There's also this discussion about maybe a special purpose vehicle so that people, member states could opt in or out to sort of issuing joint debt. Is that something, do you think, that would make it easier in the sense that it's not just a blanket Eurobond and countries could assign?
Well, I completely agree with your analysis that providing visibility to the industry to add capacity is absolutely vital. I can tell you what the German government is doing. First of all, we launched, after Russia's invasion against Ukraine, a 100 billion defense procurement fund that will do a huge amount of defense procurement and getting us to the 2% NATO target. The German government has announced that beyond this, for the years after the expiry of the 100 billion fund, we commit to at least 2% NATO spending, which is a first in many, many years. Just these weeks, my ministry has passed through to Parliament 37 projects of military procurement, some of which will last for many years to be worked on. So we are doing everything we can to give industry the clear signal that this is not something that is passing, but that this is something that is for the very long term. And in fact, we are hoping and expecting a very broad consensus on this military procurement project that we are going through and investing now before the end of the year.
And that sort of 100 billion fund that you referred to is almost exhausted. Now, could you imagine setting up another such fund off budget to try to boost spending for the years to come?
To be honest, that will be the consensus that we have is that we need to fulfill our international obligations to NATO with 2% funding. The question of how that will be implemented in the budget, of course, voters will decide on the 23rd of February, and the parties elected will then figure out what the best method is. And I have no way of predicting what that will be, but the commitment that we honor the 2% NATO target is something that has very broad consensus in the German parliament.
And a quick word on the Mercosur deal right now. Ursula von der Leyen is in Latin America. Do you expect a deal to be struck? What impact could it have on the German economy?
Well, it's hugely important, and it's very positive. The German government has for many years supported the conclusion of Mercosur and many other trade agreements by the European Union. I would name India, Indonesia. So it is part of this strategy of de-risking from China and diversifying. So from a geopolitical perspective, it would be hugely important to send this signal of cooperation to the Mercosur countries that we want to engage more and that we want to build this very large free trade area.
And just a final word on Ukraine. It's very poor timing, the election for Ukraine, given that right now anything that can get to Ukraine will put it in a more dominant position to try to negotiate potentially with Putin and Russia, with Trump coming in. Is there anything else Germany can get to Ukraine to try to improve their position?
First of all, the budgetary means that are committed in the draft budgetary proposal from the German government that was not passed in Parliament is good. It is contracted, it is committed, so this money will flow. That is absolutely independent of the interim period that we have with the temporary budget. We also, against all odds, I would say, finalize the agreement of the G7 facility of $50 billion that will be provided to Ukraine. The US has committed, the European Union, against the veto of one country, has committed. So in that sense, we finalized this 50 billion commitment. The other G7 countries have contributed their share. So Ukraine will have a very strong financing. That being said, when I talked to my Ukrainian colleague, the finance minister, he told me about the devastating effect that the attacks of Russia on civilian infrastructure, on energy infrastructure, transport infrastructure, health infrastructure, is not only having on the human lives of all those affected by this, by these attacks, but of course also on the financial stability of Ukraine, because it reduces the ability of Ukrainians to engage in economic activity, and of course it generates huge costs. So of course we are monitoring monitoring very closely and speaking with Ukraine very closely on what the macro stability needs are of the Ukrainian budget and what the military needs are. And we are fully committed to supporting Ukraine for as long as it takes.
Well, your cookies, thank you so much for your time. That was the German finance minister here speaking on an array of different issues, from the sort of difficulties of the economy here in Germany, as well as sort of the geopolitics and the question, of course, French stability, being very confident here.
Oliver, great
Thank you.
conversation, very broad ranging. Oliver Cook there with the German finance minister. Snapshot for you on markets. We're on non-farm payroll watch. 220,000 is the estimate and the whisper number. The dollar, you can see this morning, up by 1/8%. We've had 9 weeks of gains out of 10. This is going to be fill or kill for the dollar, really. You know, sub 200,000 or above 300,000 will determine the direction of the dollar, according to ING. Sterling is flat at the moment. Bank of America have a huge bullish call on that. They say 138 by the end of 2025. And on euro sterling, they see it getting to 80 to the euro, the strongest since the Brexit vote. Dollar yen, of course, will be a knee-jerk reaction to the non-farm payrolls. And if we get a stronger dollar, you certainly could hit 151 pretty easily. Let's talk about politics in the United States of America. The next president-elect, has chosen his ambassador for China. It is the former senator, businessman, David Perdue. He's been tapped for the role. Trump took to Truth Social saying this: he will be instrumental in implementing the strategy to maintain peace in the region and a productive working relationship with China's leaders. Kevin Whitelaw is with me. Kevin, it's interesting. This is a businessman. He's lived in Singapore. He's lived in Hong Kong. He has a firm understanding of Asian culture. The question is he a ballast, perhaps, to Navarro and Rubio?
Yeah, I mean, obviously, after Trump picked several China hardliners for other key positions, including Marco Rubio for Secretary of State, this is more of a sort of consensus choice, more of a middle ground choice. It does give someone there who has a business experience, understands how the markets work, and has operated in those areas. And remember, at heart, Trump is sort of a transactional kind of president. So he's putting someone in that role who can help be part of a transactional relationship with China, potentially, if there are things that they can agree on. I don't know that actually is necessarily going to change the overall sort of tenor of White House policy. You know, Trump historically has been someone who tends to be most influenced by sort of the last person in the room. And so, proximity to the White House, proximity to the Oval Office, and proximity to Mar-a-Lago are still, usually the things that actually influence policy the most when it comes to Donald Trump.
Well, when it comes to access and influence, his pick for AI and crypto is David Sachs. David Sachs is very close with Elon Musk. He's also very close with the PayPal team, Peter Thiel, etc. So this is a coalescing, as it were, of Silicon Valley.
Yeah, I mean, obviously, this is another position kind of like Musk's, which is not a formal part of the administration, but is more of an advisory role, sort of an outside advisor. So he's not going to be sort of a full-time person in the role, as we understand it. That means he doesn't actually have to sort of divest or step away from his venture capital fund. And when it comes to sort of crypto policy, obviously Trump has been very, very strong about wanting to promote crypto, been very excited about it. Crypto's rallied, Bitcoin's rallied like crazy on sort of what they expect from Trump. Sachs is a guy who's actually talked about wanting to regulate crypto in a pro-business kind of way, pro-crypto kind of way, but still put a legal framework around it. And so, it's going to be interesting. He doesn't come in as a full cheerleader, but he comes as somebody who seems to want to put some amount of market boundaries on it.
I like that, not as the full cheerleader. Kevin, thank you very much. That's Kevin Whitelaw on the very latest picks from the president-elect. Coming up, it is Jobs Day, in case we need to remind you. We'll push ahead with Citi's Veronica Clark in terms of her estimate. The consensus out there was 220,000. The whisper number on the Bloomberg terminal stands at 220. What is Veronica's call in terms of the continued cutting narrative from the Federal Reserve? This is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manish Kranny. Let's set your agenda. Caution ahead of the last piece of the jobs jigsaw for 2024, guiding the Fed's rate cut options. President-elect Trump picks David Sachs as his AI and crypto czar, along with former Senator David Perdue as ambassador to China. And our exclusive conversation with the Bank of England, Swati Dhingra, coming up. Markets are cautious. They're a little bit nervous ahead of the jobs report. 220,000 is the consensus estimate. We're flat on stocks. Bank of America warned there's a bit of a froth building in these markets. There's a risk you could overshoot, but they still see you getting to 6,666, 10% higher than here. Roll it over, have a look at the bond market. Ground zero for the reaction function, really, on the jobs report. Average hourly earnings, 3.9%. Our wages getting a little bit tighter. We're taking up by 1 basis point this morning. Still, the market sees a 65% probability of a 25 basis point cut in December 2025. That is a different story. We're 3 hours away from that November payrolls report. Nella Richardson of Automatic Data Processing weighed in on the debate.
I think there's going to be two head fakes. One was in October when we saw that really small number because of strikes and hurricanes from the BLS. The second head fake will be tomorrow. You're going to see a bounce back that won't tell the whole story of the labor market. The story of the labor market is that we're in a quiet period. There's not a lot of layoffs and there's not a lot of hiring. We're in this kind of stasis period. How long that quiet period lasts is undetermined. And what triggers it and which way, whether it goes up or down, still undetermined. So yeah, we're in a messy spot.
We're in a messy spot. There you go on the data. There's a shocking headline. Veronica Clark is the U.S. economist for Citi. Veronica, good to see you this morning. I think that's an interesting kind of take. You know, number of head fakes. We're in a messy space. Your biggest concern is this, is that the summer lull returns. You're not that optimistic about today's non-farm payrolls, are you?
Yeah, no, we're not. I mean, there is a lot of messiness to this data, absolutely. And that's why it's important not to read too much into any 1 or 2 months of data and really look at the trend. And we are trying to pick out that signal from all the noise. And it looks to us like the trend is still for a weakening labor market. And we've seen that for well over a year at this point. You know, we had the unemployment rate rising from a low of, 3.4% to 4.3% over the summer. A couple months of stability isn't enough to convince me that trend is not still weakening.
So what do you say differently to Jay Powell? Jay Powell says this economy is stronger than he thought it was in September. This economy is the envy of the world. world. You are disagreeing with the chairman.
Yeah, I mean, I think it's more, do you believe this level of activity or do you believe the trend? And what is the trend if not how the level of activity is changing? And certainly the employment picture is going to be most important for the Fed. I think when Chair Powell talks about the data looking stronger, he's talking about some big revisions that we had to GDP growth, which is true. But okay, GDP growth was even stronger than we thought, and the labor market still weakened.
So what do we go into market? Is it a form of churn? Is it a form of turnover? Is it about downsizing? If growth is strong, you don't necessarily need to downsize, but you may need to re-engineer.
Yeah, so I think everyone agrees on what we're seeing in the labor market, which is this very low churn environment where there's very low hiring. There aren't layoffs yet. You're not laying off people, but layoffs happen even in a healthy economy.
Yeah.
And if hiring is as low as it is, you would be biased to think those people are not going to be quickly finding jobs. The unemployment rate is just still rising, and that's what we've seen. The rising unemployment rate is fundamentally demand for workers not keeping up with labor supply.
So the risk is that the unemployment rate begins to tick higher towards 4.3% again. And that is a bigger red flag for the Fed, perhaps.
Yeah, absolutely. That's our forecast for today's number. We think we'll see a 4.3% unemployment rate again. That unemployment rate, there are a lot of issues in the payrolls data, the strikes and hurricanes. I think everyone knows that. That unemployment rate should be relatively clean of those effects. And it did rise, not on a rounded basis, but on an unrounded basis in October. So we are looking for that to increase again.
So what does that do to your call, which was originally 50 basis points for December? Are you still hanging on with fingernails to that? Or is that, no, Manus, there's a more realistic moment to review?
We'll see today's data, of course. But I do think the bar for them to be cutting in December, at least 25, is pretty low. Even if we get a very strong number today, I don't think that's enough to deter them. I think it would be more CPI next week. We'll see what we get there.
Do you need to break 300,000 to recalibrate a cut in December?
I would
is that
think
the kind of boundary?
I would think so, because there is this noisiness to the data, right? Is it going to be strikes and hurricanes? You can kind of look through that. The unemployment rate, I think, is the most important part of this number. But I really think it would only be surprisingly strong inflation next week, or CPI next week, that would do it.
Just had a conversation with Deutsche Bank, and they are saying you're going to get growthflation in 2025. Do you share? You don't share that kind of viewpoint, but then this comes back to: are you at odds with the market in terms of the scale of cuts that you're going to get in 2025?
Yeah, absolutely. I mean, obviously, we'll be very data dependent, just like the Fed will. And it's the employment data and the inflation data that matters most. But I do think, at least in the next 6 to 9 months, and we can question how incoming policies will impact the data later, but I think that's really second half of the year. But the first half of the year, there are a lot of reasons to think inflation is slowing. The labor market is loosening. We don't see pressures in home prices yet. Energy costs coming down, PMI prices are lower. So there are reasons to be encouraged that inflation is slowing.
And the consequence of all of that will have a knock-on effect on wages. If you think there's an incremental rise in unemployment rate going to 4.3%, what does that do to the wage situation?
Yeah, I mean, I think that wage pressure has slowed a lot, and that is evidence the labor market's loosened. We had a couple weeks ago the Q3 employment cost index reading. That's the Fed's preferred measure of wage growth. It looked pretty normal. It was the first print in a while that kind of looked like it could belong in 2019.
Let's pivot for a moment. We just finished a conversation with the German finance minister. Everybody's trying to work out how to deal with President-elect Donald Trump. Trudeau got on a plane. He came down. Strangely enough, you are the chief economist for Canada. I was looking at some of the BI research. Walmart, Kroger, Albertson, and all the grocers and potash makers would see their costs rise by 25% if we had the extreme of 25% tariff on goods from Canada. You don't see that actually happening, but that is your risk to all of your models next year, isn't it? It's the boomerang inflation.
Yeah, no, absolutely. I mean, all of those, all the tariff threats, not just for Canada, but globally, are a really big uncertainty, unknown right now. Certainly, tariffs would raise price level. Maybe if they're, to a large enough degree, it could become more actual inflationary. Inflation expectations would rise. And yeah, I'm not expecting to see 25% tariffs on Canada. I think there will be ways that we can avoid that.
Do you think Trudeau gets big carve-outs?
I do think,
I presume oil is going to be a carve-out on the whole trade.
Yeah, absolutely. Obviously, the U.S. imports a lot of Canadian oil, and that would mean higher gas prices potentially. I don't think that would necessarily necessarily happen, we would get some of those carve-outs.
Tell me this: who's playing the sharpest game so far? Do you think Trudeau getting on a plane or Scheinbaum, sending out messages?
I don't know. I'm not a political strategist on any means. I will let them do that.
Let them play out.
Yeah.
Okay, Veronica, great to see you. Let's see what the jobs report is. Veronica Clark there at 155,000 on the jobs report from Citi. The consensus is 220,000. Coming up, we have an exclusive conversation with the Bank of England MPC external member Swati Dhingra. That is up next on Bloomberg Brief.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House. We have dealt with him before, and after quite a few years, China simply is better prepared. And China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action every weekday, only on Bloomberg Television. Context changes everything.
It is your Bloomberg Brief. I'm Manus Cranny here in New York. The Bank of England is heading into its quiet period before the last meeting of the year. Bloomberg's Lizzie Burden is sitting down with the MPC external member in London for an exclusive conversation. Lizzie, good morning.
Manus, thank you. Yes, I'm delighted to be joined by Swati Dhingra, the resident trade expert on the Bank of England's Monetary Policy Committee. So what a good time to talk to you. Thanks so much, Swati, for stopping by. Your colleague Megan Green said yesterday that Britain might end up having to choose between the US and the EU in a tariff Trump war. As the trade expert on the BOE, I wonder which one you'd pick.
I think we should do things that suit us economically the most. And that doesn't have to be picking sides always. Sometimes it's a matter of optimizing both. Broadly, though, I think this is going to be a really important moment for Britain to cooperate with other nations if the US is going to put up, trade barriers and there's going to be retaliatory action from everyone else. I think this is a really important moment to ensure that that happens, if it does happen, that it's an orderly fragmentation and not a disorderly fragmentation, because that would be bad for all of us, not just sort of Britain.
But I mean, in a world where Donald Trump's threatening the EU with tariffs, is this actually a moment where Brexit pays a dividend, that the UK can set its own trade policy?
we can set our own trade policy, but we're still very constrained by the kinds of policies that can be put in place. If suppose they start having factor content requirements about where you source your goods from, where you source your services from, then we're in the same position as many of the other nations. And in that sense, we don't have that much of an advantage about doing independent trade policy. That being said, I think this is going to be a testing moment for how well we can do our own trade policy. But we've got to remember that the way trade negotiations work, large trade partners tend to have much more bargaining power than small trade partners. And that's something we have to face up to.
I mean, even the CBI just this morning said if the UK engages in this tit for tat and strikes back with 10% retaliatory tariffs, it'd barely budge UK growth and inflation. Do you agree with that analysis?
I think broadly, the analysis is right that the direct exposure that we have to the US economy or to other parts that would be affected by the trade war is limited. But that's only the direct exposure. The indirect exposure, the macro effects that would play out, we are just as subject to it as any other nation. So just to give you an example, suppose the US does put on very high tariffs on certain products. That's going to put pressure on, say, the Chinese exporters or other exporters that are targeted by them to possibly lower their prices. In principle, we could be beneficiaries of that in terms of lower prices, but equally, if all of us start rushing to the same alternative exporters, if we want to move away from, say, Chinese exporters supplying us those products, then we all end up basically crowding to one source of supply, and we could end up in very much the same kind of world that we've seen in the past few years of supply chain disruptions.
But I mean, if you do see that diversion of cheap Chinese goods, doesn't that make your job easier? Would it mean more rate cuts next year from the BOE?
I think it might also come at a pretty substantial productivity loss. And in that case, I think, expecting businesses to rewire so quickly to a new world, that's asking a lot, thinking that that isn't going to impact productivity. So I don't think it necessarily is going to make my job easier. It might make my job easier for a month or 2 months, but not necessarily over a 2 or 3 year horizon.
So thinking about rate cuts next year, Andrew Bailey, the governor's said there'll be 4 quarter-point cuts if the forecast plays out. How many do you expect are going to be needed?
So my policy view has been that, gradual is good on most occasions for the reason that, unless there's some big shock happening, say the pandemic hits and you have to immediately rewire your monetary policy strategy, most of the times gradual is better because it gives people certainty to plan ahead.
But so not all the time.
Not all the time. There are shocks which come, and most of the decisions that we make, have to react to those very sudden shocks quite quickly. But the rest of the time, how much information gets revealed about the economy in a month is very limited. Most of the economic indicators that we look at are slow moving. Also, most of what we do in terms of our monetary policy actions takes time to have effect. So why would we do sudden changes as opposed to moving gradually and learning slowly and steadily about the economy? In my view, I think we have a very restrictive stance at the moment. That's weighing on living standards. That's weighing on even supply capacity and investments. And that's why we need to sort of start to take that away to some degree so that we start to get normalization back into the economy.
Yeah, I mean, if rate cuts are too gradual, would that be a policy error? Do you risk harming UK growth unnecessarily?
I think that's always been the biggest challenge that we've faced. We're not dealing with a situation where we think the economy is going to keep growing even if we have a restrictive stance. In this case, we're really sort of paying a price in terms of, consumption's been very weak. Businesses have been telling us for months that they've reduced investment for the reason, the broader macro outlook, as well as for the fact that it's becoming more expensive to finance those investments. So it's a combination of all of those factors, the weak consumption, the weak investment, and possible damage to supply capacity is what I would worry about. And that's why I think we should be easing policy more.
I'm kind of wondering, if you look back, do you think that the BOE didn't have to put rates so high to get inflation to target then?
So I think one way of thinking about that question is what happened in June 2023. Almost everybody was labeling the UK as an outlier. But if you looked more carefully at some of the other indicators, which are more indicative of pipeline cost pressures, like what are producers paying for buying from each other, or what are they paying for inputs, those numbers were in some cases even in negative territory. So those pipeline cost pressures, there was indication that they would start to ease, and we did see that happen. So by the time we got to November, we were saying that, inflation was going to be now at about 3% or 3.4% if you went with the mean forecast at a rate of about 5% on bank rate. But that's not the world we're in now. We've actually seen wage pressures come down. We've seen services continuing to ease, albeit slowly, because these are slow-moving indicators. But broadly speaking, we are almost at half the point that we thought we would be at. So, bank rate has to ease as a result. Both of those things can't be consistent with each other.
In terms of the end point, the Fed and the ECB are having this big debate about the neutral rate. It seems, at least to some former BOE policymakers, to be something suppressed here in the UK. Where do you see the neutral rate for the Bank of England?
So I don't have particular reasons to disagree with the central view that most, say, forecasters, most market would take, which is somewhere in the range of 2.5% to 3.5%, with pretty large error bands to these things. Given those large error bands, I think it's very hard on a day-to-day basis when interest rates, have been at about 4.5-5% range to say that somehow we can take real serious indication from that neutral rate to set policy today. We're quite far away from that. So in that sense, it's not very informative of what I need to do tomorrow. But broadly speaking, I think the compelling arguments that I've heard about why the neutral rate would have risen are the ones around artificial intelligence, about need for greater public investment. I think those are plausible stories, but to a large degree, that's not where the reality of the UK is. That might be more true for the US, where we have seen AI boom much more than, say, in the UK. But at the end of the day, on a longer run sort of view, we're a small open economy. What happens in the US matters to us. So in that sense, I'm willing to buy the argument that the neutral rate has risen to some degree.
All right, Swati Dhingra, thank you so much for making time for us today ahead of that December meeting. Manas, back to you.
Lizzie, thank you. Great conversation. The debate is, of course, is high tide our rates. And in that conversation, she says rates are tight. It's the same debate here in the United States of America. Coming up, we'll discuss what to expect from, you got it, the jobs report, the last one of 2024, the guiding North Star for the Federal Reserve FOMC's rate decision in December. This is Bloomberg. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
It's coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
It is your Bloomberg Brief on Jobs Day. I'm Manish Cranny in New York. What have we got for you? It is the main event. 8:30 a.m., the jobs report will hit the tape. The surveillance team will take you through those. Then some economic data from the University of Michigan, the Consumer Sentiment Survey, 10 a.m. And it's a big day for Fed Speak as well. Bowman, Daly, Goolsby, and Hammock all on deck post-jobs. So that is going to be interesting to see what their take is. Mike McKee is with me pre-jobs, post-jobs, and throughout the day. Good morning. The whisper number is now inched lower to 217. How much distortion is there in this non-farm payroll number? Because we've got ex-hurricanes, we've got strikers coming back. How distorted is this number going to be today?
Well, this number won't be as distorted as October, but because of October's distortions, it's going to be harder to read. We know there are about 38,000 jobs that were subtracted from manufacturing, largely because of the strikes against Boeing. So we can estimate that. And here are some numbers on what we are looking at least from the BLS, in terms of what we saw in job losses state by state. Now, the surveys are a little different, so you can't add them up and say this is exactly what it's going to be. But you can see sort of the impact that we're expecting. And it may not be from the hurricanes as bad as people anticipated. So we don't really know where we're going to come out, which is why the Fed is going to kind of ignore this headline number and look at unemployment instead.
And therein lies the point. I just had Veronica Clark from Citi in the seat. She's going for 4.3%. She says it's a slow dissipation in this economy and that the unemployment rate will rise to around 4.3%. But you sat in the seat and said, actually, that's not going to be that far from what the summary of economic projections were in September. So the trajectory is for rising unemployment.
The trajectory, at least according to the Fed, is for rising unemployment, and they've been surprised by the fact that it hasn't really gone up. In September, they predicted 4.4% by the end of the year. Now, that was September. We get in 2 weeks a new estimate. We'll see what that estimate turns out to be. But at this point, we're seeing unemployment better than they anticipated. So a little bit of a rise isn't going to bother them. Now, we're pretty evenly divided. Veronica's more on the high.
She is.
We're pretty evenly divided among economists who say 4.2 or 4.1. And the difference really comes down to rounding in that 3 digits that we look at as economic nerds.
I mean, that is, I wouldn't be self-flagellating. I mean, that's pretty tough, though. That just shows you how nuanced this forecasting is for the Fed if we're down to 3-digit rounding, both on PCE and on the unemployment numbers.
Well, the hard part is that we're looking for some sort of signal on the economy. And when you're looking at 3 digits, you're not getting a very strong signal one way or another. And I was talking to a senior Fed official this week who basically said, even 4.2, 4.3, we are still in the range or below the range of full employment. So we're not really worried about that. It would take a sharp move in unemployment for them to start thinking that the labor market is weakening significantly.
Okay, Mike, well, we'll see what the numbers are when they hit the tape in just a little while, and you and the surveillance team will take us through all of that. Is Mike McKee on the jobs report. Some individual stocks, keep an eye on these. Ultra Beauty is extending its post-earnings surge. Strong sales, despite the analysts' previous concerns that the firm began the holiday discounts a little bit too early. You can never start too early with the discounts. Lululemon is continuing the gains, boosting the full-year outlook as the oversales, they blunted the U.S. softness. And Palantir, signs of a new partnership with Shield AI to develop AI-powered autonomous military aircraft. Just had a conversation with the German finance minister again, all around how do you build funds to assure the industry, the military industry, to continue to build. Those are the individual names. We're going to be all eyes down on the jobs report, as Mike says. What is the effect going to be? Here's your FX board for the moment. Again, sub 200,000, it's going to be seen as a reasonably weak number, but we are very long of the dollar. Positioning is quite extreme. Sterling, keep an eye on it, 127.60. We just had Bank of America, a huge call from Bank of America. By the end of 2025, you're looking at 138 on cable and 80 to the euro. the strongest since the Brexit vote. The Trump tariffs could push the UK to actually do more with Europe. Dollar yen, well, of course, if there's a little bit of a shift in the jobs report and a strong dollar, you could say hello to 151. Surveillance is up next. That's it for the brief team.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community, create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The U.S. economy still has significant advantages versus the rest of the world.
The labor market has continuously been strong.
The data continues to show a resilient labor market as a theme.
The story of the labor market is that we're in a quiet period. How long that quiet period lasts is undetermined.
Last month for payrolls was an anomaly. We got to make sure we're still on a really good track here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now as we come into Payrolls Friday after snapping a 4-day winning streak on the S&P 500. Your equity market is shaping up as follows. Equity futures on the S&P negative by 0.1%. On the NASDAQ, down about 0.1%. On the Russell, the small caps up by 0.1. The main event, 8:30 Eastern time. The estimates look like this. The median, 220. The high, 284. The low is 150. The November jobs report just around the corner.
And it's so wide when you look at this range of estimates because people are concerned with what everyone's talking about, noisy, messy data. Neela Richardson talking about the stasis period, the fact that it's really going to be difficult to understand because there's a lot of hiring, not a ton of firing. It's basically stasis. And also the question is this environment of we had layoffs, we had strikes, we had a hurricane hit, and also a shorter retail space. So those short-term retail jobs right now because the holiday season is shorter. It's very difficult to understand what kind of number we're going to get.
Let's put some numbers on all of those themes. And Danny, welcome to the program, by the way. Lisa is on assignment through the morning. The snapback, the extent of the snapback, the size of the snapback. Bank of America putting some numbers on it. 60K from the hurricane. From the strikes, we're looking at around 40. So 100K is just a snapback from those two themes alone.
But that's why today's report is so important, because it carries the heft of two jobs data with it. Remember, we had that awful report last month of the negative 12,000 or 12,000 rather negative private payrolls. BNP figures we could get a revision up to 100,000. So you have that at stake, and then you have this report at stake. In order to get a pause in December, you need a strong number to come in.
Payrolls 8:30 Eastern time, then it's on to CPI next Wednesday. Then the following week, the Federal Reserve, December 18th, for that last decision for 2024. Equity futures then pulling back just a touch. We have started the new year with a year-end 2025 target of 6,600. Laurie joins us now for more. Laurie, good morning.
Thanks for having me.
Great to catch 6,700. Everyone's lining up to be pretty bullish into next year. You've been a little bit more cautious in the short term here. Can you give us some reasons as to why?
Yeah, and look, we thought we were starting to get a pullback a few weeks ago, and we were wrong on that. And we took another look at the seasonality data. And, stocks do tend to run in November and December. But if you look at the last few years, you tend to get some potholes in January and February. And some of my concerns I've actually heard echoed by investors over the past week. And really, if I look at valuations, I'm not necessarily saying we're sitting at like 2000 dot-com bubble type overvaluation, but we do look full on certain metrics, and we look a little bit over our skis on other metrics. If you look at sentiment data, the FTC data is making brand new highs in terms of broader U.S. equity futures positioning and positioning in the S&P 500 contract specifically. And guess when the last time was that we did that? January 2018. So we, as we've been talking to clients, there's just a sense that there's a lot of froth in the market. We do think there are some political tailwinds next year. There might be some headwinds as well. We need some clarity on that. We're navigating in a lot of fog right now. And, if you look back to January 2018, we had just come off of the euphoria of tax reform that really propelled stocks higher in 2017. Now, that bill did not get passed until, I think, sometime around Christmas, but we pre-traded all the move, even though we didn't know what the tax rate was. It kept changing. And, as we sort of look at where we are now, we think just a lot of this good stuff has been pulled forward. And that's not to say we're not going to move higher next year. We do have a higher target, but we do think we need to have a little bit of a digestion period at some point.
We all read your research. There was a line from a note that you put out a number of weeks ago about our ability to absorb, our capacity to absorb bad news.
Yes.
What would you say bad news is? What does that look like in early next year?
So, one thing that's been coming up recently actually has nothing to do with the election, but just looking at earnings. And so if you think about the tone in the last few reporting seasons, it's been a bit more negative. You've seen margin expectations coming down. If you look at S&P 500 companies and the forecast for next year, the tone around costs has really, been, I wouldn't say it's dire, but it's been more concerned than what we had seen, kind of over the previous 4 to 6 quarters. And if you think about, sort of fundamentals, right? I mean, we've had this rock solid earnings environment. Companies have been navigating through everything. If we get to that year ahead outlook season in January, February, which coincides with that seasonal pothole, I think that's something that could rattle investors quite a bit. We got an earful the last few quarters about how business activity has been frozen. People were on hold because of the election. There's a big expectation that we're going to see this unleashing of activity. It's time to put up, right? It's time to see the evidence of this. So I think that's one big thing that actually has nothing to do really with the election itself and these tax policies, et cetera, that could rattle investors if it happens.
So there's plenty of things to be cautious about. But Laurie, the problem is that typically it works to fade the bears.
Yeah.
It doesn't usually work to fade the bulls. So what do you do in the meantime?
Look, I think we, look at what could any potential correction be. And in my mind, they're still limited to 5 to 10% type drawdowns. You get anything beyond 10%, honestly, you don't get much between 10 and 15% in recent, kind of stock market history. You hit more than 10, you tend to go to 15 to 20. And those 15 to 20 type drawdowns are legitimate growth scares where we don't typically, sort of have a recession, but the fears that we're going to have some sort of growth slowdown are real. I don't see that in my, sort of investment horizon right now. So I do think any downside is going to be limited to that kind of range. So you do end up wanting to buy the dip, but you do kind of have to go through some stuff to get there.
I was also looking at some of the consensus calls when we figured that Trump would be the next president of the United States. We got that, and things haven't quite played out how we expected. Mag 7's outperforming the S&P. Growth is beating value. German stocks are doing well. Mexican stocks are hanging in there. What among that looks mispriced? Is something gone wrong?
So, I think to a certain extent, if you look at pricing in the market and some of these higher level things, and I think there are some exceptions like materials and healthcare, but generally markets are hoping for the best. There is some preparation for the worst, right? When you see things like healthcare and materials having really underperformed post-election. But I think, if you think about financials, for example, right, that's a Trump trade, very consensus. That one's been working and it's pretty clean and it's still got some room on valuation. I think other things have had some wrinkles. And I will tell you, when I talk to people who are more constructive, and that's not really the tone I'm sensing the last few days, but if I think back the last couple of weeks and, hear the more constructive tone, it's, well, this bad stuff isn't going to happen. We think the risks of that are low. We think that this is just bluster. We think that this is just posturing. And so I do think that optimism is filtering in a lot of trades.
Is that going to be the catalyst for the pullback when potentially the bad stuff becomes reality?
I think, and look, I think I hesitate, I think good stuff and bad stuff is an easy way to think about it. Some of the stuff is just more complicated, right? And, one example that comes up, and you and I have talked a lot about this, Anne-Marie, since we went to that Trump speech, but the whole idea of the 15% corporate tax rate deduction, that the idea that there may be some conditions on that, it seems like it's finally starting to filter out. But, I do think there's, I'm seeing a lot of stuff floating around with this 15% rate. I'm like, well, it might be more complicated than that. People just haven't really been paying attention and aren't aware. And when that clarity comes, if that's what in fact ends up happening, it could suck some of the enthusiasm out, even though it might not be bad policy.
Right. So the 15%, what you're talking about, has an asterisk and fine print next to it, has to be made in the United States and likely would come after there's going to be some level of tariffs, according to President-elect Trump. And the sequencing we're hearing and reading the tea leaves out of Washington is that it's immigration bill and tariffs and then tax cuts. So early next year, are companies going to have to start pricing in what higher tariffs might mean?
It's interesting because I've been, really reading very closely the company commentary and earnings calls. We haven't had a ton, but I've also been reading conference commentaries on anything to do with the election. And a lot of the discussion has been tariff. But generally, I would say up until we sort of saw that, kind of Mexico-Canada announcement made, it was a situation where companies were like, well, we navigated really well through the China tariffs. We've reduced our China footprint. We've diversified our supply chains. Don't worry, we can get through this. And oh, by the way, we're going to pass everything along to the customer, so it's not going to impact our margins. We're going to have to see if that changes now that, sort of more broad-based tariffs have been introduced. But I think that's another misperception, is that these companies have just been going out talking about what happened in Trump version 1. And that is not the playbook this time around, if you actually listen to what he's been saying.
This line of thinking got some pushback yesterday from Jim Karen of Morgan Stanley, who brought up the issue of tariffs and said maybe people view them as a good thing.
Yeah.
Domestically, there could be some winners here that investors are excited about. Do you see anything in that?
Look, it comes up in my conversations on small caps and on the industrials in particular, that if you're going to reinvigorate domestic manufacturing, is that going to bring, some good stuff? And then you can sort of extrapolate that to the regional banks, which are going to have more regional footprints in terms of areas, like the Midwest and the Southeast, where you might have some of this manufacturing being made. I would say, I think that's all good and well in the long term, but it does take time to readjust supply chains. And as I've been reading some of these commentaries from companies, and they're talking about, well, we moved out of China into Mexico into Southeast Asia and yada, yada, yada. I'm not hearing a whole lot of we've moved to the U.S. So even if it ends up being positive, that could potentially impact demand, margins, and earnings. And when you're in an environment where there's not a lot of room for multiple expansion, earnings are a bigger driver of stock prices in the short term.
There is a massive marketing push right now. John Deere is running a commercial campaign at the moment talking about their presence in, guess where, in America. How many people we employ, how important America is to us. You're going to see a series of commercials like that from various companies over the next few years.
They want to send those signals out, and they want to make sure the optics are showing down in Washington, D.C. that these companies are on board. But to that point on tariffs, Kevin Gordon wrote in and said what happened in Trump 1.0, we didn't see a manufacturing boost in the U.S. due to any kind of nearshoring. So to Lori's point, they might be going elsewhere in other Asian countries. She's not hearing a whole lot of the manufacturing moving back to USA.
Lori, it's good to see you. Great to catch up.
Thanks
for
for
being with
having
us. Lori Cavacina there of RBC. Equity futures right now on the S&P pulling back by about 0.1% on this payrolls Friday. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. The manhunt continues for the suspected shooter of United Healthcare CEO Brian Thompson. Bullet casings found at the scene were inscribed with the words delay and depose. Police saying the gunman arrived in Manhattan on November 29th at Port Authority and used a fake New Jersey ID to book a hostel. Thompson's wife told NBC he had received some past threats, potentially related to insurance denials. Meanwhile, on Capitol Hill, Elon Musk and Vivek Ramaswamy met with lawmakers yesterday to explain how they plan to slash at least $2 trillion from the federal budget. They also attended a session with House Republicans. All this a part of their advisory commission coined Department of Government Efficiency, also referred to as DOGE. Their target to cut $2 trillion would be the largest austerity measure in the U.S. since the end of World War II. And Donald Trump has tapped venture capitalist David Sachs to serve as his AI and crypto czar. Trump also announcing Sachs will lead the Presidential Council of Advisors for Science and Technology. Sachs has become one of Trump's biggest Silicon Valley supporters. Sachs also has ties to Vice President-elect J.D. Vance, who also worked in venture capital before turning to politics. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Doge takes over Washington.
This is an important day. It's the beginning of a journey. You've heard what DOGE is all about, the Department of Government Efficiency. We believe it's an historic moment for the country. And these two gentlemen are going to help navigate through this exciting new day.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The outlook into next year is so different compared to the outlook into this year. Last year, 4,800 was the average target on the street coming into 2024 for year end. And here we are north of 6K. Going into next year, 7K over at Wells Fargo, likewise over at Deutsche Bank, 6,700 at BMO, just caught up with Laurie Calvasina, 6,600 over at RBC. Things are pretty bullish into next year. Equity futures taking a breather. We're down 1/10% on the S&P. In the bond market, things have stabilized just a touch. Yield are higher by a single basis point. The 10-year 4.1857. Out of surveillance this morning, Doge takes over Washington.
This is an important day. It's the beginning of a journey. You've heard what DOGE is all about, the Department of Government Efficiency. It's a new thing. And this is a new day in Washington and a new day in America. The taxpayers deserve better. They deserve a more responsive government, a more efficient government, one that is leaner and more focused on its primary objectives. And that's the opportunity that we have here now. We believe it's an historic moment for the country. And these two gentlemen are going to help navigate through this exciting new day.
So here's the latest this morning. Elon Musk and Vivek Ramaswamy meeting with top Republicans on Capitol Hill and outlining plans to slash government spending. Ed Mills of Raymond James writing, as much as Elon Musk and Vivek want to work outside of the traditional DC process, the reality is that they will need congressional support if they want to enact key items of their agenda. Ed joins us now for more. Ed, welcome to the program. How much support do they have on Capitol Hill?
I think they have a lot of support within the Republican caucus. The problem is there's not enough Republicans to get to a majority to pass this in the House. Right now, we're looking at the beginning of the year next year, 217 to 215. You lose one Republican, you can't get this through the House. Every member of the House of Representatives on the Republican side is going to be Joe Manchin. On the Senate side, almost everything requires 60 votes. You're going to need 7 Democrats. You're not going to get 7 Democrats to support some of these things. You might be able to get something through reconciliation, but when you have these small margins, John, it's going to be very difficult to get this done. And when you heard from some of the most conservative lawmakers yesterday, they said the threat comes from within that room. They weren't referring to the House as a whole. They were referring to their fellow Republicans, because traditionally when they have big opportunities to slash the budget, what they will say is that they get 20, 30 votes. They're nowhere close to the 217, 218 to get to that majority.
Everyone's going to be a king on Capitol Hill when it comes to next year, Ed. Is that why, not just talking about slashing money and what Doge wants to do, but the idea of the tax bill, is that why so many people are saying when you look at the sequencing of these Trump policies, you have to push that out to the end of next year?
Yeah, Anne-Marie, I think you're right. You're going to have some special elections that could potentially add to that majority, but it's still only going to be a couple of seat majority. When we look at the tax bill next year, it's a really big price tag. If you want to bring down that price tag, there's some significant kind of concessions that are going to be made. Historically, it's easier to give additional spending than to cut. But then you run against the opposition of the hardliners who want to support Doge. I do think that there probably is going to be some level of a Doge package tied to those tax bills trying to help pay for that. Because when you're weighing this idea of really unpopular or hard to defend government programs versus tax cuts for the American people, that's where the Republican Party goes back to their traditional roots of when you're explaining you're losing. So if you're explaining why you didn't support a tax cut, that's a very difficult position for you in a Republican primary. And Elon Musk is more than happy to challenge you and give money to your kind of primary opponent. So you probably still get that package, Anne-Marie, but that fragile flower of consensus is going to be very difficult to hold together.
Well, we know what some of the provisions might be in the tax bill. Donald Trump talked about them endlessly on the campaign. What do you think is going to be included when it comes to Dogifying the government? What are the cuts that we can actually see make it into legislation?
I think they're going to be on the edges, Anne-Marie. We're going to see a series of things that have been outlined previously, difficult to defend programs. What we've heard is that they want to cut $2 trillion annually from the federal budget. You would have to do a series of entitlement reforms to do that. So I think Medicaid is most at risk in that conversation. Some redetermination in terms of who gets it, more enforcement on kind of the recipients, kind of not too dissimilar to the provisions that Democrats added into the reconciliation bill, giving more money to the IRS to crack down on waste, fraud, and abuse within kind of taxpayers. They're going to say this is waste, fraud, and abuse on entitlement programs. I think it's very difficult to do multiple things at the same time. Entitlement reform might be a step too far, but if you want to get those savings, you're going to have to tackle that, with Medicaid being the most likely area that they try to tackle.
Ed, you mentioned something there that I want to dig into more, this idea that Elon Musk could fund competitors to those in the House and the Senate if they don't fall into line. We learned with filings yesterday that Musk spent $250 million on Trump's campaign. How big of a threat is that? What is Musk's power to make sure that Congress people fall in line with Trump?
For Republicans, the biggest threat generally is a primary opponent. And when you have someone who was giving $250 million, as you said, Danny, was giving $1 million away in a sweepstakes, a competitive primary is about $1 million. And so to have that outside money is going to be a huge pressure. One of the questions that I have is there are some states, especially in California, where there are still plenty of Republicans in Congress where a kind of two-person kind of advancement primaries are not as impactful. And so it would help with a lot of members of Congress getting him over the edge. But there are two members who voted in favor of the impeachment of Donald Trump who's returned. There are a handful of members from California who don't have to worry about primaries. They actually have to worry about not going too far to the right. So the math is going to have to math, and it's very difficult to get that done, Danny.
Does that then change the dynamic of the slim majority we've been talking about? Does it look a little less slim with Elon Musk acting as cop?
It's going to put pressure. At the end of the day, I go back to that when you're explaining you're losing. So as a Republican, you generally have to vote in favor of tax cuts. Now, the big question is, how much does that cost? It looks like it's going to be $4.7 trillion just to keep current law. Anne-Marie asked about all of the promises on the campaign trail: no tax on Social Security, no tax on tips, no tax on overtime, doing something with SALT. That could balloon that up to $10 trillion. You're not going to have a bill that big. I think that the over-under in terms of how much we'll add to the deficit through taxes over the next 10 years is about $3 trillion. So you'll have some of those offsets. But building that coalition, we have too many members on Capitol Hill where perfect is the enemy of good. And the more you have as perfect is the enemy of good, the harder it is to actually get this package. So I think the final thing I'd say there is you have Senate Majority Leader Thune saying he wants to aggressively move this out, maybe do 2 reconciliation packages. I'd say I'll take the over on that timing and I'll take the under on that number.
Ed, you're having conversations with market participants every single day. Do you get the sense that they're underplaying how difficult it will be to execute on this front?
John, I think it's a good question. I think what I've seen is people are just taking a step back, taking it all in, not getting too swayed too far on any one headline, because that most market participants I've talked to lived through Trump 1.0. They recognize that there is a certain swing and kind of unpredictability to this. They keep the North Star of it is still more likely than not that we extend out the debt limit. It's more likely than not we extend out some of these taxes. We probably get some level of change through DOGE. If I had to pick something that is more likely than not, there is deregulation. You can do that without Congress. The courts have really opened that up. So that's what they're focused on. As we get closer, that's where we hit the return to volatility. That's probably one of the big themes for next year.
Ed, appreciate your time, sir. Thank you, as always. Ed Mills there of Raymond James. Started that conversation on the DOGE effort. Important to point out that this has got bipartisan support in some places, the likes of Bernie Sanders supporting certain elements of it.
Yeah, theirs does. And to even Ed's point, when you're talking about some of these cuts on the margins, there's even been Democrats who have talked about some of those cuts and some of those reforms. But the math has to math, and that's the problem here. And Libby Cantrell put out a note earlier in the week that said, historically, this will be the Republicans' smallest majority ever, and the second only smallest majority in the House historically. For Republicans, though, they're first. Every vote counts. And to Ed's point, everyone's going to be Joe Manchin, but on the other side of Congress.
Ed talked about size. To extend the Tax Cut and Jobs Act of all those years ago, you're pushing $5 trillion. Just for that alone, before you get into all the other stuff.
Just to keep status quo. And then you have to start adding on the promises we heard on the campaign trail. And I find the one that's most interesting is cutting on Social Security taxes. Do you know why? Because at the same time, you're trying to maybe go through Medicare, Social Security, and cut some of the fat that's in these entitlement programs. At the same time, you're saying, well, we're also going to cut the taxes on them. There's going to be a lot of debates on this.
It's going to be a busy 2025. Equity futures right now this morning, we're down by about 0.1% on this Payrolls Friday. The number we're looking for in our survey, about 220K. I'm next on the program, Sucharita Kadali of Forrester Research on earnings from Lululemon.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young Black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Snapping a 4-day winning streak on the S&P 500 in yesterday's session and spoiling the week so far, just back-to-back all-time highs over the last 3 sessions so far this week. Just a small move lower. We're down again by 0.1% on the S&P 500. On the Nasdaq 100, we're softer also by 0.1. In the bond market, we've now gone about 2 weeks without the 2-year yield climbing. We're up by a single basis point at the moment, basically unchanged on the week so far, up by 2 at the front end to 416.42 on a 10-year 418.38, up a single basis point there. All of that, Danny, going into the payrolls report in about 2 hours from now. The estimate we're looking for is 220K.
I just wonder if the risks going into this are asymmetric, because you need a strong jobs report in order to get a pause. It's an ingredient for it, but it's not the thing that forces it. The thing that forces a pause is CPI next week, is inflation. Perhaps the bigger risk is a weak unemployment report, where you need a Fed who all of a sudden gets worried about jobs again, needs to cut ahead of a 2025 that could be very well be inflationary.
Andrew Honhorst of Citi saying something similar. Markets are underpricing downside risk to jobs data and the Fed's asymmetrically dovish reaction function. More on that a little bit later. I want to turn to Europe. Just take a look at this. The news isn't great out of France, but the market is starting to stabilize. The euro against the dollar just about unchanged, 105.83. And 10-year yields, Danny, are down on the week. In France, started the week around about 290, 292. We're down to 287.
It's a huge vote in favor of Le Pen. John, you've always been great in saying no one wants to be the candidate that upsets the bond market. The fact that Le Pen can come in, essentially cause the toppling of the French government, and bond yields barely budge, it really shows how calculated she was in this. She doesn't want to be the person kicked out by the bond vigilantes. Instead, she goes in, she talks to Francine Lacqua about being able to pass a budget. She doesn't call for Macron to step down. She's striking that careful balance of getting her way and having the markets on her side.
A Liz Truss reputation isn't one you want to carry into an election. I think it's fair to say. We can leave that there. That's the latest out of France. Under surveillance this morning, the search for United Health Insurance chief Brian Thompson's killer entering a 3rd day. Bloomberg learning the suspect had checked into a hostel on the Upper West Side using a fake New Jersey driver's license just days before the shooting.
So we have this new photo, and this photo can now be used for facial recognition technology, and potentially they are closer to finding out who this individual was. The human instinct of the woman who checked in this individual, I think, is fascinating. Former NYPD Deputy Commissioner for Intelligence and Counterterrorism had this to say. They were having a flirtatious moment. He pulls down his mask, gives a big smile, and that one informal moment between these two human beings remains at this moment the most significant clue to date in this entire case. And I think that's fascinating.
I have to say, one of the most shocking things I've seen is just the vitriol online. I think it's perhaps always a mistake to look on the internet after things like this, but kind of the lack of sympathy and the discontent from people, which it should go without saying, but I'll say it anyway, is never an excuse for violence. But it's percolating in really interesting ways. Anthem Blue Cross Blue Shield, for example, had a decision last month where basically in Connecticut, New York, Missouri, they would stop paying for insurance depending on how long you were under anesthesia. That happened last month. People were upset at the time, but it reached a new fever pitch yesterday. And then Anthem Blue Cross Blue Shield, according to Connecticut officials, pulled back on that decision, again, because this discontent is really bubbling up in the aftermath of this.
And I think we can all agree this certainly isn't the way to deal with it. Just shocking what's happened in New York City over the last few days. Let's turn to this story. President-elect Donald Trump naming venture capitalist David Sachs as White House AI and crypto. Sachs played a key role in bolstering Trump's fundraising among tech industry donors. Trump saying he'll also lead the Presidential Council of Advisors for Science and Technology.
So he's part of the PayPal mafia, as they call it, the likes of Elon Musk, Reid Hoffman, Peter Thiel. What's interesting about this is it's similar to Doge. I think everyone needs to take all of this with a grain of salt. It is an advisory position. Kraft Ventures, his VC firm, says he is not leaving. It is an advisory position. So yes, will he be involved advising the president? Yes. You see the crypto community very excited about this individual, thinking that potentially gives them a direct line to the president of the United States. But at the same time, it doesn't have the same weight as, say, a special advisor like Peter Navarro or someone that is actually in the cabinet.
Right. Well, he literally can't. He talked about on the All In podcast how he has a key man risk clause in his contract for his company, and he can't take on a full-time job in the government. I think it does, though, underscore kind of the small tech influence that's happening in D.C. right now. So you have David Sachs being added to the other VC influences. Mark Andreessen, according to the FT, is leading some of the search for the talent for the Doge outside agency, not an internal one, much like this one. Exactly, the task force. But still, you have all these people who are champions of small tech, not big tech, entering the government.
You've got to embrace success. I've always said that the secret to American success is the embrace of success. In Europe, there's always been this weird thing where they're sort of like, oh, success, regulate that, find that person. In America, I've always thought that's the secret ingredient, and these are successful individuals that should have some influence on the course of this country. A top court in Washington set to rule on TikTok's upcoming US ban today. This coming after President Biden signed a bipartisan bill that could ban the app nationwide starting in January. TikTok arguing the ban violates the First Amendment of the US Constitution.
So regardless of what we hear from the court, we need to remember the legal saga is likely going to continue. Regardless, there's likely going to be an appeal. When they talk about this idea of the First Amendment and free speech, I think back to what FCC Commissioner Brendan Carr said on this program a few months ago, who is now tapped to actually lead the commission as chair. He said it is not a content issue. It's the way the content is getting to people. And he called it a national security threat. And this is someone who's close to the president of the United States, incoming president of the United States, elect Donald Trump. So regardless of what happens, there's going to be an appeal. But the timeline is very short. We have to the end of January for them to divest, or there potentially is going to be this ban.
President-elect Donald Trump said he was against banning TikTok. Originally, he was against banning TikTok. I say originally because he did want to ban TikTok, and now he's against banning TikTok because of Meta and Mark Zuckerberg. And Meta this week has gone on a bit of a charm offensive to say that maybe we over-moderated things. We'd like Mark Zuckerberg to have some influence on what's happening. I just wonder whether that can really change the course of this story.
And he also made a pilgrimage to Mar-a-Lago to sit down with Trump. So you do see a shift in tone from all of these tech individuals in terms of wanting to cozy up to President-elect. I'm not sure if that's going to change this exactly, because there's another wrinkle, Jonathan, and that's one of the biggest donors to President Trump. And that's Jeff Yass, and he has a huge stake in TikTok.
But even so, what can Trump do? The deadline is January 19th, a day before the inauguration. What power does Trump have? I guess he could kind of get out the sharp elbows and get Congress to overturn this, but he'd need bipartisan support. And guess what? And where the bipartisan support was? It was for enacting this bill to ban TikTok. So I'm just not sure how much power Trump actually has in this.
And the clock is ticking, that's for sure. Let's turn to retail. Lululemon upping its full-year outlook thanks to strong sales in international markets. The company seeing flat sales in the United States last quarter, but a 39% rise in China. Sucharita Gadali of Forrester saying athletic gear still seems to be strong. The affluent, fitness-focused consumer is still spending. Sucharita joins us now for more. Sucharita, welcome to the program. What is Lulu getting right this time?
Well, I think a lot of this is just the entire sector is doing really, really well. When you look at the numbers for other companies that are selling similar products, whether it's On Running or you're looking at Dick's Sporting Goods, they are doing incredibly well as well. So the shopper is just spending in this category. Lulu has been performing incredibly well for years. And this year it was more just because of some lower guidance that some of the numbers are soft. And it's been underperforming the market. But the story is that their overall top line has been strong And some of these international sales, as you point out, have been a big driver in its success, which is interesting because that is perhaps one of the areas where it may have some softness in the future if tariffs actually become more prevalent.
Well, Sucharita, it's interesting also because so many have struggled in international markets, particularly in China. What underpins that success that they're having?
Yeah, it could. A lot of it is likely just newness to the Chinese consumer. Chinese consumers, like many consumers around the world, are often interested in purchasing whatever is on trend, whatever is new. They're as influenced by social media as consumers anywhere in the world. And I think that Lulu has had a strong formula for success, and that has been an enormous driver. In the U.S., it's interesting that some of these numbers were softer in Q3, but I expect in the next quarter, particularly as that will be the holiday numbers, it should be even stronger.
Well, Sucharita, I might be revealing too much about my social media habits, but all over TikTok, Instagram, I see all these influencers saying, hey, these pair of sweatpants from Lululemon, you can get the exact same thing on Amazon for a third of the cost. What is the bigger threat to Lulu? Is it the Alo Yoga, the Vioris, the high ends of the world, or is it Amazon and fast fashion?
Well, that's a great question because the biggest threat to Lulu is likely that competition where they could become the new middle. And that's absolutely where they don't want to be. They need to continue preserving their premium positioning. They need to be very, very careful about promotions and discounting because you're absolutely right. There are competitive threats that are at the high end and they're absolutely the knockoffs at the low end. And you don't want to be either. You need to make sure that every part of the brand, the logo, all of those elements are preserved and protected and that discounting doesn't become too prevalent in its business model.
How are they on that front, on inventories and fighting off discounting, Sucharita? Are they doing a good job there to fend off falling into the middle?
It's influenced by even store associates in stores. So a lot of this is going to fluctuate. That is one of the challenges of being a fashion retailer, but also what Lulu has is the ability to actually shape what shoppers want by what it has in the store and what it's positioning as what is on trend at any given moment.
When you look at the U.S. and also consumers around the world, which do you see right now in terms of who is the most picky? Where's the pickiest consumer?
That's a great question because consumers everywhere are pretty picky. And this is one of the things that we are certainly seeing is that certainly at the low end, consumers are incredibly fickle because they're the most economically distressed. But even at the high end, we see a lot of fickleness because those consumers, while they're still flush with cash, they have so much choice. And you see that in some of those U.S. numbers. And that's absolutely an issue that every business that is trying to attract higher end customers has to face.
Sucharita, good to catch up, as always. Sucharita Kodali there of Forrester Research. Lulu is up in the pre-market by more than 9%. It has been such a mixed month for consumer-facing companies in America. JetBlue, Southwest, American Airlines, all solid. Target, Foot Locker, not so much. Lulu doing better than good. It's been really mixed, hasn't it, the last few weeks?
But it leads everyone to just say, okay, it's a more choosy consumer. It's the bifurcation. It's the K-shaped economy. But how can you say that when it's someone like Lululemon that does cost more, is more upscale? Maybe it does come back to the picky consumer, but it just shows you can't just assume everybody's flush with cash and going to buy things. You need an actual strategy now.
It feels like the excuse at the moment when things go wrong. You say the consumer is choiceful,
yes,
picky, choosy, in the soft part that has nothing to do with us.
Well, you need to have the right choices for them. You can't say just a consumer is picky and we're living through these ups and downs and that's why it's happening right now. If you don't have the strategy, that's why you see all these companies, this extreme CEO turnover and people bringing back old people back into the fore to get that culture back. Something is happening now.
What I found so interesting about Lululemon was the international business doing well and the leggings are back in style. When, Jonathan, I think you're the one that pointed out to me that Lulu's problem was the fact that they didn't have this baggier fit that some other brands like Vuori were starting to
Are we
sport.
moving back? Is that what's happening now?
I guess. It's supposed to be for yoga, so it makes sense.
Lulu right now is up by a little more than 9%. in a pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. French President Emmanuel Macron is meeting with key politicians today as he looks to piece together a new administration. In an address to the nation yesterday, Macron vowing to serve the remainder of his term and saying he will appoint a new premier in the coming days after a vote of no confidence in the National Assembly ousted Michael Barnier. The new government will look to approve a budget before mid-December. Meanwhile, California's largest earthquake in years struck off the state's far northern coast yesterday, briefly triggering a tsunami warning and causing a wave of aftershocks. The magnitude 7.0 earthquake hit some 50 miles offshore and caused minimal damage, but was felt from Oregon all the way down to Sacramento. Emergency tsunami alerts were activated on mobile phones throughout San Francisco, leading to some evacuations, but the warning was lifted within an hour. And the world's most expensive dinosaur has a new home. The 150 million-year-old Stegosaurus, also known as Apex, was unveiled yesterday at the Natural History Museum in New York. The skeleton was purchased for a record $44.6 million by none other than billionaire Ken Griffin at a Sotheby's auction over the summer. Apex is expected to be on view for 4 years. That's your Bloomberg brief. John?
Yahara, thank you. You've all seen that meme. I wouldn't tell anyone I'd won the lottery, but there would be signs. This is like the 8-year-old version of that. You want to know what FU money is? It's dinosaur money.
It should be in his house, though, if it's actually that. He should have built like a second house just to house the dinosaur.
It's 11 feet tall and 27 feet nose to tail. So that's probably why he needs a museum. But actually, I'm excited because I want to go see it.
Amazing. Up next on the program, the November jobs report.
Even a number 220,000, I don't think that's going to be enough to deter the Fed from pushing through that December rate cut.
That conversation up next. Live from New York. This is Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Equities at the moment just a little bit softer. We're down by a little more than 0.1%. Bond yields a little bit higher, up a single basis point. The 10-year 4.1876. Under surveillance this morning, the November jobs report.
Looking out to Friday's non-farm payroll reports, the strength is going to be outsized, or at least we expect that. But that's going to be offsetting the weakness that we saw the month prior. So even a number 220,000, I don't think that's going to be enough to deter the Fed from pushing through that December rate cut.
So here's the latest this morning. The labour market in focus as non-farm payrolls drop at 8:30 Eastern time. Economists expecting 220,000 jobs added and unemployment to hold steady. Sarah House of Wells Fargo writing, through the monthly swings of non-farm payrolls, we expect the November employment report to reiterate that while the labour market remains solid in an absolute sense, the softening trend in employment conditions has yet to cease. Sarah joins us now for more. Sarah, welcome to the program. Identify that weakness for us this morning. What does that look like?
Yeah, so I think it's really going to be looking at what's the recent trend in payroll growth. So we know we're going to get a bounce back from October from strike effects, as well as we think from some of the disruption caused by hurricanes. But we could also potentially get some meaningful revisions given how low the survey response rate was last month. And so we're really looking at what does the overall recent trend say about job growth. So prior to October, we were running around 150,000. Does that hold, or do we see that sink lower?
Sarah, do you believe we could get a post-election bounce? Consumer confidence is up. Business optimism is rising based on what we heard from the Beige Book earlier this week. Is there something to be said about confidence picking up and hiring starting to follow?
So I don't think we'd see that in the November jobs numbers. I think that's too soon. We did see a little bit of that. If you look at the NFIB survey, the employment components for November came out yesterday, and we did see about a 3-point bounce in terms of hiring plans. And so we saw something similar following the first election of President Trump in 2016, although the bounce we saw in yesterday's numbers, it was smaller than what we saw in the 2016 period. So I think there's maybe a little bit to that in terms of increased confidence. I think just increased optimism, animal spirits. But I think importantly, the ceiling to that seems to be a little bit lower than maybe what we've seen previously.
In the meantime, Sarah, the words you've heard from Fed speakers and Powell himself is not about a weak labor market anymore. That narrative has shifted. It's about the strength in the labor market. And as Powell said, the ability to be cautious with rate cuts because of that. Is there a number we could get today that would throw that all away, that gets Fed speakers talking yet again about the risks to this labor market?
Yeah, so I think if you saw a clearly below consensus print, which would indicate that it wasn't so much the storm effects, that we're seeing more broad-based weakness. So this is similar in many ways to what we saw in the state employment level data, where you saw 29 states actually decline in October. So I think there are hints of this, that the labor market, while it's softened, we don't think that we've seen the end of that downward trend quite yet. And so I think if you were to see that further decelerate, if you saw the unemployment rate go up, I think you could get more concern about where the labor market is headed, and that the past few months' data just hasn't all been noise around the strikes and hurricanes.
How toxic of a mix could that be if you have a freshly weakening labor market, you have everybody all bulled up in assets at record highs, and you have the threat of inflation in 2025 from fiscal policy?
Well, I think the important thing is that the Fed does still have room to cut. And so when you look at where the policy rate is versus where even the highest estimate of where neutral is, we're still restrictive. And so I think there's room for the Fed to give a little bit more in terms of not so much accommodation, but at least dial back that level of restrictiveness, where you're not fully, I think, moving to an accommodative stance that could potentially fuel some of the inflation fears. But I think think give a little bit more of a floor to the labor market.
So what does that mean for 2025? Danny's talking about the new introduction of fresh policies out of a new administration, a sweep through Congress from Republicans, but at the same time, you're saying the Fed is they're still restrictive, so we're seeing cuts next year. How many do you think?
Yeah, so we're still looking for a 25 basis point cut at the December meeting, and then probably another 75 basis points of cuts through 2025, although we think the cadence of that is going to move slower, probably more to an every other meeting basis. But I think that fits with the idea that, again, policy, at least in the view of Fed officials, still seems to be restrictive. So even if you get some tariffs, for example, well, that would be inflationary, that's also probably going to dent growth. And so that's where this labor market conversation comes back in. So there's two mandates, of course, that the Fed is trying to protect. And if you see that weaker growth, that is going to be more of a challenge to the labor market.
Sarah, just quickly, is there a number that would put December very much on ice? What is it, 350? Is it that high?
I think it's at least 300 with probably some upward revisions to prior months, because that's what you're going to need to get that trend notably above where it has been around 150. So at least 300 and probably then some with revisions.
Sarah, thank you. Appreciate it. Sarah House there of Wells Fargo. Big takeaway from the Fed speak we've had so far this week actually came from Governor Waller, for me at least, and not from the Federal Reserve Chair, Jay Powell. When Governor Waller said this, Danny, there's still some distance to go in reducing the policy rate to neutral. They believe they've got a lot of work still to do.
They think they're sufficiently restrictive or too restrictive. And I go back to numbers like the Atlanta Now GDP tracker. That's at 3.3%. It's crazy to think that we're restrictive right now and we're still running so hot in this economy. But that's why this number, maybe not the most important, maybe it's CPI, PPI next week. That shows that if inflation is too hot, that the Fed can't continue their cutting cycle, at least for now.
There's a man joining us in the next hour who shares the opinion that maybe we are not sufficiently restrictive. He's joining us in just a moment. Coming up, we'll catch up with Priya Misra of JP Morgan, former National Economic Council Deputy Director Everett Eisenstadt, John Murphy of Bank of America, and that man is Torsten Slock of Apollo. He joins us just in a moment. Equity futures on the S&P 500 just a little bit softer. Going into the big one, payrolls just around the corner. The second hour of Bloomberg Surveillance up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
You are also an owner, I should have pointed out, of three major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own three major, have a stake in three major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
The The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Ways on the heartbeat of the tech sector
across global markets.
Real-time data.
higher, I think risk assets are going to continue with that soft landing theme.
Does that suggest to you then that the data monetary policy is still in the driving seat and it's not fiscal policy and hopium for growth?
I do think that. I mean, I think with fiscal policy, people look at the 2016 move and say, well, that was a big move in rates. There was significant growth positive. I think the starting point is so different in terms of the debt, in terms of inflation. I think President-elect Trump knows that. And which is why we're talking about DOGE, we're talking about tariffs. I mean, there's a lot of boogeymen here. So I think if the market thinks about the overall policy mix, we realize there's going to be a lot of differentiation. So I think active management, you're going to have to be careful about which sectors you're long, which sectors you're not. I think interest rates actually might just stay around the same level. We've actually exactly at the same 10-year yield today as we were a year ago. And yet, you know, bonds have done well. It's because it's not so much about rates, it's about where are you putting your bets on.
I wonder how much that explains the head scratcher of treasury yields being basically exactly where they were on election night when everyone thought that you'd get this huge run up in bond yields, and that hasn't happened. Break evens for 5-year inflation, that also hasn't moved as well. Right. What do you make of that? What's behind it?
I think a couple of things. I think if you look at the entire policy mix, again, to my earlier point, it's hard to say that it's all that growth positive. You can argue that tariffs are inflationary and there's no way around it. Well, not if the dollar keeps strengthening, then there's a disinflationary trend there. But I would say it's stagflationary. So some aspects of the policy are stagflationary. What does actually DOGE end up? You know, we've had a lot of federal hiring. Is that going to be negative? Is that going to be not as high? So I think when you start to get into the details, it's not so obvious. So I think that's why treasury rates are where they are. The other thing is the Fed, I have to give them a lot of credit. They've talked about monetary policy being restrictive. I think they're setting the stage for a slower pace, which makes sense. The first 100 basis points was always easy. I'm struggling 6 months from now, and they've got a few more. Now we're going to get into, are we restrictive? What's neutral? So they're telling us that as we approach, which I think 3.5, if that's neutral, they're going to slow down that pace. But they've been, I think, very consistent that monetary policy is restrictive. So that's why when the rates investors see the 10-year, I think it's attractive. I mean, I think it's fair. 4 to 4.5 is a very fair range. We could stay here and still get value from bonds. You can own 6-7% in high quality bonds here.
Given the different policies, can we stay in this range if we say we get the good stuff, tax cuts, but we also get maybe some of the unhelpful things to financial markets like tariffs?
Right. I think we're going to be volatile. I think we're going to go, number one, I'd say soft landings are rare. So that's why this year we've moved from recession, soft landing, re-acceleration. I think that continues to happen. Why I think the 10-year stays where it is because it's going to depend a lot on sequencing. Do we get one policy? Do we get tariffs first? Because that's an executive order issue. And do we have to wait for fiscal for to end of next year or maybe 2026? So I think sequencing will matter where we are in that range. But I think if we get all of what has been talked about, it's not so clear that it means much higher deficits or much stronger growth. So I do think rates stay where we are. We're going to look at monetary policy. Where does the Fed really start to slow down? I don't think we're there yet. We could get there in 6 months. And it's going to come down to the data and how different sectors are responding to the policy.
Everyone comes on and says the sequencing matters so much. Do you have a base case?
We do. I think some part of tariffs are announced early on, maybe right on Inauguration Day. I do think it's an opening salvo. I mean, we talk about the Fed put, but there's a Trump put that I think the market's thinking about, that do we start with 60? Maybe not for the whole world, or 20 for the whole world. That's going to matter. If it starts with, hey, let's talk about renegotiating trade deals, and that might be all of next year or maybe 2 years of renegotiating, I think the market's taking some comfort. And I can see that you don't start off with, this is what I'm going to do, let's talk about it. I do think you'll probably get tariffs early on. And then we spend all year debating how much are they cutting in terms of fraud and waste? How much are they cutting in terms of spending? And then what's the tax offset that you're going to get? So I do think, what can be done without Congress happens earlier.
Is the Trump put in the equity market or the bond market?
I think more the equity market. Because I do think President Trump probably looks at the equity market more as a scorecard. But I think we all understand, I think even equity people understand the bond market matters. It mattered a little over a year ago. In October of last year, we got close to 5%. people who normally don't care about bonds don't talk to me.
Start to care about bonds.
What's happening about bonds?
Started to watch auctions, Priya. I noticed that as well. Can we finish on the front end of the curve?
Sure.
I don't want to make a big deal of 70 basis points or so, but you talked about a neutral rate at the Federal Reserve being something closer to 350, 3%. This 2 years kind of stuck at 410, 420. And I just wonder if that's the market's way of telling the Fed, this is where we think neutral is. This is where we think the landing point is for this cutting cycle over the next year or so.
I think that's fair. That's the market. But the market changes that view of neutral a lot. Because, to be honest, we're all going to figure out what is neutral after we've crossed it. So I think, which is why if you start to see inflation level out, and inflation's been a little bit, the Fed's confidence is still there, but that CPI report next week is important. If you see another hot print, I think the market's going to say, we don't believe that neutral is 3. It's higher. So inflation might be a little more important, but you get payrolls today and we realize, there is that underlying loss of momentum. The market expectation of neutral will go down. So I think not to give you a cop-out answer that it depends on the data, but I think that market estimate will be dependent on both inflation and
It's a fair response. Let's put it that way. Priya, you're one of the best. It's good to see you. Thank
Likewise.
you. Priya Mishra there of JP Morgan. Bond yields this morning at the front end higher by around 2 basis points. With an update on stories house with your Bloomberg brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. Authorities are still looking for the suspect in the shooting of Brian Thompson, the United Healthcare CEO killed in New York earlier this week. Bullet casings found at the scene were inscribed with the words delay and depose. Police say the gunman arrived in Manhattan on November 29th at Port Authority and used a fake New Jersey ID to book a hostel. Thompson's wife told NBC he had received some past threats, potentially related to insurance denials. Meanwhile, President-elect Donald Trump selecting another key appointee. Trump has named former Georgia Senator David Perdue as ambassador to China. Perdue is a former businessman who has worked in both Singapore and Hong Kong. The pick comes as Trump has threatened tariffs on China by as much as 60% before threatening an additional 10% if Beijing fails to stop the flow of fentanyl into the U.S. And look at shares of Lululemon. Those are up more than 9% in the pre-market. The athleisure company raising its full-year outlook due to strong sales overseas, despite slower growth in the U.S. Lululemon's strategic plan is now targeting annual revenue of $12.5 billion by 2026. Lulu is saying it will be fueled by rapid growth internationally, a focus on online sales, and a larger product offering for men. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara a little bit later. That stock is absolutely flying. Up next on the program, big expectations for the incoming Trump administration.
Our expectation heading into the Trump administration, heading into the possibility of a Trump win, was always that the good news would be kind of front-loaded, and then the more potentially adverse news is backloaded.
That conversation up next, live from New York this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
So in a little more than an hour, we'll get the jobs data. It's just around the corner. We're looking for about 220K on a headline basis in our survey. Going into that, these are your scores. Equities a bit softer, down a tenth of what here. Really treading water across the board, both in foreign exchange and in the bond market as well. Bonds unchanged, your 10-year 417.61. Under surveillance this morning, big expectations for the incoming Trump administration.
Our expectation heading into the Trump administration, heading into the possibility of a Trump win, was always that the good news would be kind of front-loaded on some of those priorities like deregulation that were very clear, and then the more potentially adverse news is backloaded in terms of what happens with tariffs, what happens with some of these offsets for a fiscal package next year, where we're going to need to wait to see where these risks land.
So here's the latest this morning. Donald Trump's election victory pushing U.S. business sentiment to multi-year highs. Investors expecting looser regulation and a tougher stance on trade. Former National Economic Council Deputy Director Everett Eisenstadt writing, business and governments around the world should expect and be prepared for a drastically changed landscape in the years ahead relating to trade and international trade policy. Everett joins us now for more. Everett, welcome to the program, sir. I've been looking forward to this conversation with you this morning. How different will the approach be this time around compared to the first time around?
Well, thank you, Jonathan. It's a real pleasure for me to be here. I think we're going to see a significant difference. The first term, there was a kind of a walk into a tariff conversation. We started with some existing safeguards on washing machines that led to the 232 aluminum and steel tariffs. And then finally, the big China tariffs under the 301, which are still in place and were actually carried through under President Biden and actually enhanced. But what's interesting about that debate is that there was an internal dialogue about whether tariffs were a tool or an outcome. And what I mean by that is tariffs can be a very powerful tool to effectuate change, or they can be the end state in of themselves. And some people believe that, a strong tariff regime enables, domestic manufacturing, it solves the trade deficit. And those are the kind of debates we were having. That's not where we are today. It's definitely a tool and an outcome in a sense. And so what people are trying to discern now is like, well, what is that tool going to be used for, and how long are these tariffs going to stay in place? And there's a lot of different scenarios, and we're looking at different scenario plannings, but it's much more complex and I think much more advanced, which I think will lead to greater durability for a new type of trade regime that we haven't seen for quite some time.
Everett, though, is the bias towards using them as a negotiating tool, or are you expecting blanket tariffs and double digits when it comes to China and the rest of the world?
I think we could see both, and I think we can see both in different times on different countries. The president has been pretty clear that he is very committed to utilizing tariffs to change a lot of the inequities that he sees in the world. He has particular markets that he's quite concerned about, and he has said and he campaigned on a 10 to 20% universal tariff. I would be surprised if there wasn't some early manifestation of that tariff in his administration. Now, whether that tariff is put into place and then over time negotiated away, that's a very likely outcome. But he's pretty consistent in doing what he says he's going to do, and he has committed to using broad universal tariffs. He's also shown that he is going to use tariffs for the U.S.-China relationship, and that's on top of the existing tariffs we have today. So I would expect more tariffs on China. I would expect it fairly early, and I would not expect them to go away as readily, candidly. So there's going to be a lot of moving pieces. And then, of course, you saw over this past weekend with Mexico and Canada, tariffs were used for a very specific purpose, targeted towards migration, fentanyl, and border security, and then also the BRICS dollar. So, there's a lot of moving pieces out there. It's going to be quite complex, but I think at the end of the day, when we're through this administration, we're going to have quite a different approach on international trade than we've had for quite some time.
What's also different in Trump 2.0 is the personnel. Ambassador Lighthizer is not, at least thus far, going into this administration. There's going to be individuals like Howard Lutnick, Peter Navarro, Jamieson Greer. How do you expect these different individuals to use the jurisdiction they have, whether it's 301, 232, or just being very close to the president?
Well, I think the last thing you said is absolutely critical. He's been very careful in selecting individuals who are quite loyal to him. And everybody you see on that, Kevin, all the way from Howard and Jameson, they've all been very loyal, either through the campaign or in the prior administration. They have different approaches to tariffs. They have different statutory authorities. And so it's going to ebb and flow depending on what the tool being used is and what the objective is. So, for example, just to remind people, Jameson is a protege of Master Lighthizer. He's worked with him. He was part of his team. He knows how to operate. He's a very good trade lawyer. And he's going to use his statutory authority to try to achieve the outcomes on behalf of the president. Howard Lutnick has a different group of authorities. He has a different position. He's also got a broader mandate beyond tariffs, but he has more of the defensive AD/CVD, which is the dumping and anti-countervailing duties authorities. They'll be used as well. So I think they'll all play a role. You'll also have, of course, there'll be a focus on Wall Street and how does Wall Street react, because there is a concern, and he does want to maintain a very strong and vibrant economy. So that's where, some of the other voices come in. So I think it'll be like we had in the past, a cacophony of voices at the table with him being the ultimate decision maker.
For now, Wall Street hasn't really reacted, or if it has reacted, it's been in a positive way. Everett, I'm curious about the business community. You say real changes are coming. Have they started to try to make those changes? Are companies trying yet to right size their supply chains, get domestic supply chains? And if not, are they already behind?
It is such a great question. It is all over the map. I mean, you have some companies that are quite exposed to China. Candidly, it's hard to move away from China because it's a very vibrant market. You've got good, rates. It's an efficient economy, and there's a lot of capital investment there. So it really is very industry specific. We've been seeing across the board. There's some bifurcation of markets now. I think if you're in a highly regulated industry, say pharmaceuticals or another where there's a lot of scrutiny on supply chains, you may see more bifurcation of markets in research and development, which is quite a significant change. But I think the companies that are paying attention should be planning now, because these actions can begin to take place as early as January 20th. We can see some executive orders. And one thing that we constantly remind clients is that it's not just what it does to your supply chain, it's what it does to the perception of your governance structure. And have you prepared a contingency plan to demonstrate to markets that you're prepared for shocks and that you understand that there may be shocks? That doesn't mean they're going to come, but if they do come, you've got the structure and the plan in place to react. I think that's very important because there will be a lot of unpredictability in this next cycle, and having those plans in place and being able to talk about it when the actions happen can be very, very impactful, both to markets, but also in helping to manage the company on a day-to-day basis.
Well, Everett, on the idea that it's been uneven of how businesses are preparing, I was talking to one private equity executive who was looking at a business that had supply chains in Canada and said, hey, I still like this business because they have the ability to raise prices. Consumers will still buy these goods. There's more flexibility. It's a strong consumer. I just wonder, both for companies and politically, when does that narrative run out? We already learned that this is an American populace that's willing to turn on the government if they have to pay higher prices.
Absolutely. And it is such a diffuse effect that is hard to say. I think for some companies, it's going to be very price sensitive. They have low margins. They don't have a lot of optionality. You can take textile or apparel that's produced and you can't raise those prices very high in some of those markets because it's very price sensitive. There's other products where people will continue to pay. They will not have the choice, or they'll so it really depends. I mean, we're seeing in the auto sector, for example, that purchasing of vehicles is down because autos are expensive. If they become more expensive, that may affect the auto market more. So we're watching that very, very closely.
Hey, Everett, it's good to hear from you, sir. Let's do this again. This was smart. Former National Economic Council Deputy Director Everett Eisenstadt. It's far more complicated this time around because it crosses so many different dimensions. It is not just about national security or reciprocity. There's also the prospect of trying to use tariffs as a tool to raise revenue to offset tax cuts elsewhere. This is going to go across migration, drug trafficking, NATO funding, and more.
And trying to get manufacturing at home, which is why President-elect Trump has floated a 15% corporate tax rate if you produce in the USA.
A word you will hear a lot of in 2025, tariffs on repeat. Up next on the program, John Murphy of Bank of America on Tesla's growth projections for 2025 and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 almost totally unchanged. The jobs report 1 hour away, 60 minutes away. The number we're looking for is about 220K. With 2 hours until the cash open with your morning movers, here's Manus Cranny. Good morning, Manus.
John, good morning. This at Lululemon is a story of not US exceptionalism, but Chinese exceptionalism. The stores overseas are doing phenomenally well. Chinese stores rose by 39% sales there. They've upped the guidance for the year. They're going to make 10.45 to 10.49. But the conversation you've just had with Forrester a little bit earlier, it's about the preservation of premium pricing. Don't end up in the bargain bin. And that's what Lululemon are indeed achieving. Gross margins of 58.5%. So yeah, the international side of the business is doing a little better than the US. The US business, they say, will continue to underperform. There are macro pressures and headwinds out there. I never thought I could get excited about leggings, but there you go. We fitted it all in. A little bit more fitness for you, Peloton. I remember the days when we went into lockdown. People were scrambling to buy these machines, and then it was a bit of a tortured volatility period for them. Volte-Face by one of the houses out there, UBS, has quadrupled their price target. They've capitulated. They've gone in. They say it's going to be up to $10. You've only got one sell left on this from BNP Paribas and underperformed. Go Peloton. I'll leave you with a light touch of beauty. There you go, Ulta Beauty. Just think of the competitors here. You got Sephora. You got all the others coming in like Walmart, Target, and Amazon. But they have raised their guidance for the year. So it's going to be a raising of the guidance. They blasted through on the earnings per share, $5.14 to up above the estimate of $4.53. So the pendulum is swinging very much in favor of this company. And Data, Telsey, friend of the show, she's raised her price target to $500 from $450. So there's still 27% left in the tank. Beauty and health. What more do you want on Jobs Day?
That's enough for me. Max, thank you very much. Appreciate it. 3 of the winners so far this morning. The opening about 2 hours away. The jobs report about 60 minutes away. Under surveillance this morning, Elon Musk and Vivek Ramaswamy making rounds on Capitol Hill, building enthusiasm for their efforts to slash government spending. Both meeting with key congressional figures, including House Speaker Mike Johnson and incoming Senate Majority Leader John Thune.
So the question is, can they Dogify the government? And this is where it becomes very difficult in terms of spending. One thing they want to do is make all these federal workers come back to the office, even though the Biden administration appointee of them is actually working on potentially allowing some to already have a mandate to work from home before Trump comes in for some government workers. But the big piece of the pie, the chunk of what the U.S. spends money on is entitlement programs, and they are very popular. How difficult is cutting from that going to be?
I find it interesting that they're going after jobs to be an interesting aspect of this, because kind of unsaid in this whole, or actually, sorry, explicitly said in this, you need to go back to the office, is it will lead to voluntary people quitting, that you're going to have less people working in the federal government. What does that mean when right now it is the federal government that is doing the hiring at this moment? Priya Misra was just talking about it, this idea that the jobs number would have been negative for last month if not for the government. If all of a sudden you're letting go of large swaths of the workforce, one, how much appetite is there for that? And two, what does that do to this macro environment?
So this was the memo. The American Federation of Government Employees, a union representing 42,000 Social Security Administration workers, reached an agreement with the agency last week that will protect telework until 2029. This is one of those, I know you want to bring them all back, but at least these 42,000 working for Social Security Administration, we're going to let them hybrid work.
You know, there is a myth for European tourists, and I speak directly to European tourists because once upon a time I was one. They would come to America, they'd look at the infrastructure and they'd say, Americans really don't pay enough in taxes. They need to do something about this. And then you move to America and you speak to the accountant. They start going through the taxes you're about to pay. You're paying close to 50% in many cases here in New York City. City tax, state tax, federal tax, some other taxes as well. We need to do something about what is going on or not going on in Washington, D.C., which is why so many people are on board with this effort.
Right, because they say there's just way too much spending and we cannot pay our bills. And especially when it comes to entitlement programs, they will be running out. More people are retiring. The money is just not there. So they want to see this happen. What I find interesting, though, is what Ed Mills said. The pushback is going to be challenging from people that were in that room, Republicans, because why? The margin is so slim. Historically, it's the slimmest margin Republicans have had in the House.
Let's turn to this story. Trump announcing former Georgia Senator David Perdue as his pick for U.S. ambassador to China. Perdue seen as an olive branch to Beijing, thanks to his history of working with the Communist Party in a business capacity. What does this mean for the path forward?
So what I think this is showing is what Terry Haynes rightfully called this, a cabinet of rivalries. You have hawks like Representative Waltz, who's going to be his national security advisor, Marco Rubio, who is sanctioned by the Chinese Communist Party. And then you send someone with a business touch, a lighter touch on China, to go actually sit there in Beijing. What we put out in our story is the selection of Perdue worked in Singapore and Hong Kong, helping American firms actually source cheap labor in countries. This is something that Trump is trying to bring that labor home. So I think what this shows is a balancing act when it comes to China and potentially Trump going back to really who he is, which is a deal maker.
That's the latest on China. This is the latest on energy. Take a listen to this. Chevron planning to slow production growth next year in the Permian Basin. That's America's biggest oil field, reducing capex by up to 10%. This, of course, might be a hurdle for Trump's promise to unleash U.S. crude production. This is some pushback into next year.
But it just shows that Trump can't have it all. Either you have lower energy prices or you have higher energy prices, that encourages people to drill. The two work against each other, as does his approach to OPEC. One of them is going to have to give.
Can Tesla have it all? Let's turn to the autos. Bank of America raising its price target on Tesla to 400, citing confidence in growth prospects. John Murphy of BofA highlighting a visit to the company's Austin Gigafactory, writing the trip gave us increased confidence that Tesla is well positioned to grow in 2025 and beyond with its core EV business, launch of its robotaxi offering, and longer-term investments in Optimus. We'll get to Optimus a little bit later, John. Let's start on the car. It's good to see you.
Great. Well, thanks for having me.
What was that experience like?
There were many things in the trip that were very good, but I think the two things that stood out is it sounds like the penetration rate or the subscription rate on FSD are going up, and that combined with our ride in the latest version 13.2 of FSD was really impressive. So I mean, you've put those two together. If that 13.2 continues to improve, I think getting people to pay $99 a month for FSD is going to be a very easy thing to execute for Tesla.
Where is FSD compared to something like Waymo? What's the big difference right now?
So right now Waymo is working on a level 4 basis in many cities. San Francisco is probably the biggest. So geofenced autonomy, and it's working pretty well. Tesla is not to a point where it's actually even testing at sort of autonomous tech that will come in 2025 in their robotaxi launch. That will be surveilled, if you will, by teleoperators and folks in the vehicle. But as far as what is going on in sort of the rate of change on a subjective basis here, there is really a massive improvement that's going on at Tesla with FSD. And then sort of on an objective basis, the target of getting to 10,000 miles without any disengagements of FSD is a target by the end of this year. And next year, they're going to probably make very significant progress. I think this is one of the few areas that Tesla might be under-promising on its targets.
Well, Waymo did announce in a blog post yesterday that they're going to go into Miami in 2026. Is their first mover advantage to this industry, or can Tesla come and bully Waymo out of the way?
So, I think there's certainly room to play for probably 2 to 3 players in the autonomous robotaxi space. So I think that Waymo is definitely ahead of the curve here versus Tesla. But I think the way that Tesla is approaching this is different than everybody else. Doesn't have sort of a suitcase worth of sensors on the roof of the vehicle. The vehicles look very normal, and I think consumers will appreciate a regular, normal-looking vehicle as opposed to something that's kind of a Frankenstein-looking vehicle as far as getting into it. So I think that ultimately the way that Tesla is approaching this with the cameras that are already in the vehicle is going to really impress a lot of folks, and might allow them to shoot the gap and take the lead.
So we have Tesla taking the lead. You have Waymo far behind. Is there a future for Uber and Lyft in this?
Well, I'm not an Uber and Lyft analyst, so I'm not going to comment on them directly. But I think the companies that own the software and the hardware together are going to ultimately probably be the winners, and that would include GM with Cruise.
So you said that you think actually in terms of things like robotaxis and the rollout of this is underpriced right now in Tesla. What kind of targets should we be looking at?
So I think the launch of the robotaxi fleet next year and seeing these vehicles operate truly on a semi-autonomous basis with the teleoperators and the safety drivers, I think is going to be the next proof point. Understanding the launch of the Cybercab, which will probably be in 2026 itself, will be very, very helpful. But I also think, and this is very interesting to the Doge story on Elon's involvement, is the idea that we may get somebody in government that understands we need to increase the speed of travel. And this technology is opening the door to something that I don't think anybody in the markets really fully understands. And many people, really nobody is talking about at the moment, is the speed of the travel needs to go up. And this technology, if it creates vehicles that cannot hit things, should allow for the speed limit to go up and the real economic growth to take hold. So you need somebody in government to sort of bend people's minds with the development of this technology and really create something that we saw from the introduction of the Model T in 1908 to 1927, when the number of miles in the United States went up 125 times. 125 times. We need to focus on this, because otherwise the economy is going to be stuck in a 1 to 4% GDP growth rate. We're going to lose out to the Chinese on scale. This is the technology that the U.S. needs to embrace and change the speed of travel so we can compete with the Chinese auto industry. Otherwise, it's done.
Do you think Musk and his proximity to power, what he's doing, he's in Congress, he's probably going to be making a lot of trips to the White House as he is to Mar-a-Lago. Do you think that that will be the force the government needs in terms of some of this deregulation and thinking about things like this, the speed?
I think it's probably just beginning. Tesla has not even sort of expressed this view of increasing the speed of travel. Are they making it easier, cheaper for folks to get into robo-taxis? But I think this is the kind of things that certain DOT programs at the state level are working on. I think there has been some thought around this. But I think this needs to be sort of the precedent for whoever replaces Buttigieg, whoever, who has not even thought about stuff like this, not to be critical of the past administration. But we really need people to open their minds and really think about this, because otherwise we're not going to make a lot of progress. I mean, the speed of travel on our computers has gone up 7 trillion times in the last 10 years, and our speed of travel on the roads has gone down because of traffic. It's there's all sorts of social good and economic good that comes out of this, and it's just kind of bizarre that the industry and the government can't actually see this at the moment.
What's your vision of the future? What is the destination here? The current travel picture sounds a little something like this. You go to the DMV, buy a license, get a car, or rather get a license, buy a car. Or you travel on public transport, or you hail a cab, yellow cab here in New York City, or you get an Uber. Are they all going to merge? What does that look like in the future?
So it's a very good and important question. I think over time, you're going to see somewhat sort of a hybrid system still in place where you have public transportation, you have fleets that are operated by fleet managers and still individual owner operators. The fleet management might expand out a bit, but as you get into suburban and rural areas, you're still going to have the individual owner operator in place, and that may include some of those vehicles dumped into or sort of opting into fleets like managed by Tesla, over time. So I think there'll be a hybrid there. But I think if you get to a point where you can get that speed of travel up significantly, even if it's on interstate highways or if we organize traffic patterns here in the city, so the millionaires and the regular folks are moving faster because everybody's losing in the traffic patterns that we see right now. Everybody could win. That you could really change activity. And the reason I kind of bring up the interstates is because in 1956 we had the Interstate Highway Act, which was the last time we actually had any real improvements on the roads in the United States. This is really important stuff for the U.S. economy and sort of politically or geopolitically. That as you look at this, you start opening up swaths of real estate that are not available to folks right now because you can get there farther and faster. I mean, houses that are 100 miles outside of New York City start opening up to people to commute in the morning, and it's exactly what also happened in New York from 1910 to 1920 when the population went from 2.3 million people down to 1.6, and it's never grown since in Manhattan. So I mean, there's precedent for this stuff happening.
John, smart, super smart. Whole conversation on autos, and we didn't get to tariffs. We'll do that another time. John Murphy there of Bank of America. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. Rebels in Syria gain control of the city of Hama in a major blow to President Bashar al-Assad. The resistance group has rapidly advanced south in recent weeks and have their sights set on the key city of Homs, which could cut off the country's capital, Damascus, from the Mediterranean if captured. Any potential response from Iran and Russia will be crucial in determining whether the Syrian president can maintain control. Meanwhile, a U.S. district judge rejected Boeing's proposed guilty plea to fraud charges, which were related to 2 fatal 737 MAX crashes several years ago. The judge said he couldn't accept the deal between Boeing and the DOJ because it would improperly require race to be factored into the hiring of an independent monitor. He also echoed concerns of family members of the more than 300 people killed by the 2 crashes, who'd urged him to reject the agreement and have maintained the penalties are too lenient. And the world's richest man is now also America's top political donor. Elon Musk gave at least $274 million to political groups this year, with most of his donations going toward helping Donald Trump win the presidential race. But that's a drop in the bucket for Musk, who's worth more than $360 billion, according to the Bloomberg Billionaires Index. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Up next on the program, Payrolls Friday.
The catch, of course, is that the first estimate of October, from which we're all trying to estimate the trend, will be revised. And it might be revised enormously because the response rate in October was extremely low.
That conversation up next. Live from New York, you're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say it in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
"42 minutes away from the jobs report. I think this scene is familiar of what we typically see on the first Friday of any given month. Markets just treading water, unchanged in foreign exchange, unchanged in the bond market, almost dead flat in the equity market. On the S&P, we're down by about 0.1%. Under surveillance this morning, payrolls Friday.
The catch, of course, is that the first estimate of October, from which we're all trying to estimate the trend, will be revised. And it might be revised enormously because the response rate in October was extremely low. So everyone is trying to do these very precise estimates based on a number which could just be obliterated on Friday morning. Given the incredible uncertainty that we have right now, any more precise forecasting is just, kind of a waste of everyone's time.
But we'll do that anyway. So here's your latest. Less than an hour away from the November jobs report, with economists expecting a rebound from October's near zero print. Torsten Slok of Apollo writing this: the Fed has a very asymmetric view on its dual mandate, putting much more weight on low unemployment than on getting inflation to stay at 2%. Torsten joins us now for more. Torsten, good morning. Good to see you. Evidence of that this summer, wasn't there? They were putting far more weight on the risk that unemployment was going to get away from them.
Absolutely. If you look at the SEP, there is a sub-question that's filled out by the FOMC members where they are asked about what are the risks to your view on inflation? What are your risks to the view on employment? And they have, since this began, consistently said the risk to unemployment is that it will go up in all environments. And that's the worry you can have, namely that if there's too much focus on let's keep unemployment low, that it takes the eyes off the ball of inflation, which is exactly the risk at the moment, where inflation for the last few months in core PCE has started to move up towards 3% again, well above the Fed's 2% target.
We've had a morning full of people worried about the underlying pace of growth in the jobs market. Are you pushing back against that?
Absolutely. I think the narrative is changing in the opposite direction. The narrative for the last 2.5 years has been very simple. Namely, the Fed began to raise rates in March of 2022, and your textbook would have predicted that when the Fed raises rates, you should see car sales go down. That's not what has happened. You should see home prices fall. That's not what has happened. You should see capex spending slow down, and that's not what has happened either. The economy has been remarkably resilient for a number of different reasons. The AI data center boom. We also have fiscal policy from CHIPS Act, Inflation Reduction Act, the Infrastructure Act. But because of this resilience, and now we're adding some potential from the new administration to do some tailwinds to both economic growth and maybe also from tariffs, restrictions on immigration, and maybe lower taxes, some lift up in inflation. all that is switching the narrative around from we're having a soft landing to, hey, maybe we are either moving sideways or actually having a risk of inflation beginning to move higher.
But the narrative hasn't shifted at the FOMC. What you've heard from Fed speakers still this week is we have room to cut rates. We are still restrictive. Well, that evidence that they're maybe not even restrictive enough, or they should stay at these current levels, does that evidence come too late? Do they start to cut and kind of create a toxic mix before that comes evident?
Well, that's really important, Danny, because the incoming data, GDP in the last quarter, Q3, was 2.8. If I look at the Atlanta Fed GDP now estimate, which is at 3.3, that's telling you, where is this restrictive monetary policy? If monetary policy was restrictive, we would have much lower growth. The long run growth rate, according to the CBO, is 2%. So if we are 2.8, 3.3, around 3 still, even 2.5 years after the Fed raised rates, maybe this whole idea that monetary policy is restrictive is misguided. And I do think that Jay Powell earlier this week, when he begins to talk about we can now be more cautious, is basically a way of backtracking a little bit from this view that, we got to have rates down very quickly.
So maybe next week is the more important week for this market when you get CPI, PPI, import prices, and it's in a Fed blackout period. Are you expecting some massaging of the message from financial media, some stories to start appearing next week?
Well, let's see the data we get here today. But if the consensus is right that we get plus 200,000, again, that's just confirming that there is no slowdown. So I go to lunch with some hedge fund friends once a month, and the conversation is now beginning to turn around. Hey, maybe we could actually have the Fed hiking in 2025. So that's not my expectation at this point, but there's a complete almost ignorance to the fact that the data just continue to be good, and 200,000, 220,000 on your Bloomberg screen in consensus is not a bad number at all.
So if you're not expecting a hike though next year, potentially, could we be done with the cutting cycle?
Absolutely. The market has, of course, gone from expecting a lot of cuts earlier this year, 6, 7, 8 cuts, and now the market is only expecting 3 cuts by the end of next year. And I think the swoosh is coming up more to a straight line, meaning that we're probably going in the direction of the market saying, hey, now, well, let's wait and see what policies we're getting on tariffs, on immigration, and also on tax cuts.
Do you think the Fed in the next meeting, when Jay Powell comes out, is going to have to start talking about some of these fiscal policies that are going to be coming down the pipeline, given the fact that we've already seen the president-elect talk about them in public and have phone calls and meetings with world leaders about things like tariffs?
Well, and that's why fiscal policy next year becomes very, very important. The Penn Wharton budget model just published a paper this week, which was saying very clearly that it is possible to get a turnaround in the fiscal situation and to get back on a sustainable track. But it does require that we grow the economy, we grow the tax base, and it does require a number of political decisions that therefore will be very important in terms of trying to get some more fiscal clarity about what's coming. But it's clear, to your point, Anne-Marie, that we will need to see in markets more evidence and more clarity about what exactly is coming and how much is coming on tariffs, on restrictions on immigration, and also on lower taxes. Because it happens to be the case that if you lower taxes, pushes up inflation. If you put tariffs up, pushes up inflation. And if you restrict immigration, also pushes up inflation. So that's why where break-evens are trading is really a very big surprise to me, because all these policies do point to the risk that there might be more tailwinds coming, not only to growth, but also to inflation.
What do you think neutral is?
I think that it's definitely not at 3% nominal where the Fed is thinking it is at the moment, because otherwise the data should be a lot weaker. So the frameworks that we have, and when we try to do the Kalman filters that go into the Laubach-Williams model of estimating what our star should be, they give a number that's more between 4 and 4.5. So that's not too far away from the 475 of where we are today. So that means that we will likely get another cut or two, meaning 25 basis points. But I do think that the most important thing really is to watch the incoming data. And the incoming data still, in particular, core PCE in the last few months, still suggest that the economy, if anything, is at least moving sideways and maybe even beginning to reaccelerate.
So where does this come from? When Governor Waller, someone we all respect, says things like there is still some distance to go in reducing the policy rate to neutral, what's he looking at?
See, I don't understand that either, because I think that the idea is that in the basement of the Fed, that there is a very important and very sophisticated econometric framework, which I totally appreciate. We should be putting weight on our models, but it is just in contrast to what you're seeing in the incoming data. So that's why I think it is the inertia of the groupthink on the FOMC that it just takes time for the committee to come around to changing their view. And that's why Fed speakers more recently have been switching away from saying, oh, it's a soft landing, we need to cut rates more, to saying, hey, we can proceed. Musalem was also saying, hey, we can proceed more slowly. And of course, Jay Powell also saying we can proceed more cautiously. I think all those things tells the market that we should still be positioned for rates higher for longer, which means, of course, in fixed income, cutting coupons, getting nice yields continues to be a good strategy.
Jim Bianco, Vigo Research, agrees with you. He joins us a little bit later in the next hour. Still a no-lander. Inflation looks like it bottomed this summer. He says this about the Fed: they shouldn't cut anymore. Jim Bianco just around the corner. Torsten, enjoyed this. It's good to see you. Thank you, sir. Torsten Slok next in the third hour of Bloomberg Surveillance. We'll catch up with Nadia Lovell of UBS, Jim Bianco of Bianco Research. We'll speak to Mohammed Al-Erin of Queen's College, Cambridge, and Jeff Rosenberg of BlackRock. All of that and more. The jobs report, 34 minutes away. The third hour of Bloomberg Surveillance up next.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
In case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared. And China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
The U.S. economy still has significant advantages versus the rest of the world.
The labor market has continuously been strong.
The data continues to show a resilient labor market as a theme.
The story of the labor market is that we're in a quiet period. How long that quiet period lasts is undetermined.
Last month for payrolls was an anomaly. We got to make sure we're still on a really good track here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So this is it, 30 minutes away from the jobs report in the United States of America, anticipated ahead of the Federal Reserve decision on December 18th. It's this, then on to CPI next week, then on December 18th, the big one. Pause, skip, or go another 25 basis points and cut interest rates. Going into that, your scores look like this. Equity futures on the S&P 500, negative by not even 0.1%, almost totally unchanged on the NASDAQ 100. Your estimate shaping up as follows. 220 is the median, the high is around 280, the low is around 150. Danny, a line you mentioned a little bit earlier, echoed by Citi this morning, 2 months of jobs data in one day.
It is, and that's why this is so important, because we're not just going to get for the prior month, we're also going to get revisions for October. In a really messy report, BNP Paribas says that the number could be as big as 100,000. This will maybe show us, it might not, but it will maybe show us whether the weakening trend was real or it was all about weather and strikes.
And it's going to show us whether or not the Fed has a bias potentially to the labor market, depending on what kind of number we get today. Andrew Hollenhorst just publishing with this report saying the average of today's reading and October's will determine whether jobs growth is slowing, as we expect, they're at 155, or holding up more solidly, as it is believed by markets and Fed officials, and also Torsten Slok.
Fed officials going into the quiet period. I think we all understand the bias. They've conveyed it pretty clearly over the last week or so. They want to reduce interest rates again. You can feel it by another 25 basis points. Things could change a lot. January 20th, when we get incoming administration, President-elect Donald Trump taking over, and on day one, making some big changes.
And this is the big risk, because what if jobs are a little bit weaker and they feel the need to cut, and they say, we're going to continue to cut in force, and they continue to do that until they come head to head with the politics? Does that mean they've already moved too far? Do you get in this toxic brew of you've cut interest rates and then inflation is picking up? What happens at that point?
Toxic brew. Ramos proud. Lisa's not here, but we're still talking
Channeling
about
her, because in her absence, I'm in her chair. I thought I would.
It makes sense.
Yeah.
It's allergic. You can feel it. It sort of drifts around a table. Equities right now on the S&P down by about 0.1%. Contagious was the word, not allergic, of course. Although you might be allergic to it if you are bullish. Equities down by 0.1% on the S&P 500. Coming up this hour, we'll catch up with Nadia Lovell of UBS on her 2025 equity outlook, Mohammed Al-Aaron of Queen's College, Cambridge on growing global divergence, and we'll speak to Jeff Rosenberg of BlackRock on the latest jobs data. We begin this hour with the rally losing some steam as traders await one of the Fed's key data points, today's jobs report. Nadia Lovell of UBS looking ahead to next year and writing this, the favorable macroeconomic backdrop continues to support markets, and we expect US stocks to move higher in 2025. But investors should brace for increased volatility due to potential changes to government policies under Trump 2.0. Nadia joins us for more. Nadia, good morning.
Morning.
Bull case, 7K on the S&P. Bear case, a tariff shock, 5,100. What does that tariff shock look like?
You know, if we get that universal tariff that Trump has implications for economic growth, it will be a drag on the economy, and that feeds into earnings growth. I mean, we could see a hit mid-single digits or so to earnings expectations and volatility. And we saw that during the trade wars, right? That the market did pull back. Remember March 2018, right? When you had that first implementation of tariffs on steel and aluminum, we saw the market pull back. And then subsequently in the September, as the trade wars got into heat of it, remember the market was down almost 20%.
He's not in signal of what he wants to do. He wants to put double-digit tariffs on China, maybe even Mexico and Canada if they don't get certain things done. Why is the market so resilient in the face of that at the moment?
I think it's trying to figure out, you know, we're in an era where we probably will see policy by social media or through social, and it's sometimes going to be difficult to determine the signal from the noise and how much of this is negotiated and posturing. I would say in terms of Mexico and Canada, we're already seeing the reaction when he put on social media 25% tariffs if they don't do something to control borders and also the traffic of drugs into the U.S. And so already those two countries have stepped up. and had conversations with President-elect. And so we think that that's going to be more of a stance of escalate to de-escalate. But with China, it's probably more escalate to decouple. And so that's something that we have to be mindful of, that we will see increased tariffs on China, and that has implications for certain segments of the markets that are more exposed to China. You know, you have to think about even parts of tech that has exposure to China.
One of the so-called good stuff that we're likely to get, that was supposed to start this whole cyclical rally. You saw it after Trump got elected, but since then it's stalled out. It's been the Mag 7 that's led the S&P. It hasn't been cyclical stocks, save for the financials. Small caps are also lower over the past week. Has the Trump trade run out of steam? Is that what we're seeing?
I think part of the Trump trade also got caught up in the strong results we saw coming out of earnings. So I would say some of it was also fundamental. So it's not surprising to see small cap lose some steam, because that wasn't really driven by fundamentals. Reality is the earnings growth is not coming through on small cap, and the 2016 playbook is being pulled out. And now you have to think about the implication of tariffs even on small cap. When you look at tech, the news that we've been getting has been incrementally positive. Look at the off-cycle earnings reports we've had this past week. Also, you know, the tone coming out of the UBS Tech Conference this week has been quite positive. I mean, not to have a view on any sort of single stock, but you look at Salesforce this past week, strong top-line revenues, and they've also talked about implementation of AI and seeing some traction within agents, you know, the agent strategy. You know, NVIDIA, no surprise, at the UBS Tech Conference, continue to say exceptional demand for Blackwell. And so we think that the tailwinds for AI is still there. And that's why you've seen the likes of the Mag 7 continue to outperform.
I was going to say, you've had some pretty prominent bears throw in the towel without saying they're throwing it in the towel on their sort of bearishness, specifically on tech. The idea being, and David Rosenberg said this, that what's getting priced in now is in decades far away. And that's why you can have these very lofty valuations. Do you buy that just how we value companies has changed?
I do think that, you know, there are some companies that are being valued on the potential pickup in productivity, but I wouldn't put tech in that category because you are seeing that earnings growth. I mean, look at how much earnings growth you're seeing from tech. Next year, you're probably going to see over 20% earnings growth from tech versus what we're expecting for the broader market of, you know, 8 to 9%. And yes, tech is trading at a premium valuation at about a 30% premium to the market, but it's growing at double times. And so I think it's justified. And you are seeing not only the top line, you're seeing margins and you're seeing earnings growth come through, particularly in tech. Some other areas of the markets are there. Could there be some potential frothiness where valuation needs to come down and those companies have a valuation reset? Potentially, but I don't think that tech is in that category.
How vulnerable, though, is the tech industry, though, to something like your tariff shock you were just talking about? I mean, 80% of these semiconductors are made in one place, in Taiwan.
In Taiwan. So we have to watch the implications for Taiwan. We have heard President-elect Trump say that Taiwan needs to play for their sort of own security, and so we're watching that. But at the same time, the president-elect is definitely in favor of American advanced technology and making sure America stay at the forefront of that. And there is some reshoring happening. We've heard, you know, in terms of plants being built in the U.S. to be able to eventually manufacture chips. But I don't think that you're going to see that happen overnight. So don't think the president is going to do anything that's going to be destructive to American innovation, because at the end of the day, we have to be at the forefront of AI in the world. And so I don't think he's going to do anything to do that.
Sounds like what you're talking about is potentially we could see some carve outs. With your bear case of a tariff shock of 5,100, what happens if we get that coupled with a 15% corporate tax rate if you produce in the U.S.?
Well, then it goes back to like, how do you define what's produced in the U.S. as well? But if you do get that tax cut, which I'm not sure how that's going to be funded, Anne-Marie, where we got to look for those pennies under the sofa to be able to fund this. And so, but let's pretend that you do get that. It does favor, as we were talking about earlier, the smaller companies in the U.S. because they tend to manufacture in the U.S. And so you could have some offsets with that. But I think that there is going to be a big headwind from tariffs that you're not going to necessarily see that this sort of uplift in the market. We do think that the tariffs will still continue to have that headwinds in the market.
How many bears have you spoken with in the last 3 weeks? Are there any left?
Well, you've been talking to me for a few years. So you've known that I have always been in the bullish camp. And so
you've got a lot of company now.
So I do have a lot of company now, and I think I'm in good company. But wouldn't say we're necessarily overly bullish. I think we're balanced, and I don't think that there are very many fears left because of the fundamental pictures. But we have to be cautious of potential risk as we turn into the calendar year. The president already sort of sending out social media posts even before he takes office. So we have to take that seriously. There will be increased volatility. I think that's what we need to be mindful of.
Laurie Cavestini was on the program from RBC, someone who I'm sure you know well, talking about the capacity to absorb bad news. Just how stretched are we, and how do you gauge that? What do you look at?
When you look at valuation, yes, it's at the upper echelon, to 22 times forward PE. It doesn't leave much room for error here, right? So that's why I do think that if you do get, a slew of news around tariffs, if you do get these broad-based tariffs implementation, then that is going to add some volatility to the market, and you could see the market trade down. But we also have, corporate earnings season around the same time that the president takes office. And so if we do see, incremental, more positive news on the corporate fundamental side, that could help offset. But absolutely, valuations are on the upper end.
I gave the bull case and the bear case. What's the base case for you and the team?
So our base case is 6,600. And I know you're going to say a lot of people around that, but I would like to point out, Jonathan, that we initiated that in mid-October. Right. So I'm, again, glad to see that others are joining us in the 6,600. But that is our base case driven by 8 to 9% earnings growth.
We've known each other a while. You're preempting me now. Nadia Lovell of UBS. It's good to see you. Thank you. Nadia mentioned some social media posts. So let's get one for you from the President-elect Donald Trump going into bat for his nomination for Defense Secretary and saying this: Pete Hegseth is doing very well. His support is strong and deep. He was a great student, Princeton, Harvard educated with a military state of mind. He will be a fantastic high energy Secretary of Defense, one who leads with charisma and skill. Pete is a winner, and there is nothing that can be done to change that. Some pushback this morning.
Pushback, and he's saying he's still backing Pete Hegseth to be his defense secretary. Hegseth is really struggling when it comes to these meetings with senators who doesn't look like, Jonathan, potentially he is going to have the votes. And the conversations I have been having with people that are close to this is that actually there was a conversation with Governor DeSantis and President-elect Trump. And if Pete Hegseth can't make it through, Governor DeSantis is ready to step in.
Watch this space. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Authorities continue to search for the suspect in the shooting of Brian Thompson, the United Healthcare CEO killed in New York earlier this week. Bullet casings found at the scene were inscribed with the words delay and depose. Police say the gunman arrived in Manhattan on November 29th at Port Authority and used the fake New Jersey ID to book a hostel. Thompson's wife told NBC he had received some past threats, potentially related to insurance denials. Meanwhile, the European Union and the South America Mercosur bloc have agreed to a long-sought trade deal. This is despite objections from France, which has vowed to obstruct its ratification. Besides agreeing in principle to a deal that would create a market of 780 consumers while eliminating tariffs on goods like cars and industrial products. France and Poland are the most opposed over concerns over impacts on the agricultural sector. And China implemented new export rules to ban the sale of certain goods to the U.S. for companies not just inside the country, but outside as well. The measure attempts to replicate the reach of U.S. and European sanctions against Chinese products by restricting items that are either Chinese-made or contain Chinese components. Any company or individual that violates the provisions will be, quote, held accountable according to law. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, we'll get you some morning calls. Plus, we'll catch up with Jim Bianco of Bianco Research as we count you down to the November payrolls report. That report drops in 16 minutes' time.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Everybody's at 6,600. Got there eventually. So these are the price targets. Most people are actually at 65, the ones I'm looking at. Morgan Stanley, Goldman Sachs, they're at 65. JP Morgan, 6,500. RBC, 6,600. Nadia Lovell, 6,600. Barclays, 6,600. Bank of America, 6,666. BMO, 6,700. Deutsche Bank, 7K. Wells Fargo, 7,007. Upside is the takeaway here for 2025. Apparently, equity futures right now on the S&P 500 negative by 0.1%. The opening bell an hour and about 13 minutes away. 13 minutes away, we get a jobs report in America. More on that in just a moment. Let's get you some morning calls. First up, Bank of America, double upgrading Dollar General to buy, noting improved inventory positioning and positive customer experiences. That stock is up by more than 2%. Your second call from Jefferies, downgrading Deere to hold, citing potential negative impacts from tariffs in 25. That stock is down by 0.9%. And finally, Citi raising its price target on Lulu to 380, pointing to strong international sales and gross margin. That stock is flying this morning. It's higher by close to 9%. November payrolls just moments away. Economists expecting 220K. And for unemployment to hold steady at 4.1%. Joining us now, Jim Bianco of Bianco Research. Jim, welcome to the program, sir. What are you looking for in about 12 minutes' time?
Probably looking at the October report as much as the November. I'd like to joke that this is the, monthly payrolls report, because we had 47% response rate for October. On the second pass, that usually rises to about 95%. We could actually get more respondents for the October payroll report in this revision than we got in the initial release. And that number could go up a lot, because a lot of those businesses were closed because of the hurricanes, and they've reopened and they've re-reported that they've actually got employees. So not only does November matter, but October matters just as much. And if we get 220,000, say around the payroll, around the estimate, and we get a big upward revision, that's going to put the Fed in a tight spot, because we're only at 68% that they're going to cut rates in the December meeting, and a strong number could push it to 50-50.
Jim, you're a no-lander. You say inflation looks like it bottomed this summer. You think they shouldn't be cutting in December, regardless of what these numbers look like over the next week or so. How big is the gap between you and them at the moment?
Oh, I think it depends, because if you look at the dot chart, they're all over the place right now, the Fed. The one thing that Chairman Powell likes to say is that there's some kind of unanimity or unanimous consensus view. The dot chart says there isn't. There's still, members that think that they need to cut 2 more times this year, and we got 1 meeting left. And there's members that think that they don't need to cut. And if you look at like the long-term dot, they can't agree on where the neutral rate is. It's anywhere between 2.5% and almost 4%. So I think, I'm in the no landing camp. I'm in the camp that the economy is doing fine. I'm in the camp that says, Jay Powell, look at the rise of long-term yield to you, that these cuts that we've done is unnecessary. The market is just more worried about that you're creating too much stimulus and potentially an inflation problem. But we'll see. We'll see what winds up happening in 10 minutes and next week with CPI and which way they go.
If we do get a strong number, Jim, is this bond market mispriced? And I know you said yields have been moving higher, but they've actually been moving lower in the past month. We are near the lows of the recent months of this 10-year yield. Is something mispriced with all of the more optimistic estimates out there for what the jobs figure is going to look like today?
No, I think, the bond market moves on more than just a payroll report. It also moves on what's happening in Europe and the weakness there. We've seen some strength in the dollar, potentially a mini flight to quality as the French government collapses and in what's happening in South Korea, maybe pushing people into the U.S. Treasury market because it is the reserve currency. But to your original question, I got to say it. Look, if we get a strong number and those probabilities go to 50-50, the Fed has made a terrible mistake because they're in their quiet period. And now we're going to be back to where we were in September. We're going to be watching the Wall Street Journal reporter, Nick Timiraos, who's the effective Federal Reserve Chairman during the quiet period, and whether or not he gets that call from unknown that says Blue Horseshoe likes 25 or not and reports it in the paper. And that's how global financial markets are going to be working for the next 10 days on a strong number. It's not what the Fed wanted, but they've created this monster.
Jim, talk to me about how problematic that is for communication of the Federal Reserve. Is that a problem? That the named reporter that you named is certainly not his fault, and many journalists envy him of the position he has. But how problematic is that?
It's hugely problematic because you're right. It is not his fault. The Fed kind of created a system that put him into that position because now he's got to be careful of the opinions he has. If he writes an opinion piece that this is my opinion, it could be mistaken for that, unknown phone call, and that people will think that this is a policy prescription, and he could be creating policy when that was not his intention all along. So yeah, they've created a huge problem with this. It'd be, if we get a weak number and the probabilities go to 95%, then it's not a problem. But this could be the second time in like 4 months that this is going to happen to the Fed.
Well, Jim, we all remembered before the Fed moved 50 basis points worth of a cut with that Nick Timiraos story, we couldn't figure out whether that was from Fed officials or whether that was his opinion. How much of that, though, leads to a volatile bond market? We've seen that play out time and time again, where the messaging has been strange at times, has been through media, and you get that volatility. What does that mean for 2025 when we're set to get even more volatility because of the different prescriptions we're going to get from fiscal policy?
Oh, I agree. I mean, we're going to get from fiscal policy, we're going to be, everybody's going to get a Truth Social account. And we're also going to be watching the, Nick Timiraos during the quiet periods. And any one of these stories can swing markets one way or the other. And then, like I said, we haven't even thrown in the idea that maybe inflation is ticking up, maybe Europe is weakening, maybe Germany is going into recession. All of this is going to play into a volatile cocktail for the U.S. bond market. And you mentioned also, I should say, that everybody's at 6,600 for their forecasts. I understand those forecasts, but the fly in the ointment of those forecasts could be is everybody agrees that, no, the economy is strong. The Fed doesn't need to cut rates. The offset to all those forecasts are going to be you're going to have to go to 6,600 in the S&P with rapidly rising long-term yields, because that's going to be the natural response to the bond market is yields will go up in response to potentially more inflation and in response to stronger growth. And that could be a drag on a lot of those forecasts.
Jim, I know you're making the point that the data is good. And to John's point yesterday, and I brought up politics, he said the data is good and that potentially is going to help the Fed. But how political will it look if they do not cut in December and they cut twice, or once before an election and once during an election week?
Oh, I think they've already baked their cake with it. That's why that 50 basis point move in September was such a mistake. Because even if they cut in December and refrain in January, and you're right, the data could look good and it could be a perfectly logical reason. But then somebody with a Truth Social account is going to say, you cut rates before the election, and then when I won, you stopped. And that's going to be a difficult thing for them to have to communicate through. But they set this up with that 50 basis point move, 7 weeks before the election. So they made it look political. And if they stop, they make it look political. And if they keep going because they're afraid of the politics of it, they may exacerbate a policy mistake. They made this bed for themselves. Now they got to lie in it.
Jim, that post was incomplete. The next line reads, and that's why I nominate Kevin Walsh to be the next chairman of the Federal Reserve. Jim, how early are you expecting that change to happen, even if he just makes the nomination and we have to wait for the term to finish?
I know that President-elect Trump is very close with Kevin Walsh. He didn't get Treasury. He didn't get NEC, National Economic Council. I think he's got a plan for him. It's not that, Kevin, I'm sorry, there's nowhere in your position here. And I think that's Federal Reserve Chairman. And Scott Bessent, the Treasury Secretary designate, said that we might have a shadow Fed chairman and nominate him probably this spring or summer. And then everything that the Fed does, you'll have Kevin Warsh on your panel, on your studio during Fed meetings to basically second guess whatever Chairman Powell says at every press conference and at every Federal Reserve meeting. And so this could become another source of, volatility for the market. Well, there's what the chairman says, and then there's what the next chairman thinks. And so we could wind up seeing something along those lines, too.
This could be messy, Jim. Appreciate it, sir. Jim Bianco of Bianco Research on the Federal Reserve and the jobs number, which drops in 4 minutes' time. It is just around the corner. Payrolls, 220K is the estimate. We'll break it down with Mohammed Al-Erin of Queen's College, Cambridge, Tom Porcelli of PGIM, and Jeff Rosenberg of BlackRock. As Danny said all morning, 2 months of jobs data in just one day, and it all drops in a few minutes' time.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
December 6th, the last jobs report of 2024 is seconds away. The scores going into it look like this. Equity futures, negative by 1/10%. The NASDAQ, almost totally unchanged. The Russell, positive. Small caps, up by 0.2%. Here's a flavor, a snapshot of the yield curve in America. 2-year, 10-year, 30-year, almost totally unchanged across the curve here. The 2-year yield higher by almost a basis point or two. With your jobs number, here's Mike McKee. Good morning, Mike.
Good morning. Well, we come in sort of in the neighborhood of what the markets were expecting, 227,000. That is a little bit stronger than the 220 that we saw the prior month that we had for a forecast consensus. Prior month of 12,000. I'm looking right now, and I want to get those numbers for you because we've been revised up in September by 32,000, and October only by 24,000 to 36,000. So very, very small revisions, which suggests either we're going to get something more. There's been some concern that the strikes maybe not have washed out of the data yet, or we saw a lot of job creation and not much of a rebound from the hurricanes. The unemployment rate, 4.2%. That's up from 4.1%. Got to check and see that on a 3-digit rounded rate. The change in manufacturing payrolls, fairly strong, 22,000. That compares with a negative 46,000 the month before, unrevised. Average hourly earnings up 0.4 on the month. Bit of a surprise there, but there was some thought that maybe it's been pushed up by a lack of low-income jobs. And hourly earnings on a year-over-year basis, 4%. Average weekly hours, 34.3, unchanged. And the labor force participation rate drops to 62.5% from 62.6, which does suggest that maybe we saw a larger labor force during the month. So we'll check into that and get back to you in just a moment. I'm sure you're getting some market reaction out of this one.
Yeah, we've got a little bit, Mike. So let's work through it together. So equity futures with a little bit of a pop. Equity futures near session highs. The S&P 500 up 0.1%. Not a big move. If you turn the page and get to the bond market story, this is what it looks like. Yields are lower at the front end of the curve. They were just a little bit higher. We're down by 4 basis points now to 4.1%. Further out along the curve, we're down 2 basis points. The 10-year 4.1510. As you look at that picture, you can get a decent guess of where the dollar is trading. Just a bit softer against the euro. Euro dollar back through 106 briefly. So we'll see if this sticks. But Danny, going through the numbers at first look, it's a small upside surprise, but not the major snapback. Not the big upside revisions that some people were expecting to the previous few months.
And instead, you have an employment rate that does increase. The unemployment rate goes to 4.2%, even though you had a decline in the labor force participation rate that Mike just talked about. So overall, you get status quo from the messaging that we've heard from Fed officials, a labor market that is strong, not too hot. So again, the focus goes to next week. It goes to CPI. This doesn't do anything to shake the Fed off of their course to cut in December.
Mike McKee, I want to come back to you and just ask you about the unemployment rate. Have you seen anything that suggests what's behind that move back up to 4.2%?
Yes, what we're seeing here is the labor force rose by 174,000. That's fairly substantial, but we saw a decline of 355,000 in the number of employed in the household survey. That's a huge decline, and it's kind of inexplicable other than to say these numbers are a kind of volatile on a month-over-month basis in the household survey. So it doesn't quite square with what we're seeing on the establishment side. And I know a lot of people are going to be wondering which one is giving us a better picture of the labor market.
Mike, as you look through some of these revisions, what color do we get around the messy report of October? Does this change our understanding of it at all? Something that was punctuated by strikes and weather effects?
Well, everybody's got to dig into this a lot more, Danny, but I think the immediate takeaway is that the narrative that we saw big strike and hurricane-related drop-off in October, maybe not as correct as we anticipated, and it might have been just a outlier month where a lot of people did not get jobs for one reason or another, whereas the November numbers don't show a big snapback, so it does show some extra strength in the labor market this month. It could also relate to the timing of when companies added temporary workers for the holidays, but that is not clear at the moment.
Mike McKee, thank you, sir. Equity futures positive by about 0.1%. Mike, stay close. I want to cross over to Tom Porcelli of PGIM. Tom joins us now for more. Tom, your first reaction to this one, what jumps out to you?
Yeah, so good to be with you all. Look, I think at the end of the day, this report is pretty consistent with what our view has been, which is to say, the labor backdrop has slowed down quite a bit. I think there are some cracks in the labor backdrop, but the floor is not falling out from beneath us here. I mean, we like to look at something called cyclical hiring, and so basically you just take private jobs, you strip out healthcare. We gained 121,000 jobs this month. I mean, even if we exclude the prior month, which was impacted by all the things that we know at this point, Boeing and the hurricane, you're averaging about 100,000 jobs from a cyclical hiring perspective. So again, our view has been that continued economic expansion will roll into the coming year, but you're going to do it with a labor backdrop that has slowed down, and I think will remain soft.
Tom, just to be clear, does this change anything when it comes to December cuts? The rhetoric we've heard from Fed officials.
No, Danny, I think you're quite right to ask this question. No, I don't think it changes anything. I think at the end of the day, I think this is a kind of number that will support the Fed cutting rates in December. I think that looking for 2 or 3 more cuts in the coming year, I think is completely reasonable. But again, I think it's interesting, right? Because people were really looking for or hopeful that this report will really bounce back in a more notable way than what we've seen, and it didn't. And I think that really drives home that when you look at all this other labor market data, all this other labor data have really slowed down quite a bit. I mean, if you're waiting for the payroll report to crack, it's too late. I mean, this is one of the most lagging of economic indicators, and as I think we all appreciate now, it's revised relentlessly. So I think when we look at some of the leading metrics, it does seem like things are slowing down.
Does that mean that the bigger risk for volatility in this market, for volatility of policy, is next week CPI, PPI, import prices?
Yeah, Danny, and that's again one of the the unfortunate realities, right? I mean, when you think about the things that really drive monetary policy decisions, a lot of them are lagging indicators, like the payroll report, like CPI. So I think you're right. I think that we're probably going to be swung around by some of this data, because while this report at 227 is pretty reasonable, I mean, you can't discount that next month you're going to have a low 1 handle. I mean, that's how the data have been rolling. And then, of course, you then build in the revisions. It's like you're not just looking at the current month anymore. You have to look at what the prior month did from a revisions perspective. So, yeah, I do. I think that things actually wind up being pretty volatile in that regard.
If you weren't just joining us, welcome to the program. You just missed out on the jobs number 227, a small upside surprise. The median estimate was 220. Unemployment came in at 4.2%. That is the wrong kind of upside surprise. We were looking for 4.1%. Just coming in just a little bit hotter than expected, in line with the previous month at 0.4%. Joining us now, Mohammed Al-Emin of Queen's College, Cambridge. Mohammed, you've had about 7-8 minutes to tune over these numbers. What stands out to you, sir?
Thank you, John. As Jim Bianco pointed out, the challenge for the market and for policy would have been a consistently strong report. This is a somewhat strong report, but not consistently strong. Strong on the earnings side, it is strong on the labor participation coming down side, less supply, and it is also strong on a small beat on employment. But the fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points, means that the market will increase the probability of this happening. So on the policy front, this did not complicate what would have been a messy situations for the reasons that Jim pointed out. On the economy side, John, just a confirmation that and that U.S. exceptionalism is set to continue.
Mohammed, it makes the decision easy to cut. Maybe still got to wait for CPI next Wednesday. I wonder, though, if it's still just as hard to signal anything for 2025 in a news conference. What is that exercise going to look like in 2 weeks' time?
So it would be hard for this Fed, because this Fed is so reactive, is so data dependent, that it will simply tell us that it will remain data dependent. And I suspect that while the range is going to compress a little bit, you're still going to have quite a wide range in terms of the terminal rate. The Fed always has two options. The option it took in 2021 and got completely wrong, which is to look forward. And now it shied away from that and went to the option of being excessively data dependent. And I suspect they'll stay excessively data dependent. So we're not going to get any strong signals other than we will remain data dependent.
Tom, can I get your opinion on this? What it looks like in December, what the summary of economic projections looks like, what they can project forward, if at all?
Yeah, look, I think Mohammed is quite right. I think, prudence, I think, is demanded right now. Powell's he's in a slightly tricky spot. And I think he's laid the groundwork for that, right? Like you think about his speech at the Deal Book the other day. I think what he laid out there to me, I think made a lot of sort of practical sense. They're just going to continue to wait and see how the data unfold from here. They're not going to pre-commit. I mean, he's already laid the groundwork for, sort of a skip after the December meeting. I mean, he's been pretty clear on that, not just at the deal book meeting, but during the last presser too. So I think, when I think about the sort of the SEP at large, I mean, look, I don't know that they have to make any wholesale changes here. I mean, the economy is more or less evolving in a similar fashion to what they have there for 2025. So again, I think it would be in their best interest to not really make any wholesale changes. This is a nipping and tucking outcome, I think.
Well, when it comes to the data, and we're still waiting on CPI next week, Mohammed, last time you were on for the jobs report, you said inflation is not dead. What kind of number could we see that could potentially change the Fed's thinking at this upcoming meeting?
And you heard from the chair saying that inflation has been more stubborn than he and the Fed expected. Look, we're going to see inflation stuck in the 2.5% to 3% range for the Fed's preferred measure, the core measure. And the Fed is going to have to make a decision. My gut feeling is that it will run with this number there, promising us 2% down the road. And I suspect we'll see 75 basis points of cuts still, but they're going to be spread out. Like you just heard, it's going to be cut, pause, or skip, and then cut, and then we're going to have a huge conversation. Was this a hawkish skip? Was it a dovish skip? So we're gonna go to the third differential now, because we lack proper policy guidance.
Mohammed, you went there. So what kind of skip or cut are you expecting? A dovish cut, a hawkish cut? What are you looking for?
Look, no one is going to predict this when you know that the reaction function of the Fed is backward looking, because it will depend on the latest number, unfortunately.
And CPI drops next Wednesday. Bond yields right now are lower by about 4 basis points on a 2-year. On a 10-year, we're down by about 2 basis points. Equity futures still higher on a session on the S&P 500 by close to 0.2%. The numbers dropped about 12 minutes ago. I want to cross back over to Mike McKee for a little bit more. Mike, you went through what was behind that uptick in unemployment, the snapback that we didn't really get. I think a lot of people in the market were looking for a big snapback in payrolls. Where did we get some growth and where did we miss out?
Well, what's really interesting is we saw a decline in retail sales hiring, minus 28,000 in the month of November, when people are usually staffing up, which leads you to believe that there may be some seasonal effects to this. The seasonal adjustment factors may be holding down the number of jobs created a little bit. Trade and transportation jobs also down 23,000, and that's usually when we're seeing the additional UPS and FedEx drivers and that sort of thing. So a little bit of a surprise there. We did see manufacturing rebound with 34,000 jobs. So good news there. Construction only 10,000. And we're looking at the government hiring is one of the highest at 33,000, but almost all that was state and local. Federal government lost 2,000 jobs. And our old friend, leisure and hospitality, did rebound 53,000 jobs total, and about 28,000 of those were in the restaurant business. So people getting jobs there. And then I do want to point out the 3-digit unemployment rates, 4.246 for November, just below a 4.3% reading. Would have gotten the Fed's attention, if not worried them. Remember, they forecast in September 4.4% by the end of the year.
Good catch, Mike. As we count you down to the opening bell in about 46 minutes' time, you'll see the outperformance on the small caps. The Russell by something like 0.8% at the moment on the screen, up by 0.81 off the back of this move lower at the front end of the yield curve, with yields down something like 4 basis points. Jeff Rosenberg of BlackRock joins us now to get his input on the program. Jeff, welcome to the program. The panel so far suggesting the door is still pretty much wide open for a 25 basis point reduction. Is that your sense of thing as well for 2 weeks' time?
Yeah, I think that's the read. This is clearly just reiterating a gradual slowing in the labor markets. As Mike just pointed out, to all 3 digits, that unemployment rate kind of helps the Fed come in December to cut. The market was already pricing 70% of an outlook for that. And I think the bond market reaction, the initial reaction, is just kind of increasing that on the kind of gradual labor market slowdown. So I think that's very much the read. And as the panel was just discussing, we're going to pivot to this, pause, skip debate and what kind of message that means. But the big debate is over the degree to which cuts have to take place in 2025 and the disconnect between financial conditions, which are going to be easier after today, and the degree of restrictiveness that you still see some of the committee members believe justifies that number of cuts that they're forecasting into 2025.
Jeff, are you arguing then that you need to have a Fed who starts paying attention more? That conversation has kind of gone by the wayside. Are they going to have to rethink cuts because of what this market is doing?
It's gone by the wayside, but then there was a little bit of acknowledgement of it in Powell kind of acknowledging, we cut 50 and then the data revised. The whole issue is really about the strength of the economy. And as Mohammed rightly points out, this is a very, very data dependent and reactive. And the data that's key here on how restrictive policy is really economic growth. And you don't see economic growth well below potential. You see economic growth above potential. And that's telling you that monetary policy is not as restrictive as they think it is. Now, there's a little bit of a disconnect between whether you're looking at the growth measures or whether you're looking at the labor market. Take out about 100,000 from today's payroll print. That's hurricane and strike payback. The labor markets are moderating. That's the best evidence of the restrictiveness. But outside of that, you really see the impact on financial conditions, animal spirits. This is a very supportive financial conditions environment. And that's how monetary policy transmits. So maybe you don't need to keep pushing into financial conditions, easing by this degree of cuts that they've been signaling.
Well, Mohammed mentioned it earlier about now the third degree. If the door's open for this cut and there's going to be a bias to 25 basis points, then what is the tone and the rhetoric around that? Is it going to be a hawkish cut? Because they're going into 2025 and there's going to be a lot of change of fiscal policy in Washington?
Well, it's hawkish relative to expectations, right? So 2 weeks ago, 4 weeks ago, the market was expecting, a very aggressive pace of Fed cuts. Now we've priced that out from the markets. And so there's a little bit less of a disconnect between the Fed moderating the pace of cuts into 2025 and market expectations. So that may read hawkish, but if it confirms market expectations, not so problematic. If there's a even greater acknowledgement of that, I think that would be surprising and that would read hawkish. I think when you get into 2025, it is going to be about understanding this pace of cuts has to slow because the economy and the data doesn't support the amount of restrictiveness that the Fed thinks they currently have.
Another round of Fed speak coming up today, and then obviously we're going into the quiet period. I think they've been quite consistent through the week so far. We've mentioned this quote from Governor Waller in a speech from him earlier this week, cut or skip. This is what he had to say on the neutral rate. There is still some distance to go in reducing the policy rate to neutral. Tom Porcelli over at PGM, I just want to give you a final word just quickly on the neutral rate. They think they're a long way away from neutral. They think they've got space here, which means they can carry on cutting interest rates. How much distance do you think there is between where we are and where neutral might be?
It depends which Fed official you ask, right? I mean, think about the dispersion in the estimates of what neutral is. I mean, the low end is 2.25, and the upper end is 375, right, per the long-term dot, obviously nominal we're talking here. That's 150 basis points of spread. So depending who you ask, you could be really far away from it. I think what's going to wind up happening, John, is this. So if you look at the Fed's 25 dot, the median is 3.4%. I think what's going to wind up happening is that's going to shift higher, right? And I think to Jeff's right point, I think it'll wind up shifting higher to where the Fed, where the market is, right? The market is pricing in, I think, 370 right now by the end of the year. So you take out one of those 4 cuts that they have priced in for next year. I think it falls in line with what the market is thinking, and I don't think that has to be terribly disruptive.
Tom Porcelli of PGM. Tom, appreciate your time, sir. Thank you. Mohammed, I want to come back to you on the same question. I think this is an important debate. How we reconcile our differences here between where the market might believe neutral is and what this Federal Reserve is signaling. How do you think we close that gap?
I think we close it by fudging a very key variable to all this is what is the inflation target. If your inflation target is 2%, then you should not cut in December. if your inflation target is somewhere between 2.5 and 3, which is justified by all the changes, all the structural long-term changes going on in the economy, then you cut. And we are fudging this. No one wants to talk about this. I don't know if you saw a few Fridays ago in the afternoon, the Fed put out its discussion of the monetary coming up and said explicitly, we will not discuss the inflation target. But critical to all this is what de facto inflation target will they run with? My own gut feeling, as I said, John, they're going to run with slightly higher, and that means that ultimately they'll end up somewhere between 3 3/4 and 4.
Mohammed, what about the argument that they can't abandon what they have now as their inflation target because it's important in setting expectations? It's important not to have people run away and think that we're going to have higher sustained inflation and therefore change consumer habits. Is there any credence to that argument?
I think there is, and I think there's many ways to do it, and people have come up with different ways. My concern is if they truly believe that 2% is somehow given to them, it's not an arbitrary number. And if they try to get there and stick to that inflation target, they will sacrifice the American exceptionalism. That's what I'm worried about. But Danny, at the end of the day, I think they're going to fudge it by saying 2% down the road, and it's just going to be a very long road.
Jeff, do you agree with Mohammed that 2% down the road is going to be very long?
I do, and I think this is a really important debate, and the Fed has had this debate, and I agree with Mohammed. They're not going to announce a change to the inflation target. They're going to stick to the target, Danny, for the reasons you point out. They agree as well. It's very important to expectations, but there's a lot of room for interpretation, and so 2, 2.5, 2.6, 2.7, and I agree with Mohammed that the cut in December of 25 basis points is kind of telling you where they lean on inflation versus growth. I think there's some long-term consequences for that, because if the bond market wakes up to the fact that there's a tolerance for inflation, and the real test is, as long as inflation is gradually moving lower, and even if it's moving sideways, they can kind of play this fudge-it game. The real test is what happens if the acceleration in growth, the impact on financial conditions starts to press on inflation. And the one thing we didn't talk a lot about, and it's hard to see here whether the wage number today and the slight uptick is just a mix shift or not, but you haven't really seen the wage numbers kind of conforming to, depends on productivity, the 2% inflation target. The real challenge is going to be, what do they do if inflation starts to go back up? Not predicting that, but that's where you kind of are going to put this 2 versus fudging to 2.5 really to task.
That's the risk for 2025. Jeff Rosenberg of BlackRock. Jeff, thank you, sir. If you are just joining us once again, welcome. 227 is the number. It's an upside surprise against a 220 estimate. Unemployment just creeping a little bit higher, 4.2 and very close to 4.3. The estimate was 4.1%. The takeaway for a lot of people in this market, it leaves the door wide open for an interest rate reduction on December 18th. Still one more data point still to go. CPI next Wednesday. Mohammed Al-Arian still with us for some final thoughts. Mohammed, we all noticed that you published the FT column ahead of this conversation this time. And I noticed the content of that piece as well. It's not about whether the US will outperform. It will. It's the extent to which it will diverge from the rest of the world. You noted earlier this week, and I think it's a perfect time just to finish and think about the rest of the global economy. As we get 227 in America and start to complain about whether that's good enough, the rest of the world is struggling. You noted China and a potential Japanification of China's economy. We've noted Europe's inability to govern itself throughout the whole week so far. In a tripolar world, Mohammed, what does 2025 look like?
It's a world of dispersion. John, I've been saying with you for the last few months, the good, the bad, and the ugly of the global economy are to follow. The good is the US, the bad is China, the ugly is Europe. And we've had confirmation of that over the last few weeks. It is a world where there's going to be significant differences in the three systemically important economies. And that's going to play out in the currency market, first and foremost. It also is going to play out in yields, but it will continue to suck capital into the US. And that's the good news for US markets, that if you think of TINA, there is no alternative. There is right now no alternative to American exceptionalism in relative terms.
Mohammed, just to hang on the point of Europe, Robin Brooks of Brookings wrote a column yesterday basically saying Europe desperately needs a weaker euro. And now should be the moment where the ECB decouples from the Fed, where they cut and they cut aggressively because they need some sort of stimulus that's not coming through governments in Europe. Would you agree with that?
A weaker euro will be like pushing on a string. What Europe needs is fundamental structural reforms. The Draghi report sets out the fundamental problem they have with productivity, with competitiveness. A weaker euro stimulus doesn't address those structural issues. So Danny, I think it's much deeper than that. And I think that Europe has to understand that unless it takes serious steps, it will fall further behind. Unfortunately, the minute you say further step, you need political leadership. And we know what the situation is like in France, we know what it's like in Germany, and there is no European policy without France and Germany leading right now.
There is very little leadership, that's for sure. Mohammed, we're lucky to get some time with you. Appreciate it. Mohammed El-Erin there of Queen's College, Cambridge on this Payrolls Friday. Looking ahead to next week already. The ECB is just around the corner, December 12th. Let's get to the week ahead. It looks like this. Before we get to the weekend, we're going into the quiet period for the Federal Reserve. So look out for some comments from Bowman, Goolsby and Hamak as well. And then as we get further into next week, on Tuesday, OPEC holding its year-end conference. Wednesday, we get some CPI data. Thursday, PPI and another round of jobless claims. And then that ECB interest rate decision. The guest lineup on Monday looks like this. Neela Richardson of ADP, Chris Harvey of Wells Fargo, Peter Oppenheimer of Goldman, and the IIF president, Tim Adams from New York City this morning. Good morning to you all. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that, other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Bring
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Futures turn higher after the jobs number beats. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the labor market bounces back from storms and strikes. The U.S. added 227,000 jobs in November, and that beat estimates.
And a view from the White House, BlackRock and PIMCO. We'll get reaction from all of them on the jobs report, as well as Acting Labor Secretary Julie Su, CIO Rick Reeder at PIMCO is going to join us, and at BlackRock's going to join us, and PIMCO economist Tiffany Wilding.
And Trump taps venture capitalist David Sachs as his AI and crypto czar. The pick underscoring, of course, the president-elect's intent to boost two rapidly developing industries. All of that and more coming up. But let's take a look at where markets are trading. As Matt said, 30 minutes until those bells ring. A little bit of green on the screen, a little bit of a lift after those numbers. It seems like the view prevailing right now is that we didn't get anything that is going to change the Fed's course this month when it comes to rate cuts. As such, a little bit of a muted but positive reaction. The S&P 500, the NASDAQ 100, higher a little bit to the tune of 0.1%. Then you take a look at the bond market, a little bit of a rally as it comes to the 10-year Treasury yield, down about 3 basis points. But watch these levels, Matt Miller. We are well below 420 right now, getting closer to 4%.
All right, interesting move in yields for sure. We're looking also at Tesla stocks within striking distance of a record high after losing, remember, 75% of its value in 2021, 2022. But Elon Musk, the world's richest man, has now given more than $270 million. It's won him great influence over the incoming White House. And now his buddy, part of the PayPal mafia, David Sachs, is going to be an advisor as well to Donald Trump.
That's a lot of money. David Sachs had given a lot of money as well. We'll talk about that a little bit more later in the show. Right now, we're going to talk about some stocks moving pre-market. Just Lululemon surging. Well, more than 8%, almost 9% pre-market. There was strength in their international business. They lifted their guidance for the year. Ulta Beauty, another consumer stock, up more than 10% pre-market. Petco also rising higher after positive results. But higher, 23%. You know, I have a dog myself, so you got to love to see that.
Yeah, I mean, you'd pay anything probably to keep that dog happy and healthy. The dog might have a job. We added 227,000, and that's better than the expectation. I thought it was interesting coming into this. You know, the whisper number was under the survey, so there was potential for a miss. But I guess after the 12,000 reading we got in the last month, this is welcome relief.
But what was interesting and what I want to ask Julie Su as well as Mike McKee about was the revision in October. It was pretty small, just 36,000. I think it was expected to be much higher than that when you think about how noisy the last reading was, but not a huge number there, Matt.
Yeah, I think it's interesting also the unemployment rate was higher, labor force participation lower. All in all, a muddy reading, even if they did beat expectations.
Let's get into this muddy reading here. Not as bad as the stormy one we got last month. Mike McKee joins us to give us the details. So we know the headline number's better. The unemployment rate's a little bit worse. How do you see through these numbers to what's really happening?
We're still looking at it through a foggy lens. I'm sure the Fed is trying to figure this out as well because there's some contradictory information in here. We did have 227,000 jobs, which was certainly lower than higher than anticipated. But payrolls for October we thought would make up a big portion of that, and they don't. With just 30, employment rate comes in at 4.2%, but it's to 3 digits, 4.246. So it was basically just under 4.3%. The average hourly earnings, probably affected by the mix of jobs, doesn't change from last month. And we did see in the month that leisure and hospitality, healthcare, government, the things you would expect to see month after month, added jobs. But the surprise was in retail and trade and transportation, both of them lost jobs in a month where they're usually hiring a lot. So there's very good possibility out there, I suppose, that we have a seasonal adjustment issue with those numbers. And then you also look at the number of people who joined the labor force. That was up, which would contribute to unemployment. But the number of jobs it created in the household survey was down by 351,000. That's all an explanation for the unemployment rate, but how do we compare the 227 to the 351,000? So some interesting divergences in the data that people are going to be looking at.
You know, this year has been a tough year to read the data. I think that's safe to say at this point, but also the surveys, the difference between the household and the establishment survey, they tell different stories, don't they, about how people are feeling about the job market and where participation is happening.
Well, they do, and they also include different criteria. If you're in the household survey, you don't have to have worked at all. If you're in the establishment survey, you get 1 hour in, and you're counted. But in the household survey, if you didn't work very much, you could say, I wasn't at work. So there may be a distortion there. The biggest issue for everybody, obviously, is what is the Fed going to think of this? And it's strong enough, but not too strong. We've got the weak parts in there that they can justify cutting in December if they want to. So now we move our focus to the jobs numbers. We saw the numbers for the Fed funds futures and for SOFR futures show a cut priced in both in December and January. So markets are taking this as a relative positive in the sense that bad news is good news, as it is often for the markets.
All right, Mike McKee, great breakdown. We'll see you in an hour's time. We have some sentiment data coming at the top of the 10, but let's keep the conversation going on what we learned at 8:30, because joining us now is Acting Labor Secretary Julie Su, live from Washington. Great to have you with us again. Let's start with, of course, the hurricanes and the strikes, because there was a beat when it comes to the headline number, but how much of that was simply a rebound from the jobs that we saw lost as a result of the hurricanes and those strikes?
Yeah, absolutely. That's right. You know, last month we said that the numbers that came out were largely affected by the tragic hurricanes, the fact that there were tens of thousands of workers on strike. Now that we are past that this month, we saw the numbers rebound again. And we often look at averages, the 3-month average, even including that month of, of relatively low growth because of aberrational factors, is still 173,000. So the picture of this economy, as we've said over and over again, is one of a historic recovery of consistent job growth. And as you all remarked just before this, the unemployment rate remains really low, not just as an absolute number, but in the face of really record high levels of labor force participation. And those are all signs of an economy that is, not just recovered, but has been consistently strong and stable and continuing to grow.
Yeah, good context there. Of course, we're talking about a slight rise in the unemployment rate, but historically still very low levels. But talk to us about the revisions. This is a puzzle that we were just trying to solve. You had a very small revision to last month's number, just 36,000 jobs revised there for October's number. That came in at just 12,000. The narrative there was, of course, that was going to be noisy when you think about all the different factors, weather, strikes, et cetera. But a small revision, how are you thinking about that?
I mean, I always say this, revisions are really part of the jobs numbers. We report new data when we get it because it's important to be accurate, and it's also important to be timely. So we put out numbers when we have them, we revise them each month. Not only were the last 2 months small, they were also upward revisions. So I always say the revisions can go up or down. It depends on what data we get. And that's also why we look at averages. You look at the story of this economy from 2022, when it was hot and recovering and everyone said it was going to crash. It did not. It reached a more steady state in 2023. And we've definitely seen that continue in 2024. And I think the takeaway is, this has been an amazingly fast recovery. It's also been really broad-based because we've always said that when you prioritize workers, when you prioritize vulnerable populations, the economy is stronger. It's not just good for those individuals, but also we will be, handing off the strongest economy in history, and those were all not inevitable outcomes.
And while you could appreciate the historically low unemployment rate, the fact that it has been ticking higher, and if you round, you're getting closer and closer to 4.3%. How concerned are you about where the labor market is weakening and how fast it might weaken from there?
Yeah, I mean, it's still, 4.1 to 4.3% since the summer. That is still, as we just said earlier, historically low. It was not anticipated to get that low as quickly as it did. I think, what this also tells you is that economic policies matter, leadership matters, and that is a big part of why we've seen the kind of recovery that we've had. And what comes next is going to depend also in large part on whether there is a continued focus on vulnerable populations, on working people. Again, this is the story of this economy with real wages up, and wages going up while inflation is falling is also not promised, but very much central to the Biden-Harris vision of what makes an economy good, what makes an economy strong. And so, I think hard to say what's to come, but those things, that vision is, I think, a really important part of how we make sure that the economy does well for everybody.
The other strength in the data was with the weekly earnings growth picture, where it registered at about 0.7% higher. And even though it's really the focus is on jobs here, the wage growth, wondering how much that signals to you that there's still persistent underlying inflation under the hood here.
Well, the average wage growth over the year is 4%, right? It translated into more concrete numbers. It's like $4,000 for an individual person working, even after taking into account inflation. So, more money in workers' pockets. I've said that a whole bunch of times because that's also really fundamental to how we think about, all of these things are numbers. But at the end of the day, for working families, for individuals, it's about how you feel when you get home at the end of the day. And that's why our commitment to creating not just a large number of jobs, over 16 million since this administration came into office, but also good quality jobs with workers have a real voice, have a real ability to make a good living, to be able to retire at the end of the career with security, have all been really fundamental too. And so I think when you put up wages against inflation, it's a consistent story too, that we shouldn't have to choose, workers shouldn't have to choose, right, between having a good job where they can afford things and our ability to tackle inflationary pressures. The trend in this economy is also
warm out there. That is Acting Labor Secretary Julie Su. Meanwhile, let's take a check on futures right now. Less than 20 minutes until the bells ring. You can see a little bit of a lift in the pre-market. The S&P 500 up about 0.2% if you round up. The NASDAQ 100, a similar story. Where you're seeing real outperformance is the small caps. The Russell 2000 up about 0.8%. Of course, the narrative here is that the Fed is going to proceed with that rate cut in a couple weeks' time. That would absolutely be good news for the little stocks out there. We'll keep an eye on that. And coming up, a great conversation. Rick Reeder, he is BlackRock Chief Investment Officer of Global Fixed Income. We'll get his thoughts on the latest jobs report and what it means for the Fed and for the bond market. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
Demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Context Changes Everything.
Because I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. Where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia News.
Welcome to Balance of Power.
This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. You take a look at this lift in futures right now. A lift in the bond market, of course, yields down, price higher, 10-year yields down about 4 basis points. Now, Matt Miller, I know you have a lot to say.
Well, I just, see the 10-year at 4.13, and I note that that's the lowest we've seen in a couple of months now. And also the mechanics of it are interesting because we can look at WIRP to justify or to, evidence the fact that markets expect a cut. But you can look at the bond market pretty easily. So if you think there's going to be a cut, you want to buy the bonds today to get that coupon before it gets lower. And that's exactly what we're seeing, right? Buying those bonds, pushing the yields lower.
Well, anyways, we have the perfect person to talk about that, don't we, Matt?
Yeah, we do. Rick Reeder is here. He works at BlackRock. You may know him as the Chief Investment Officer of Global Fixed Income. He also runs the BINC ETF, BINC, handily beating the benchmark and returning, I think, 5.9%, which is better than a stick in the eye, Rick. Tell me what your response is to the jobs number beating and, the smaller revisions than we expected, the unemployment number. What do you see there?
So I'd say one thing. First of all, I think the market had set up for a pretty strong number after the hurricane-related number before that. So I think there was a little bit of relief from that. I also, when you dig into this number, the unemployment rate, and Mike McKee talked about this, the unemployment rate ticking up, representative of the fact that, you're seeing some moderate softening in what is a pretty solid labor report, labor market. So a little bit softer when you cut through everything and, expectations that were high. Listen, I think there's some things when you go through it. You look at this leisure and hospitality, it was a pretty good number. So that was solid. But then you go underneath and say, where else? So temporary hiring I thought could bounce back a little bit more after a pretty significant negative the month before. So on balance, with the unemployment rate ticking up a little bit, the Fed can go in December, and then we got a CPI report that's important, so we got to see that next week. But probably the Fed can go in December, and then still uncertain how much more they have to go after that.
Rick, you've talked a lot on this program about how you've liked to invest in the belly of the curve, and we get really jazzed here on this program talking about the moves we've seen at the longer end. Are you excited about the longer end? Do you think that there's a possibility or still too much risk there to extend out on duration?
So if you take the grand suite of investments in the world today, so I'm thrilled that you get excited. I get excited about the fixed income markets, but it's also equities are going up over 20%. Like, that's more exciting. So if you said, I could take risk in my portfolio, do I need long end interest rates, which is obviously a long durated asset, or would I buy equities for my long duration risk? Like, I'll take equities all day with an economy that's growing, an operating leverage machine called the S&P 500. I would take that, and then I just clip loads of yield in the front of the belly of the yield curve. If we can create income, and Matt was kind enough to describe it in our ETF, if you can create income and build 6.5% yield, just by income, I don't think rates are going very far. Certainly in the front end, we'll see how much the Fed can go, and then I just take my risk in the equity market, particularly when equity volatility is so darn low. You can protect your downside that way.
That's a
You
really
don't need rates to
interesting.
protect your equity.
Yeah.
Sorry, go ahead.
No, I was just going to say that's an interesting way to look at it from a portfolio construction point of view, that you take your duration risk in the equity market. And it's been a while that you've been preaching, T-bill and chill, just clip your coupons, be happy, don't overthink it. When does that change? What are the ingredients that need to come to fruition for that mindset to shift a little bit?
Yeah, it's a great question. So it's not today, and it's not going to be January. So, we've got to resolve the dynamic of, we got tariffs, maybe a systemic strategic decoupling in the world, and think about U.S., China, and how do you think through that? Tends to be an inflationary dynamic. You also have the dynamic at play today. We've seen a lot of improvement in inflation. My guess is next year you won't see any more significant improvement, and it probably trends up a little bit more. So I don't think it changes that paradigm unless you believe the economy softens considerably, which I don't think is going to happen. So I think you got a little bit of time. And, I still believe, like you were describing, this idea, stay in the front of belly, clip a lot of yield, use some of the credit markets, securitized markets, by the way, Europe is going to slow. It is slowing faster. Get some European fixed income while you're buying U.S. equities. That to me is a better expression.
Rick, I guess the Fed in Washington matters less than what's going on at the winter White House at Mar-a-Lago. What do you expect from Trump land? What do you expect from the incoming administration especially in terms of tariffs and deportations? Because that's going to have an effect on inflation. And frankly, it's going to have an effect on what we see in terms of deficits as well.
So, it's a hard question. My sense is you have to interpret today that tariffs are going to be the tool of negotiation for this administration, which, as you said, creates some near-term inflationary dynamic. By the way, it also dulls growth. So there's going to be a transmission that we've got to watch pretty carefully. Bit higher inflation, maybe growth trends down alongside that, but then, ironic, and by the way, some cutting of spending, which does dull some of the growth. And then, so we got to keep an eye on that and see how much that takes place. My sense is growth, you look at the U.S. consumer, including the data that we got today, U.S. consumer, when you actually take the income data that comes off of today's data, it's actually pretty good. U.S. consumers in good shape. CapEx in the country is still in pretty good shape. You got an economy that's moving along pretty well. And my sense is the administration will want to propel that forward while trying to bring the deficits down, cut some spending, keep inflation down, or try to keep it down through things like deregulation, energy dynamics. But we're going to learn a lot alongside of that. But listen, I think you can invest in that environment.
You're not the only one who thinks that. We can see from the market that a lot of people agree with you. What about the tariff seems to be our focus, although the mass deportations, and remember the signs at the Republican National Convention, they're serious about deporting millions of workers from this economy on a day when we're focused on the labor market. What does that mean?
So it's a question of how much is going to happen. And so, by the way, if you look at today's job report, and if you look at the jobs report for the last 2 years, 3 years, huge amount of how we filled the labor roles, leisure, hospitality, restaurants, hotels, airlines, was actually through immigration. The transmission, and I'm sure the president and the administration doesn't want to reverse that trend of any significant magnitude while dealing with the illegal immigration. My sense is it's somewhere in the middle, in that you deal with the illegal immigration, but try not to cut off good immigration that flows into things. By the way, also the technology sector, don't cut that off. And make sure the economy's still moving along with, what grows the economy is if you can grow the labor force, you can grow the amount of wage, aggregate wage, and immigration does that. So my senses are going to try and complete a very fine line of trying to complete that effectively with not slowing the economy down.
I almost want to pinch myself for asking this question, but I am surprised at how much it comes up on this program. This whole idea of government efficiency, Doge. A guest earlier this week pointed out that Dogecoin's market cap was $64 billion nearly. That is more than 3 times the size of the Carlyle Group. And so if you think about the efficiency measures that could be put into place, Rick, are you really convinced that it could make a dent in what we're seeing for the U.S.'s fiscal situation?
So I think making a dent is probably the right dynamic. Are there things that you've got some pretty smart people are going to try and cut spending out. It's not that easy because there are so many entrenched programs that are, quite frankly, politically favorable, and I'm not sure Congress is going to allow for significant slashing there. The only answer to make a big difference in the debt is you got to outgrow it. And so the idea is, like, you want to keep the economy moving. If you can grow nominal GDP at 4.5 to 5 and the cost of the debt stays at 3.5-ish, then you can outrun the debt over time. And to your point, I don't think you can elegantly cut spending enough and without slowing the economy down that you're really going to create that much of an improvement. You got to outgrow it. And by the way, U.S. economy, the amount that's being spent on AI and clean energy and other forms that impact infrastructure, like, that's the only way to do it. That's where you make a big dent.
All right, it's a great point. You can't cut your way to growth. I do want to talk about Bing before we let you go. Of course, it's your fixed income ETF, up about 6.5% on a total return basis year to date. If I take a magnifying glass to your holdings, I see a slight rise in securitized products, a slight rise in your high yield holdings. I also see agency MBS coming down. Is that the market moving things around, or were those conscious decisions?
You're pretty accurate. So those were conscious decisions, and some of that is with the rate volatility. Do we need to own as much in the mortgage sector? By the way, I still like agency mortgage, still high quality, super liquid. But gosh, getting yield, I really, kind enough to mention, I just think it's income, it particularly in the front of the belly. And, if we can still get 6.5% yield, and, you look at like European high yield, as a dollar investor, you can get 8-ish. Like, getting that income is still pretty attractive. And credit's in great shape. The economy, it's operating well. They paid down their debt. They termed their maturity walls out. So that was a largely conscious decision, which you were kind of to point out.
Rick, great to have you on the program. Thanks so much for joining us. Rick Reeder there of BlackRock. And, it's so interesting. We have to fight to get Rick on this show.
I know.
Because obviously Surveillance wants him on their show. The ETF wants him.
Yeah, that's true.
Do we still do that interest rate show in the afternoon on Friday?
12 o'clock today. Everybody watch. It's a great show. But, the point he's making about junk bonds, he's not alone. You have junk bonds really headed for its third set of weekly gains. The market piling in right after him.
Well, it certainly helped him beat the ag. Some handy outperformance there. Coming up, it's the opening bell. Don't go anywhere. We'll walk through all the big market moves. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure. And there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda on it, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Futures moving slightly higher on this jobs day. We're moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. You can see it's very slight. So S&P futures up only 0.1%. NASDAQ futures as well. Wow, Russell 2000 futures powering higher on hopes that the Fed will cut rates. December 18th is when we get that decision. And of course, it would be more beneficial to those smaller cap stocks than the big boys. Albany International ringing the bell at the New York Stock Exchange. Down at the NASDAQ, you've got MMMC. Not really important. What really matters is what's the Fed going to do in the shorter term, and then longer term, we have other worries. But in terms of the cash trade, Katie, are we going to see another record today?
Well, we'll see, because yesterday ended up being a little bit ugly for the major averages. At least for right now, you take a look at what's transpiring. At least for right now, you take a look at what's transpiring behind me. The S&P 500 building on that early momentum, up about 0.2%. Similar story if you take a look at big tech, the NASDAQ 100. I'm flying through this, though, to get to the Russell 2000, because that is the outperformer today. And Matt, you said it well, that when and down, the small caps are supposed to go higher. That is the logic working its way through the market. The Russell 2000 up about 0.7%, just 53 seconds into the trade. Meanwhile, we take a look under the hood, because earnings season, it's still here. And Lululemon is surging after the activewear brand lifted its full year net revenue guidance. Analysts also highlighting strength in their international business. And this stock needed it, because through yesterday's close, it was down 32%, Shanali, currently up about 12%.
I'm watching another retailer here, because if jobs are generally strong, so are retailers. Wages strong too. Ulta now up almost 10%. Good day for retail, kind of across the board, isn't it? Shares are jumping of Ulta after the beauty retailer reported better than expected results. It also raised its full year outlook. Matt, people are buying makeup.
Yeah, not me, but I'm glad, I guess. I don't know if I'm
Are you
glad.
wearing makeup, though?
I don't wear makeup
You're
typically.
supposed to.
I know. Let's not tell anybody. Otherwise, the boss is going to be like, you have to. It's HD, right? So you can see every pore. Petco also positive after results beat analyst estimates. Morgan Stanley said there are signs of stabilization in that business, and it's mostly because of Loki. Let's get a closer look at the broader market right now as stocks rise following the jobs report. For that, we go over to Abigail Doolittle.
Well, stocks not just rising after the jobs report, Matt, but we also have a weekly gain. In fact, over the last few weeks, we've mainly had gains for stocks. Let's take a look at the NASDAQ 100 over this time period, up a very healthy almost 8% since the presidential election. In fact, today, B of A's Michael Hartnett saying that stocks and Bitcoin, well, they might get a little frothy in 2025, that stocks could go higher from here, but there's reason to think that there could be some kind of a pullback in the new year. If we take a look at valuation for the S&P 500, we will see Michael Hartnett's point. This is price to book, and you can see right now well above 5, the peak a little bit higher back during the tech bubble, a healthy price to book where you would really want to buy a stock less than 1. So you can see, again, very overvalued. In addition, you can see this massive rally higher. 2 legs of it, pretty parabolic. Parabolic uptrends do tend to consolidate in some way or form. And you can see that happened out of the pandemic rally into 2022. So perhaps Michael Hartnett will prove correct about some sort of cooling off in 2025 for a period of time. As for Bitcoin, well, of course, over the last 2 days, it's been a wild ride. More than $10,000 worth of intraday volatility on Bitcoin as it went back above 100. You can see, though, over the last month, out of the election, the Trump trade, the idea of pro-America, up more than 31%. And of course, his administration expected to be friendly to Bitcoin, and the related ETFs and stocks, well, they are really on a tear.
Really on a tear. You just can't escape crypto. Abigail Doolittle, thank you so much. Let's keep the conversation going now with Gabriela Santos. She is JP Morgan Asset Management Chief Market Strategist for the Americas. Great to see you in person.
Great to see you. Thanks for having me again.
So we get these economic data releases, the jobs report at 8:30, then we contort ourselves to figure out what the Fed is going to do. And with that in mind, I love this first line in your notes. Don't miss the forest for the trees. It's all about fiscal policy, not now monetary policy. Tell me about that.
That's right. I think we've been used to, over the last 15 years, really, to focus a lot on what's going on with the Fed, what's going on with monetary policy globally. I think what the Fed is telling us is we're pretty close to the end of this adjustment period lower with rates. And now it's really about fiscal policy and governments really telling us that they're going to keep these very elevated deficits, very high debt issuance. And so the attention for us next year is really what's going to happen with the 10-year. You could make arguments for it to stay in a pretty wide range between 4-5%, maybe testing that 5% ceiling from last year. And really a lot of attention is going to be paid on the evolution of the tax bill next year. Baked in that the $4 trillion in expiring tax provisions will be extended. The conversation really is additional tax cuts where there's the potential for $3.5 trillion more.
I feel very vindicated because I wake up in the morning and I make Matt look at the 10-year. And for a while there, he's like, yeah. But you look at it now, and you have people thinking it could get as low as 3.5%. I didn't hear that in your calculation here. Do people have it wrong?
They're a little hopeful, right?
Super hopeful.
I have a hard time seeing it get to 3.5%, honestly below 4% on a sustainable basis until we get the eventual next recession. Part of it is for good reason, higher nominal growth. We've seen an improvement in productivity. There is a certain amount of inflation back. But part of it is related to this persistent elevated deficit as far as the eye can see, actually potentially above 7% if all the expiring provisions are extended. And additionally, if we get those additional tax cuts. And I think this is true globally. We're seeing what happens in France. We're seeing what happens in the UK. So the US is not immune to there being a certain premium that investors demand for lending for such a long time to the government.
Even without COVID spending, Donald Trump added far more to the deficit in his first term than even, big spending Biden did. Can we expect the same, you think, in the next Trump administration? And do the bond vigilantes ever come back in force?
This is truly a bipartisan issue, right? And I think part of it is because of how hard it really is to cut government spending. About 80% is just entitlements, defense spending, interest spending, and that's only going to go up from here.
Well, do you have any faith that Elon Musk and Vivek Ramaswamy are going to be able to reduce the budget by $2 trillion?
I think it's a worthwhile effort. We just have to moderate expectations about how difficult that is. Non-defense discretionary spending is only 13%. It's hard to squeeze some juice there without making tough decisions around entitlements. And then in terms of revenue raising, there's the discussion about tariffs. Tariffs represent only 1% of government revenue. So we really have to 1,000x the tariff revenue here for it to make a dent, really. And we're talking about additional tax cuts. That was going to be true regardless of the outcome of the election. That's why bond yields have stayed persistently above 4%. Now the discussion is additional tax cuts. For example, exempting tips or overtime income or cutting corporate taxes additionally.
Well, let's bring this conversation to the stock market because we talk about all these different cross currents, what it could mean for the long end of the Treasury curve. You write that for asset classes across the board, it's the long end that you need to pay attention to. So how does this filter through to the equity market?
I think for equities, it's all about, as it has been this year, why the 10-year is moving higher. So especially over the month of October, it really was moving higher for good reason. Resilient data, the job scare from the summer had passed. Things are looking all right. It's just a normalizing, pretty good labor market and economy. I think what we have to watch next year to see if this starts becoming a hurdle or potentially a catalyst for a correction in equities is if the 10-year starts moving higher, much more about this fiscal concern, or if it starts moving higher because of inflationary concerns again. So unfortunately, I thought we were done with inflation. I think next year we have to watch that again, and specifically inflation expectations, which have moved higher by 60 basis points since mid-September.
Looking at fiscal policy, looking at the long end, is it fair to say that Gabby's research is driving our conversations with every guest today?
Yeah, it really is. And, you know, the other part of this, too, we were speaking to Rick Reeder at BlackRock just a little bit ago, and he mentioned growth concerns. And if you're concerned about growth, then what does that spillover look like into the equity market, particularly if you're one of the investors that believes that a lot of the growth this year was really kind of at least backstopped, if not propelled by government spending?
So I think in terms of growth, there's a nuance. What we've been seeing in the economy, in consumer spending, in the job market, in cyclical sectors like manufacturing and housing, is normalization. By normalization, though, we do imply a certain downshift in the pace of growth from the 3% we've been seeing this year towards a 2% next year. And then there is some optimism about certain elements of economic policy. Lifting of animal spirits we started to see, but there are also countervailing aspects of economic policy, like an increase in trade policy uncertainty. So for next year, we're penciling in about 2% growth. As you get that deceleration, you might have moments of correction in the market, but overall, I don't want to leave the bearish impression here. We still think there's opportunity in risk and equities and corporate credit. It's just that I think you have to work harder to really get that access to that pretty decent growth story, especially with valuations, as you were mentioning, where they are now.
Well, that's a great note to leave it on. It's great to see you again. Come back soon. That is Gabriela Santos of JP Morgan Asset Management. Now, coming up, the retail roundup. We'll take a deep dive into results from Lululemon, Ulta, and Petco. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets.